Hi there. In this, I'm going to be talking about financial markets, institutions, and intermediaries in the context of debate. Before that, a couple of caveats. First, I don't work in or study finance, so as always, take this with a grain of salt. Second, and more importantly, the purpose of this presentation is not per se to outline a set of principles relating to finance that are immediately useful for debate. Rather, I've written this presentation with the aim of building an understanding of how the financial system works, and more importantly, why the financial system works the way it does. The aim of this presentation then is not to provide you with facts that are immediately deployable in debates about finance. Rather, it's intended to help you understand the financial system in a way that's more intuition-based, which hopefully makes it easier to understand, for example, how to make arguments about banks or how to debate the merits of regulation. Third, this presentation will be rather long, and so it's probably best to watch this in parts. The way I'd personally recommend is starting with the section on commercial banking and understanding the major risks involved in commercial banking, the model that commercial banks adopt, and then shifting more towards capital markets and intermediaries. And if there are particular sections that you understand less well than others, you probably should spend more time thinking about or reading about or just working through those topics. The other thing I'll add in terms of a caveat is that I'm not going to talk that much about sovereign finance. I have a small section on debt restructuring and vulture funds and a bit on sovereign wealth funds and the issuance of sovereign debt, but this is not going to focus all that much on sovereign finance. And I'm not going to talk at all about crypto. My personal inclinations, not that that's relevant, but personally, my view is that crypto is either a scam or a cult or probably both. If you want to read more about crypto, there are plenty of great resources online. I'd recommend you check that out. Before I get into actual substance, I just want to address the sort of elephant in the room, which is that debating about finance can be tricky. And so there's a couple of reasons why that might be the case. One is just a mental barrier. It's difficult to understand finance if you're not familiar with financial principles. And that can create a real mental barrier to even trying to learn about finance. It's easy to feel like, well, I'll just take the four on finance debates. Maybe finance just isn't my thing. The second barrier is just that finance is typically couched in jargon, and it's difficult to understand what jargony terms mean if you're not familiar with them. And the third related barrier, in my view, is just that finance is heavily interconnected, which is to say that if you don't understand one concept, it's often hard to understand others. So, for example, if you don't really understand the concept of leverage, it's going to be hard to understand the concept of hedge funds, or you can only partially understand it. So, if you don't understand concept X, any concept that depends on or derives from concept X, it's going to be hard to understand a whole range of topics in finance. So, just a bit of advice on each. In terms of mentality, finance is really not that bad. My personal view is just that finance uses needlessly complicated terms and jargon to mask what is oftentimes a fairly intuitive understanding of human behavior. And it's worth remembering, by the way, that you can read about finance without reading about it in the way that a finance bro would. You don't need to, for example, be reading markets and market information every day or monitoring the stock market or price indices to debate finance. You can entirely depend upon narrativized accounts of finance to figure out how the financial system works. So, for example, Michael Lewis has written plenty of books that are entirely digestible. Are they perfectly accurate? Well, some people would dispute that, but they're a completely reasonable way to learn about finance that doesn't require you to be super knowledgeable about the internal mechanics of leveraged buyouts or whatnot. The second barrier on jargon, I think the best way to approach jargon is the first time you encounter a term you don't understand, figure out how to translate it into terms that you do understand, then revisit it 1, 2, maybe 3 days later and do the same process again. Make sure you can translate the jargon back into terms that you understand. And then at some point in time, you should be able to intuitively associate the jargony term with your personal understanding of what the jargony term means. But what this means is that finance does take a bit of time to learn, because in order for finance to be something that sticks in your mind, you have to have some repeated exposure. So, for example, if you can't off the top of your mind or tongue define liquidity, well, that's fine, but you're going to want to spend at least 1 or 2 pass-throughs just making sure you can, off the sort of tip of your tongue, explain what liquidity means in the financial system and why it matters. The last piece of advice I'll give is about interconnectedness in finance. I think the one reason why finance is perhaps easier to understand than other concepts in debate is just that the financial system sort of is a story. By a story, what I mean is that there's sort of a reason for every component of the financial system. It might be silly reasons, like, for example, why are there trillions of dollars in repurchase agreements issued and purchased and sold every day? Well, it's largely because of tax and regulatory reasons relating to the comparative advantages that repos have over bank loans. So in some cases, the reason why a particular part of the financial system exists is not interesting or spicy. But on the whole, you can explain or understand why different parts of the financial system exist or work together in a way that is sort of story driven. So just to give an example, if you want to explain the rise of money market mutual funds and their role in shadow banking, at first that sounds like a very complicated and needlessly esoteric concept. But if you approach it sort of like a story, and you think about, for example, how caps on interest rates paid to bank depositors drove depositors toward money market mutual funds because they could get higher returns from those funds than they could on bank deposits, which in turn fueled the rise of shadow banking. Well, now you have sort of a story that stitches different parts of the financial system together. Relatedly, one way to make the story of finance make more sense is to use generative AI. I think one of the best ways that you can use ChatGPT for debate is basically to test your understanding of financial concepts. So, for example, just write out arguments or write out your explanations of particular financial concepts and just ask ChatGPT if this is correct or what's wrong about your definition or characterization. It's a very useful way to get pretty fast and quick feedback in a way that doesn't require ChatGPT to be a good debate judge, for example, because you're just using ChatGPT to say, test your knowledge of whether you properly understand equity markets or something like that. In terms of how this presentation will be organized, I'll start by talking about banks, then shift towards capital markets, and then talk for quite some time about institutional investors. I've integrated sort of four-ish distinct case studies in here. These are mostly intended to illustrate broader concepts like interest rate risk in the context of Silicon Valley Bank, or the role of hedge funds in global financial markets in the context of the Treasury basis trade. So the purpose of these case studies is not that you need to know these things for debate, but they're intended to concretize broader concepts. Additionally, a lot of this presentation includes references to articles or books that I found useful. So anything I've referenced in this slideshow is something that I've read or found useful when I was learning about finance. So I've tried to cite where you can find these things, like author names, years, etc. I do recommend reading at least some of them. I think it's a pretty good way to familiarize yourself with the mechanics of the financial system. Before we get into banks and what banks do, how they work, the risks they face, etc., it's worth just talking briefly about why the financial system matters. What I mean by that is there are two types of debates about finance. First, there are debates that are just about the financial system, like motions about bank regulation. And second, there are motions that are not directly about finance, but involve arguments about the financial system. An example of this would be something like a debate about housing policy. Debates about housing policy will affect real estate markets, and effects on real estate markets will in turn affect banking systems. Or motions about tariff policy will impact manufacturers, which will in turn affect bank loans, which will in turn affect the financial system. So in debates about just the financial system, most teams will accept the financial system matters, or why it's important to have safe and functional financial institutions. In debates where you are making an argument about finance and other teams are not, it's very important that you actually explain why your impact matters. What I mean by that is it is not at all intuitive beyond buzzwords why we should care very deeply about the financial system's health in comparison to other impacts. For example, if you're in a debate about housing policy and one team says, well, we reduce housing prices, and your side says, well, you're going to cause a bank run, it's very difficult to concretely understand why a bank run is worse, for example, than lower housing prices. So in order to make the financial system or arguments about the financial system resonate with judges, you always have to ensure you explain what I think of as the transmission mechanism between the financial system or the financial economy and the real economy. So, for example, you can make arguments about how people are directly exposed to financial markets. When stock prices go down, for example, that means people's pensions take a hit. When banks stop lending, that means people can't get mortgages. You can also make arguments about companies and governments. Companies and governments both rely on borrowed money to do things like pay employees, build infrastructure, finance research and development. So to the extent that technological development is important, that is often constrained by the health of the financial system. And of course, the easiest way to make arguments about finance and its relevance to the real economy is just to talk about what happens when the financial system gets in trouble. And in that context, it's fairly easy to show that financial crises often become real economic crises in a way that causes people to lose jobs, people to lose their homes, so on and so forth. But these are arguments that need to be explained, particularly when other teams aren't arguing about finance and you are. These are just some illustrations that you might be able to give. In terms of the precise transmission mechanisms that you might highlight, these are a couple more about asset prices, for example, affecting middle-class households, or credit availability affecting technological growth and innovation, or the ability of people to find gainful employment in a context where firms don't have the working capital to pay salaries. These are just some examples of how you might justify why the stability and functioning of finance matters for real people's lives. Remember, judges won't care, immediately at least, about impacts to things like liquidity or price discovery or the profits of hedge funds. Those things don't matter in a tangible way. They matter because of their impact on the real economy. So whenever you're making arguments about finance, it's important you don't just impact to the financial system. You then link the financial system and your specific impact on the financial system to the real economy. So just to give an example, I'll return to the specific example of high frequency trading later. But suppose you're debating about the merits of high frequency trading. I'll explain again what that means later in this presentation. You might make an argument on op that says high frequency trading is good because it increases liquidity by reducing bid-ask spreads in stock markets. That's a fine argument, and there's a good bit of empirical research to say that's true. But this argument is completely useless if you end the argument there. You need to actually connect liquidity in stock markets or bid-ask spreads to real people's lives and why bid-ask spreads in stock markets matter for people's financial well-being. Again, if the term bid-ask spread means nothing to you, we'll get to that later. The point is that you would need to link, for example, lower bid-ask spreads means that it's cheaper to trade. And when it's cheaper to trade, that means middle-class households have more money in their pensions because savings and trading costs get passed on by pension funds to the people whose money is in pension funds, which in turn means that people can better enjoy their retirement, for example. So with the general introductions out of the way, we'll start by talking about banks, both because banks are the sort of bedrock of the financial system, and also because they show up in a whole range of debates, including debates that have very little to do directly with the financial system. First, this sounds a bit stupid, but it's worth asking, why do banks exist? I don't mean that facetiously. I mean, really, why do banks exist? In the sense that it's not clear that people need to put their money in banks. We could just have our money sitting around. So why do people bother putting their money into banks or into any financial institution for that matter? One reason is safety. In a very trivial sense, if you have money laying around, that's a literal risk. What if it gets stolen? But the more intuitive reason is because putting money in banks is great for you individually. The bank will pay you money in the form of interest on your deposit if you just put your money in the bank. Now, from the bank's point of view, it might not be immediately obvious why that is. Why would a bank pay you money for you to give money to the bank? Well, the intuitive reason why is because banks can use your money to do productive things that make profit for the bank. In other words, the bank can use other people's money, make investments, and then make some profits on those investments. And if banks pay you less money than they make in revenues on the interest rates that banks charge on their loans, then banks run a profitable business model. So there's a natural relationship between banks and depositors. Depositors want a safe place to keep their money, and banks are willing to do that for them and provide them with some interest on top of it. Interest here just being additional money that banks pay on your deposit. And the reason why people don't do this banking activity for themselves, for example, the reason why people don't just hoard their own cash and issue their own loans, because in theory you could charge loans on your own and just be a person that runs your own bank. Well, there's lots of reasons why you wouldn't do that. The most obvious is you're not really, as a regular person, in the business of making loans. It's hard, it's complicated, it's risky. What if you don't make the right loans? It's going to take you a lot of time to screen potential borrowers to determine if they're sufficiently stable borrowers. So the banking system arises because there's a natural synergy between people who need money, i.e. borrowers, and people who want to save money. And the banking system exists to connect those two groups, i.e. the banking system exists to match borrowers with lenders and lenders with borrowers. Banks just happen to sit at the middle of that relationship. They pay interest to depositors so that depositors put their money in the bank. Banks then use that deposited money to make loans. A more technical way of putting this is banks perform three functions, which are called credit intermediation, liquidity transformation, and maturity transformation. Remember what I said earlier, that finance is filled with jargon? it's useful to learn the jargon, but the best way to learn the jargon is to understand what terms mean individually and eventually reconstruct these terms once you can explain each individual word in its own particular meaning. So let's start with credit intermediation. Credit intermediation sounds scary. It's a fairly simple concept in practice, though. The idea of credit intermediation is there are people who want to borrow money, and there are other people who are theoretically willing to lend their money out if it means that they get some money back. And banks basically intermediate that process. So credit is basically just one person lending money to another, and then that person promising to repay. And intermediation is just some institution sitting at the middle of a transaction. So credit intermediation literally is just a bank is intermediating the transfer of money from lenders to borrowers. Now, it's a bit weird to think of depositors as lenders. So, for example, if you have a bank account or people that you know have a bank account, you might not think of them as lending their money, but essentially that's what they're doing. They're putting their money in the bank, and they're then trusting that the bank will use their money to make loans that will generate profit, and then the depositor is going to be paid some interest as a sort of output of that profit. So if you're a bank, one part of your business is funding related. You're just trying to attract depositors. And the way that you do that is by offering interest and ensuring that their money will be kept safe. Of course, the harder part of banking is lending. So the second big thing that banks do in credit intermediation is actually issuing loans. And of course, the problem with issuing loans is that there are lots of people who want to borrow money, but many of them aren't worthy of credit, which is just to say they're not going to pay the money back. So for example, if I went into a bank tomorrow and asked for a $5 million loan, they'd say, Ryan, you're crazy. You don't have the ability to repay us $5 million. What are you on? And so to that extent, if you're a bank, you're not just in the business of raising money, you also need to determine which borrowers are suitable to give money to. And once you've determined who you're going to give money to, you then need to figure out, well, what interest rate am I going to charge on this person? How risky of a borrower are they? How large of a loan should I give them? So on and so forth. The harder components of banking to understand are liquidity and maturity transformation. Credit intermediation is just banks transfer funds from people with excess cash to people who need cash. Liquidity and maturity transformation relate to how banks change the nature of money. So for primers, what is liquidity? The simplest way to think about liquidity is how easy is it for you to turn something into cash without majorly reducing its value? So here's a very simple example. Cash is considered a liquid asset. Why? You can very easily turn cash into cash because money is money. Cash is cash. And to that extent, if you needed to pay for something, for example, if you order a pizza and the pizza delivery man driver pulls up at your house and says, hey, here's your pizza, cost is $20, give me some money now, you would be able to very easily provide them with the liquidity that they're asking, the money that they're asking by just handing over some cash. But for example, if you were like, well, look, I know the pizza costs $20. I don't have cash on me. I don't have a credit card, but I do have this really nice and fancy set of Pokemon cards that's worth well over $20. They're probably not going to take your offer, even if it's valid, even if it really is the case that those Pokemon cards are worth more than $20. And the reason is just because that's a relatively illiquid asset. It's not perfectly illiquid, but in order for you to turn Pokemon cards into cash, you're going to need to find someone who's willing to pay for them. You're going to need to arrange the transaction. You're going to need to ship the cards. You're going to need to receive the money, so on and so forth. And all of this is probably going to take a lot of time. It's going to require a lot of effort. And there's a good chance that whatever the actual objective value of the Pokemon cards is, you're going to get a bit less than that in cash, just because the transaction has a bit more bargaining power on the buyer side than the seller side. So in that context, liquidity is just you have something, you own something, an asset, if you will. How easy is it for you to turn that thing into money without majorly reducing its value? Cash is a great example of a liquid asset because it is literally liquidity. It is just money. An example of something that's not literally money, but is still considered a liquid asset because it can be easily turned into cash without significantly reducing its price would be a very highly rated government bond. So, for example, if you buy a bond issued by the United States government, that basically is a fancy way of saying the US government has promised to repay you some money. So you now basically owe debt that's been issued by the US government. That's all that a sovereign bond is. Now, is a bond itself money? No. If you walk into the pizza restaurant or talk to the pizza delivery guy and you're like, hey, I have a Treasury bond sitting in my bank account. Will you take that as payment? They're going to say no, because a Treasury bond is just a piece of paper saying the US government has agreed to pay you X amount of money on this date. It's not good as money itself. But there are tons of people who would be willing to buy that government bond from you. So if you went to a financial market and said, hey, I've got this government bond, I'm willing to sell it, it would be very easy to quickly turn it into cash. And so for that reason, a government bond is considered a very liquid asset. By contrast, a very illiquid asset would be something like housing or real estate. If you own a house and you want to sell it, that is a long and difficult process. You're going to have to find a realtor. You're going to have to find a potential buyer. The buyer is probably going to have to go and get a mortgage from a bank. That's going to take time. They're going to have to determine the relevant price that they're going to pay for the house. There's going to be a negotiation around that. There's a whole regulatory process for approval. And this process is probably going to take at bare minimum days, probably weeks. And even when you do sell the house, there's a good chance it's going to sell a bit below whatever your initial asking price was. And if you tried to sell the house really fast, well, then you're going to have to sell at a really steep discount. So in other words, if you said, look, I really need the money by end of day, I've got this pizza delivery driver waiting for me and I need to pay him the $20. Well, if you want to sell your house in 2 hours, you're not going to be able to sell it for full asking value. You're going to have to take a discount. And so that would be an example of an illiquid asset. If you want a really illiquid asset as an example, intelligence would be one. Technically, you own intelligence. It's technically your asset, but it takes a very long time to turn intelligence into cash. You need to use your intelligence to get a job, to get hireable skills, to get employment, and then get a paycheck, and then that's the money. But you can't easily, for example, turn IQ into cash. That's a process that takes a very long amount of time. And as such, it's just sort of weird to say intelligence is illiquid, but that would be an example of something that's on the very extreme end of illiquidity. So that's what liquidity is. How does it apply to banking? Well, think about the two things that banks do. Banks take deposits and they make loans. Deposits are liquid, which is just to say that deposits can be easily turned into cash. Why? If you put your money in the bank, you basically reserve the right to, at any given moment, walk into the bank and pull your deposit out. So if you walk into your bank and say, I want my money out, the bank basically is obligated to agree and give you your money. So deposits are sort of by definition liquid. At any moment, depositors can walk in and take their money out. By contrast, loans are not liquid. So here's an example. You're a bank, you issue a loan that is due for repayment in 10 years to some business. Now, if you suddenly, as the bank, need money tomorrow, you might say, look, this business has promised to repay me a lot of money. I promise I'm going to have the money. The problem is I'm going to have the money in 10 years. Now, maybe you could try to haggle with the borrower and say, hey, I know that I just gave you the loan a couple days ago, but I really need the money back. Well, here's the problem. The borrower's probably spent it. So for example, take a mortgage. If you're a homeowner, well, you take out a mortgage from a bank and you use the money to pay for a house. If the bank then comes back to you 5 days later and says, oh my gosh, we're so sorry, we really need the money back, you're in a bit of a pickle because you just used all that money to pay for your house. So a loan is illiquid in the sense that it can't easily or readily be turned into cash. Now, there is a slight workaround, which is called calling in a loan. A bank might call in a loan, which is basically to say it goes to its borrowers, and if it's contractually permissible based upon the loan contract, the bank might say, hey, we're basically demanding repayment now. You could try doing that. The problem is that if you demand repayment early as the bank, you almost always are going to get less than the full value of the loan because whoever borrowed the loan isn't prepared to repay you in full weeks, months, years ahead of its proper due date. And so for that reason, loans are also illiquid because even if you can turn the loan into cash quickly, it's going to be at a very steep discount. So what this means is that if you're a bank, you have very liquid deposits. You are obligated to give cash to people when they demand cash. But your investments, your loans, your assets, in other words, the stuff that you own, the cash that you will make in the future, that's illiquid. You can't easily turn loans into cash. That is the liquidity problem that banks face, and it's called liquidity transformation. Banks take a very liquid liability, in other words, deposits, and they turn it into a very illiquid asset, in other words, a loan. So in other words, banks take money from depositors, that's liquid, and they then produce loans, that's illiquid. That's what liquidity transformation means. Maturity transformation is a bit easier to understand. Deposits can be withdrawn at any time. They are short-term liabilities in the sense that if a depositor comes to the bank tomorrow and says, I want my money out, you're obligated as the bank to give them their money. Loans don't work the same way. They are long-term. And for that reason, banks also engage in maturity transformation. Here, maturity, you can sort of just think of as time. How long does it take for the loan or for the investment to mature, to payoff, for example. So deposits are short term because they can be withdrawn at any time. Loans are long term because they take months, years, sometimes decades, even centuries, heck, in the case of sovereign bonds, to be repaid. That is maturity transformation. Banks have short-term liabilities, stuff that they owe, and they have long-term assets, the stuff that they own. The simpler way to think about this is banks lock up a lot of their, in fact, nearly all of their money in long-term investments that they can't easily redeem, but the funding that they use to make those investments, that comes from deposits that can be taken away at any time in the short term. That is liquidity and maturity transformation in commercial banking. So, given that banks intermediate credit and transform both maturity and liquidity, they face two distinct and very major types of risk called credit and liquidity risk. So, credit risk is the easiest type of risk to understand. It's basically the risk that someone doesn't repay you. The simplest way to think about credit risk is a bank makes loans. What happens if the borrowers don't repay? That's credit risk. Why is credit risk a problem for banks? Well, remember, banks are getting money from depositors, and they're then using that money to make loans. But if the value of loans goes down because borrowers aren't repaying, then the amount of money that banks own in the form of their loan portfolio will be less than the amount of money that banks owe to their depositors. For example, a bank might have $100 million in deposits, so it makes, I'm making up numbers here, $100 million in loans. But if only $90 million of the loans are paid back, well, the bank now has $90 million from its loan portfolio, but it owes its depositors $100 million. That's a bankrupt bank, which is just to say the bank doesn't have enough money to meet all of the demands of its depositors, and that would be an insolvent bank. It would not be a solvent financial institution, and it would declare bankruptcy. Liquidity risk is a bit trickier, but it follows naturally from the previous discussion about liquidity and maturity transformation. If you're a bank, you're issuing illiquid loans through liquid deposits. And that creates a risk of you not having enough cash on hand to meet all of your depositors' withdrawals. This is what's called the fractional reserve banking system. The way that commercial banks work is they get lots of money from depositors. They invest most of it in loans, and they keep some of it in reserve in the form of cash or very liquid securities, something like a Treasury bond, that they can easily turn into cash as needed. Now, this works fine in normal conditions. Why? Well, in normal conditions, not all depositors are going to take their money out of banks at the same time. So as long as banks have maybe 5, 10, 20% of their deposits in the form of cash on hand at the bank, if just a couple of depositors are coming in asking for their money out, they're going to be able to meet the demands of their depositors. The problem arises when a bunch of depositors demand their money out all at once. For example, imagine you're a bank, you have $100 million in deposits. So maybe, I'm again making numbers up, you keep 10% of that, $10 million, sitting around in cash that you can use to pay out your depositors as needed, and you invest $90 million into loans. That's fine as long as on any given day, no more than $10 million worth of depositors ask for their money out. But what happens if 20% of your depositors come into the bank one day and say, hey, we want our money out? Well, now you as the bank have a problem because you don't have enough liquidity on hand to meet those withdrawal requests. In other words, you have enough money to pay the depositors back at some point in time. After all, you have $100 million in assets under your control, $90 million in loans, $10 million in cash, or reserves, as they're more technically called. The problem is people want their money now. You can only get them their money in the future. This is the quote unquote maturity mismatch that makes banks vulnerable to what are called bank runs. Bank runs occur when depositors worry that banks aren't going to have enough liquidity to provide funds to depositors. And what this means is people will run to the bank physically, prior to the age of electronic banking, physically run to the bank and try to get their money out fast as they can. Why? Maybe they don't think the bank is actually bankrupt, but they worry that other depositors are going to be doing the same exact thing. And if all depositors start running on the bank at the same time, a bank is quickly going to exhaust its liquidity. It's going to burn through those reserves, and it's not going to be able to give depositors the deposits, the liquid financial assets that they put into the bank. By the way, there's a great scene from The Simpsons that you can watch that sort of nicely illustrates this if you'd like. I'll link that in the slides below. By the way, Paul Krugman, who for many years ran a blog at the New York Times and now has a Substack, has a really nice sort of brief summary of this dilemma. It's well worth the read. So this creates a fundamental problem in banking. And the fundamental problem in banking is even a perfectly healthy, perfectly risk-free bank, risk-free in the sense of credit risk-free, it's not at risk of mass defaults on its loans, a perfectly healthy bank can be crushed by a bank run in the sense that if a bunch of depositors start worrying about other depositors running on the bank, even if no individual depositor actually thinks the bank is insolvent or near insolvency, the bank can still go under as a consequence of bank runs. And that's a huge problem for the financial system. And for centuries, this was the major issue that affected financial markets. The solution is what are called public credit guarantees. And there are two major implications of this. The first is deposit insurance. The way that deposit insurance works is that governments promise that depositors' money will be safe no matter what happens to the bank. If the bank is healthy, the bank will just give you your money. If the bank goes bankrupt, the government will make sure that all of your money is paid back to you. The reason why deposit insurance works is it removes the incentive to engage in bank runs because you're no longer really that concerned about what happens to the bank or whether other depositors rush to take their money out of the bank because, hey, the government's got your back. That's, for example, what the Federal Deposit Insurance Corporation does, or the FDIC. The way the FDIC works, by the way, is that the FDIC provides deposit insurance to what are called insured depository institutions. And in exchange, those banks pay small insurance premiums to the FDIC. The FDIC uses that money to pay out depositors in the event that a bank goes under and can't repay its depositors. But the whole point of deposit insurance is to ensure that this happens rarely. That is, ideally, deposit insurance means that bank runs happen never, which means that deposit insurance funds are never needed. But still, the FDIC has a fund because inevitably bank runs do happen. We'll talk about that in a bit in the case of Silicon Valley Bank. So that's the first implication of a public credit guarantee. The government basically guarantees the safety of deposits up to a certain threshold. So, for example, in the United States, it is notionally $250,000, though arguably it's higher now post SVB. More on that later. The second way that governments address liquidity and liquidity and credit risk is through lender of last resort status. So the way this works is central banks agree. Central banks are the monetary authorities in countries. They manage the money supply, they adjust interest rates, they influence banking regulations, and so forth. Central banks basically will offer money to banks that are solvent but illiquid. So the distinction again between solvency and liquidity is solvency is whether you own more than you owe. In other words, you have more money than you are obligated to pay to other people. So a solvent bank is a bank that hasn't suffered a huge problem of defaults, for example. An illiquid bank is a bank that, if you look at its balance sheet, it has money and it has more money than it owes, but there's a time mismatch problem or a liquidity mismatch problem where the bank's money is mostly locked up in long-term illiquid assets like loans that the bank can't easily turn into cash to meet short-term withdrawal requests. What central banks do in this context is they lend money to the bank. Now, the reason central banks do this is that they recognize the bank is a safe bank, it is solvent, it is just facing a liquidity problem. So what the central bank can do is it can lend money to the bank and say, look, we're going to give you the money that you need to pay your depositors. Now, we are going to require you to post collateral. Collateral basically is an asset, something of value, that a borrower says, if I default, you can take this. So here's a simple example. A mortgage is a secured loan. If you want to be fancy, you could call it a hypothecated loan. What that basically means is a mortgage is a loan from a bank to a homeowner. The homeowner gets money and uses the money to buy a house. The house is the collateral for the loan. If the homeowner cannot repay their mortgage, the bank will seize ownership of the home. That's what collateral means. In the context of a central bank, the way this would work is the central bank would say, look, we think that you're a solvent bank. You're just facing a liquidity problem. We'll give you the money that you need to address your bank run or your liquidity problem and ensure depositors get their funds. But in order to make sure you're actually solvent, we're only going to do this on the condition that you post good quality assets as collateral. Why does that make sense? Why do central banks require that? Well, the reason is because central banks don't want to be in the business of lending lots of money to actually broke banks. In other words, if you're a central bank, you want to give money to solvent but illiquid banks, but not money to insolvent and illiquid banks. That would just be a bailout in essence. So central banks require that banks that borrow from central bank liquidity facilities, like the discount window, for example, that's run by the Federal Reserve of the United States, post collateral to secure these loans. That's basically a way to solve the adverse selection problem of insolvent banks trying to get bailouts via the central bank. This relates to what's called Bagehot's dictum, which says that central banks should lend freely to solvent firms at penalty rates against good collateral. The idea is they should give liquidity to banks that are facing a liquidity shortage, but they should only do so when there's good collateral available to make sure that insolvent banks don't get bailed out. The idea of penalty rates is that you don't want banks to over-rely on central bank financing, so the interest rates should not be ridiculously low. In practice, of course, there's a bit of a tension here because central banks need to make sure that the funding is affordable enough that distressed banks can afford to take out loans from the central bank. The other problem, by the way, that central bank lending facilities face is stigma. It's a bit odd to say stigma in the context of finance. The problem is basically this. If you're a bank, it's a bit of a bad look in the eyes of other lenders and other financial institutions if you're taking out money from the central bank. The reason intuitively is the central bank lending facility exists to help banks that are struggling for some reason. So if you're a bank and it's found out that you're borrowing from the central bank, in other words, you're using the discount window, for example, there's a risk that other banks get a little bit angsty and say, I'm concerned about your creditworthiness or the health of your financial institution. Maybe you're not a particularly safe borrower. Maybe you're not a particularly safe counterparty. And that potentially risks or sort of jeopardizes the stability of the bank, its ability to get credit from other banks, so on and so forth. That's the sort of stigma associated with the discount window. Central banks try to mitigate this in a variety of ways. For example, most central banks won't publicly identify the nature of the banks or the size of bank loans that's issued through these liquidity facilities until a few years afterwards. And the other thing that banks as well will do in periods of major market distress, like the 2008 crisis or the COVID crisis back in 2020, is lots of banks will collectively borrow or will kind of collectively agree to borrow via central bank lending facilities as a sort of show of force that exploiting this opportunity to borrow from central banks is an opportunity that banks should take advantage of, as opposed to shirk on the basis of concerns over the discount window stigma. So given that context around lending and the sort of distinction between solvency and liquidity, by the way, it might seem like a bit of a abstract concept whether a bank is solvent. In practice, it's actually a pretty major difficulty in financial markets. For example, back in 2009, a sort of interesting economist blogger at the time had a pretty long and pretty interesting blog post that's kind of interesting to read about whether or not the financial system circa the 2008 crisis was collectively solvent. And the issue with that question is it's actually hard to determine what we even mean by solvency. A more tangible example of this is there's a major debate to this day about whether Lehman Brothers, which is the major bank that failed on September 15th, 2008, and sort of triggered the worst of the 2008 financial crisis, there's disagreement about whether Lehman was actually solvent. Lehman was certainly illiquid. It didn't have the funding on hand to meet short-term debt obligations, but there's disagreement as to whether or not Lehman's assets were sufficiently valuable for Lehman to sort of constitute a solvent bank. It's a debate that mostly involves looking at Lehman's balance sheet and trying to assess the value of those assets. So by this point, what we've seen is banks face a set of risks. They face credit risk, they face liquidity risk. They also face a couple of other risks that we'll talk about down the road, but those are the two critical ones to understand. And we've also seen that there's a way to solve the problems associated with bank runs, which is to provide deposit insurance and lending of last resort facilities like the discount window in the United States. There is, however, a problem, which is although these regulations like deposit insurance and lending of last resort via central banks, although that's eliminated largely the problem of bank runs, it's also created other problems. And the main problem it creates is a potential for moral hazard. Moral hazard is basically the concept that if someone else is going to bear the costs of risky behavior, you're more likely to behave riskily. So in the context of banking, if someone else is going to foot the bill when you lose money, but you stand to gain if your investments pay off, you're naturally going to take riskier bets because the losses, those don't affect you, but the gains, you internalize them. Why does moral hazard matter in the context of deposit insurance? Well, the issue is if a bank is covered by deposit insurance, depositors no longer really care about the riskiness of the bank. More specifically, depositors are no longer personally affected by whether the bank is making very risky or not risky loans because their money is guaranteed by the government in any case. So there's no reason for them to monitor their bank, how much equity their bank maintains, whether their bank has kept sufficient reserves, etc. And there's no real reason for you to shop around for a safer bank. For example, when regular people with normal amounts of money are looking for banks, they're not really in the business of looking around to say, well, does this bank make really risky investments versus that bank? The more important factor is what interest rate will be paid on my deposit account. So that's a potential for moral hazard. Because there is reduced monitoring of bank risk taking. And there's also, of course, a more active form of moral hazard here, which basically is that deposit insurance means that banks can very easily access very cheap funds. And because there is this lender of last resort facility available to banks, it's a bit easier for banks to justify to themselves taking risk on the basis that, well, if the risks don't work out and we end up losing money, the government is sort of there to de facto bail out our depositors and arguably bail us out through the form of lending of last resort. The government is going to give us loans even if no one else will in the form of the central bank. So what this means is that by solving the problem of bank runs, deposit insurance and lending of last resort facilities give rise to moral hazard. And the risk with moral hazard is that banks will start making increasingly risky loans because the upside from those loans is higher. Risk is proportional to reward. And banks don't really have a strong enough deterrent against this because the potential downsides are socialized via deposit insurance. So how do governments solve the moral hazard problem? Well, in theory, they solve it through regulation. The idea is because governments provide banks with two massive benefits in the form of deposit insurance and lending of last resort, the quid pro quo is that banks have to accept regulation from the government. In particular, they have to accept prudential regulations, prudence meaning sort of risk minimizing, that limit the degree to which banks can take on large amounts of risk. This, by the way, would be a sort of narrativized vision of how all of these factors fit together. So what specifically do governments do? There are a whole slew of regulations on banks, and they vary wildly by jurisdiction, by context, by country. By the way, I'll talk mostly here about the US context, both A, because that's the context I personally know the best, also B, sort of objectively, whether you love this fact or hate it, the US financial system is by far the world's largest banking and financial sector. And as a consequence, banking regulations in the United States have pretty major effects, not just on the US economy, but also on the global economy. The two most important types of regulations on banks pertain to capital and liquidity. So capital, in fairness, is a misleading term here because when you hear capital, what you probably think is money. And that's what I'll typically mean when I say capital down the road. So, for example, when I talk about capital markets, I'll be talking about markets to raise money for banks or for businesses or for governments or for households. But here, when I talk about capital regulations, capital has a slightly different meaning. It's basically the buffer that banks have to absorb losses. So if you look at a bank's balance sheet, you'll basically see three things on the balance sheet. First, you'll see assets. That's the total amount of stuff that banks own, the money that will be brought into the bank. That, for example, would be securities that the bank owns, like stocks or treasuries. It would be loans that the bank has issued that will be repaid to the bank. It would be reserves that the bank has in the form of deposits it hasn't lent out. That's the first thing on the bank's balance sheet, assets. The second would be liabilities. That's what the bank owes. So the major liability a bank will have is deposits because banks owe money back to depositors should they choose to withdraw. Now, in theory, assets equal liabilities. So in other words, if a bank owes $100 million, it's got to have at least $100 million in assets to cover that. In practice, though, banks also have a third component of their balance sheet, which is called equity. Equity fits on the liability side of the bank balance sheet. And equity is basically the money that either the bank's shareholders or owners put in, as well as retained earnings that constitutes the buffer, so to speak, for banks to absorb losses. This is slightly different from loan loss reserves, which is basically another component of a bank's balance sheet where banks plan or account for the fact that some of their loans won't be repaid in full. But equity or capital in this case is basically the extra money that banks have in their balance sheet just to absorb losses. So here's a kind of hypothetical example. Suppose that you're a bank, you have something like $90 million in liabilities, $10 million in capital or equity, and $100 million in assets. What basically that equity exists for is the first $10 million of losses on the bank's assets won't affect depositors. So in other words, if $10 million of loans fail, the bank's assets shrink to 90 million from 100 million. This doesn't trigger a crisis for the bank in the sense that the bank doesn't have enough money to repay its $90 million deposits because the bank has a built-in buffer in the form of equity. Again, equity would be money that the bank's founders or shareholders put in or money that the bank has retained. And there's also other forms of bank capital. But for the macro perspective here of understanding broadly what capital regulations entail, that's sufficient to understand. And so the purpose of capital is basically the buffer on a bank's balance sheet to absorb losses before losses start to affect depositors or creditors, excuse me. In other words, the people who have lent money to banks. Capital regulations require banks to hold capital in proportion to the riskiness of their assets. Now, this is a little bit tricky, but the concept is, and this relates particularly to what are called the Basel Capital Accords, which are a series of international standards established by the BIS, negotiated by a whole bunch of international countries. And what the Basel Capital Accords aim to do is require banks to hold enough capital on their balance sheet to absorb losses on their assets, their investments, in other words. So the way this works is that different categories of assets will receive different risk weightings. So in the simplest version of this, back in Basel I in like the 1980s and 90s, for example, something like a Treasury bond would be given a risk weighting of 0. It wouldn't count towards the bank's capital requirements. So if you owned a bunch of government bonds that are considered risk-free, you wouldn't really, under the Basel capital requirements, have to hold all that much capital. But if you invested in something riskier, like corporate loans, for example, that would receive a higher risk weighting, something like a risk weighting of 1.0. So in that context, you would need to hold a larger amount of capital in order to absorb potential losses. The purpose of capital regulations, which exist in droves to this day, they're very complicated because that risk weighting procedure is increasingly sophisticated. But the purpose of capital regulations is to require banks to have enough of a buffer to absorb losses without creditors like depositors losing money. Liquidity regulations are easier to understand. They're basically just requirements that banks need to have enough cash or cash-like assets on hand that they can pay out people who need their money out of the bank, like depositors. The way this works in practice is that banks have to hold either a lot of money in reserve. These are what are called reserve requirements, which are established by central banks. A reserve requirement is sort of what it sounds like in the name. It is a requirement that banks keep some fraction of their deposits in reserve. So maybe, for example, if you are in a country with a 15% reserve requirement, or reserve ratio, that means if you have $100 in deposits, $15 has to be kept aside. It can't be invested in loans. It's got to be kept aside just to serve as liquidity so that if depositors come in and say, hey, I want my money out, the bank agrees and says, okay, great, here's your money. In practice, this is often not just cash. The reason that banks don't like holding cash is because cash doesn't pay returns. You could alternatively put cash into very liquid securities. By the way, a security is just something that you own that sort of pays you interest or gives you some money, basically. And more importantly, it's something that can be traded. So, for example, a Treasury bond is a security. It pays you money. You can trade it. You can buy and sell Treasury bonds with other investors. Of course, some securities don't pay you money directly. So, for example, a stock is a security, which is just to say that you can buy and sell stocks. A stock itself is not going to directly pay you interest, but it entitles you to ownership of a company, which in turn entitles you to a share of its profits and to dividend payments. More on that later. So, banks don't like holding cash because cash doesn't pay interest. You can get interest if you invest in a very risk-free asset like a Treasury bond, even though the actual rate of interest will be very small. So in practice, most banks hold what are called HQLA, that's high-quality liquid assets. It's basically very, very low-risk assets that can be very easily and very quickly turned into cash. An example of this would be something like a government bond that can be very easily sold on a moment's notice. And there are lots of very fancy and specific regulations that pertain to how much money banks have to keep in the form of high quality liquid assets as opposed to relatively longer term or relatively illiquid assets, something like a corporate loan or a mortgage, for example. That's harder to turn readily into cash, but that's the important context behind the liquidity regulation. Capital regulations aim to limit credit risk, both by deterring banks from taking on too much risk because that increases the risk-weighted assets, which means they need to hold more money in the form of capital, and by ensuring that banks have enough or large enough buffers to deal with losses. Liquidity regulations aim to reduce liquidity risk because banks have enough money on hand to meet withdrawals. Now, there are also lots of other specific regulations that restrict what banks are allowed to do. The most famous example of this in recent memory is Dodd-Frank. That's the law that was passed in 2010 after the Great Financial Crisis. Dodd-Frank implies a range of regulations on banks. It requires banks to conduct stress tests. It creates new regulatory bodies that monitor for consumer exploitation. The Volcker Rule is a component of the Dodd-Frank Act that prohibits banks from doing what's called proprietary trading. That's when a bank uses its own money, its own profits, for example, to invest on the bank's own interest as opposed to invest on behalf of its clients, like its depositors. So there are lots of regulations on, for example, banks can't invest in hedge funds, or banks aren't allowed to invest in very specific types of securities that are considered very, very high risk. And those are intended to reduce the aggregate level of risk-taking that banks engage in. Now, a real question to ask about this is, do bank regulations work? Which is just to say, do bank regulations actually prevent crisis? The case for optimism often gets undersold in debates. Bank regulations arguably are fairly effective. Banks don't want to break regulations. There's a major risk of lawsuits and a huge loss of funds. A lot of people's response to this is, well, banks aren't concerned about breaking the law because they're so huge, they're so massive. What does it matter if, a fine gets imposed on a bank? And of course, the response to this is, yeah, a bank might be massive and have hundreds of billions of dollars in assets under its management. But the relevant question a bank has to ask is, does the profit from breaking a law exceed the expected value of the fine? So here's an example. Suppose a bank figures out a kind of risky way to sidestep a regulation. And doing so is going to give the bank a profit of $750 million. Now, there is, however, an 80% chance the bank gets caught. And if the bank gets caught, it's going to face a $1 billion fine. Well, in this case, the expected payment that the bank is going to have to provide to the government in the form of a fine is something like $800 million. Now, although the bank might theoretically not get fined, or even though the bank itself might be worth $2 trillion, and heck, $1 billion to a $2 trillion bank means nothing, if you're the bank, you're still going to take a loss on that specific trading strategy, because although the $1 billion fine doesn't mean much to you as a multi-trillion-dollar institution, it does mean a lot specifically in relation to the profit you've extracted from that trade. So for that reason, bank regulations that are enforced through court orders or through regulatory bodies do matter a reasonable bit. The other reason that banks do care about regulations is because regulations influence their ability to engage in other types of behavior. So for example, if you're a bank with a repeated history of breaking bank regulations, it will be harder for you to get regulatory approval to merge, for example, with a different bank, or you're at greater risk of having additional capital requirements imposed upon you, which further reduces your profitability. So in that sense, bank regulations very much do restrict the behavior of banks. In fact, probably the best arguments against bank regulations aren't that they don't work, it's that they work too well or are enforced so zealously that they shift trading and investing behavior out of the traditional banking system. That being said, you can make arguments about why bank regulation tends to be ineffective. One argument is a lobbying argument. To be clear, the lobbying argument is often under-mechanized in debates. The proper way to make the lobbying argument is, if you're a politician, the way that you win elections is by persuading swing voters to vote for your campaign. The way to convince swing voters to vote for your campaign is to run advertisements or large political campaigns that convince those voters that you're the better candidate. In order to run those campaigns and advertisements, you need money. And large banks can lobby legislatures through campaign finance contributions in a way that encourages political candidates to adopt positions that are favorable to banks. That's one way that lobbying might work, because if you're a candidate and you need money to win the election, it logically makes sense to align your position with that of a large bank that can provide you with substantial campaign financing. The other way this works is that banks just selectively provide campaign financing to anti-regulation or pro-deregulation candidates, and in doing so boost the odds that those particular candidates succeed. So that might be one argument about why regulations don't work. The specific reason why this would be effective is because it can result in banks convincing legislative bodies or regulatory agencies to water down regulations with lots of loopholes. So, for example, the Volcker rule on paper should be simple. It should be two sentences. Sentence one is insured depository institutions can't invest in covered funds like hedge funds. Sentence two, insured depository institutions cannot engage in proprietary trading. Congratulations, that's the Volcker rule. In practice, the Volcker rule is something like 300 to 400 pages because there are lots of very dense and esoteric carve-outs for, well, proprietary trading is permissible under these circumstances. And within those circumstances, there are specific sub-cases where prop trading is or is not permitted. And that gives banks and their legal teams lots and lots of rooms to find loopholes. Now, of course, regulators can patch those loopholes and they can say, the Volcker rule is being exploited in XYZ way. Let's solve that loophole. The problem is that regulators move slower than bankers. Part of this is just an incentive mismatch. If you're the banker that finds a clever way around a loophole, you get rewarded with a multi-million-dollar bonus for bringing in tens of millions of dollars to the firm. If you're a government regulator that finds a clever way to patch the loophole, you probably get a pat on the back and maybe a mild promotion at best, but as a consequence of restrictive compensation packages in public sector careers, the incentive to find solutions to loopholes just really is not as strong as the incentive to break regulation by finding loopholes. And the fact that Wall Street can hire just about the best corporate law firms in the world certainly gives large financial institutions a leg up in these matters. That being said, those are the two arguments that you'll most commonly hear for why regulation doesn't work, i.e. lobbying and loopholes. They're probably the less persuasive in comparison to the revolving door and arbitrage arguments. The revolving door argument is empirically very compelling. The claim is most regulatory agencies, like the Securities and Exchange Commission in the United States, for example, or the ESMA over in Europe, if you look at who's actually running those agencies, almost all of the top folks running bank regulatory bodies are themselves former banking employees or banking executives. So, for example, if you looked at the Treasury during the U.S. financial crisis back in 2008, who was running the U.S. Treasury Department? Well, it was a guy named Hank Paulson. Before Hank Paulson was working for the Treasury, which played a major role in, for example, the bank bailouts and the U.S. government's response to the financial crisis, the bailing out of Fannie and Freddie, Mae and Mac, etc., where was Hank Paulson? He was the CEO of Goldman Sachs, one of the largest financial institutions in the United States. Now, why does this happen? Well, for one reason, there's a sort of inverse revolving door effect, which is banks love to lure regulators into their camp because if you're a regulator, whatever the regulatory body is paying you is pennies on the dollar compared to what JP Morgan is going to pay you. So banks can easily poach regulators into their camp. And once you have the regulators working for you, it's much easier to figure out how to evade detection, how to evade enforcement. And the other effect, of course, is just that lots of top banking officials end up becoming the folks that run these institutions. They have political connections. They're the likeliest to be appointed. And those people, in turn, then have their own selfish motives for undermining the efficacy of regulation. And in that sense, the revolving door effect, whereby corporations and regulatory bodies see employees circle back and forth, undermines the effectiveness of regulation and the sort of implementation of regulation in the first place. The second effect that's related is regulatory arbitrage. Suppose for a moment that bank regulations work perfectly. They absolutely prohibit banks from doing whatever regulations don't want them to do. Well, in that case, regulations very commonly reduce the profitability of banks. For example, they limit the types of loans that banks can make, or they limit the hedging strategies available to banks. What happens when banks become less profitable is that they can A, issue fewer loans, and B, pay lower interest rates on deposits because they're just not making as much profit. Well, when that happens, more and more lending starts to be done by financial institutions that are not nearly as regulated as banks, like private credit funds, for example, or private equity firms that we'll talk about later. And the other effect is that people that are figuring out where they want to put their money are increasingly unwilling to put their money into a bank deposit when they can just put their money somewhere else, like a money market mutual fund that doesn't face all of these cumbersome government regulations. And as the money market mutual fund can make more profits, it can pay higher interest to the people who buy into the fund. And as a consequence, depositors have an incentive to withdraw money from banks and shift it elsewhere. The consequence is the more and more that you regulate banks, the less and less lending banks do, and the less and less money there is in the banking sector. And the consequence of that is that money flows into less regulated sectors of the banking system. And so in that sense, regulation can arguably be counterproductive. Related to regulation is the concept of too big to fail. A common argument you'll hear in debating, and also in that matter in public discourse, is that large banks are too big to fail. They are systemically important. And to be clear, this is not just a leftist talking point. There are actual banks designated sci-fis. That means systemically important financial institution. And there's lots of other modifications of this. Like, for example, there are GSIBs, which are global systemically important banks, for example. The reason why they're called systemically important financial institutions as opposed to just banks is that there are lots of financial institutions that are systemically important that are not banks. An example of this would be insurance companies can often be systemically important based on how much money they manage and how many investments that they make. The concept of too big to fail is there are some banks that are so vast, so massive, so interconnected with the financial system, and so complicated and complex that if they went bankrupt, the entire financial system would grind to a halt. Lending would evaporate. Households would see a huge reduction in their wealth. The stock market would implode. Businesses wouldn't be able to get loans. Factories and stores would close down. The global economy would probably lose 5, 10, 15 percentage points. That's a bit of an exaggeration, that last part, but the other one's not as much. Just to give you an example of what this might look like, JP Morgan is the largest bank in the United States, at least by asset count. And JP Morgan manages something like $4 trillion in assets. Just to give you a comparison, that's roughly the GDP of the entire country of India, which is a nuclear superpower and a population well over 1 billion people. Now, that's not to say that JP Morgan has the same level of influence as India or vice versa. The point is just systemically important financial institutions are sort of modern empires in terms of the amount of capital that they command. Now, the main concern with too big to fail financial institutions is twofold. One is one I haven't written on the slide here, which is probably the strongest argument, which is just that the existence of sci-fis is inherently risky, just on the basis of diversification. Even if significantly important financial institutions aren't excessively risky, if any one of them collapse, the financial system worldwide would be in major jeopardy, and that's arguably an intolerably large risk. The other argument made against too big to fail banks is the moral hazard claim. So as a reminder, moral hazard is the idea that if someone else bears the costs of risk, you'll naturally be inclined to take more risk. So the way that this argument can work is two ways. One, in probably the weaker argument, says the reason that too big to fail banks are bad is that these banks expect to be bailed out by the government. That's fair, to be clear. If you're a bank that is so big that your collapse would tank the global economy, it's not unreasonable for you to expect the government would bail you out were you to actually go bankrupt. And so if you're a banking executive, you might say, look, if we make a high risk, high reward bet and we make the bet and it works, well, we make a lot of money. After all, that's the whole part of the high reward and high risk, high reward. But if the bank investment fails and our bank goes bankrupt, it's fine because the government will just bail us out. So there's no reason for us to be risk avoidant. We should be risk taking because the losses are socialized. They're covered by the government. The profits are privatized. They are exclusively held by us, the bank. The other version and the stronger version of the moral hazard argument, or at least the version I consider to be stronger, is the claim about borrowing costs. And there's actually some pretty good empirical research on this. The gist is, if you compare borrowing costs for systemically important banks compared to banks that are not as large, and if you control for other variables like the natural effects of size, for example, banks that are perceived by markets to be too big to fail are able to borrow at artificially low interest rates. And there's an intuitive reason for this, which is If you're an investor, if you're a lender, the interest rate on a loan reflects the riskiness of the borrower. For example, if a borrower is very likely to default, you will charge them a very high interest rate because it's a very risky investment. You need a high return to justify making such a risky loan. And if a borrower is very safe, well, you're going to charge them a very low interest rate because they're not at high risk of default. If you're a lender and you're considering lending to a large bank, you probably believe that large bank is so large that it would be bailed out in the event of a financial crisis, which means the bank basically is incapable of failing because the government will foot the bill and bail out its creditors. Consequently, very large banks can borrow at very, very low interest rates, and they can borrow huge amounts of money at very, very low interest rates. The logic being that creditors are not willing to discipline systemically important banks because they are perceived to be near risk-free investments. The consequence is A, large banks are not disciplined by markets. Normally, if a bank takes huge amounts of risk and that risk isn't healthy or managed or hedged or diversified, markets punish the bank by hiking interest rates on its bonds and its loans. And that naturally creates a self-fulfilling or self-corrective mechanism whereby excess risk-taking reduces the amount of debt that a company can take just on the basis of no one's going to give you money at affordable interest rates. That doesn't happen for systemically important banks because there's no disciplinary mechanism in lending markets. In other words, if a bank takes lots of risks, but it's systemically important, its borrowing costs don't go up to reflect the increased level of risk. The other implication is that very large banks are able to borrow enormous amounts of money because investors will happily lend as much money as these banks want to gobble up because they are perceived to be very likely to repay that debt. That increases leverage, which, as we'll talk about later, specifically in the context of hedge funds, magnifies gains when profits come in, but also magnifies losses. That being said, the too big to fail argument has lots of problems with respect to the moral hazard claims. Probably the strongest argument against the moral hazard concern is just management incentives. Maybe it is true, potentially. I'll just skip ahead for a second just to, there's a quote somewhere I wanted here. Yeah, this is a nice quote that I think kind of neatly captures it from the New Yorker a couple of years ago. But one argument that is sort of captured with the management claim is the moral hazard argument sort of tacitly assumes that banks make these cold and calculating decisions to acquire huge amounts of risk based on the belief that the government will bail them out. And it's not actually clear that banks make that calculation. Much more commonly, the reason that large banks like Lehman Brothers or Bear Stearns or Silicon Valley Bank, the former two being much larger than the latter, I should note, in terms of importance to the financial system, most of these banks fail just because they're stupid or they make bad decisions, not because they consciously calculated the government would bail them out. The other related reason why moral hazard is not a huge concern relates to management incentives, which is if you're a bank manager, in other words, someone who's actually running the bank, the person who's actually making the investment decisions, maybe the bank will be bailed out, but you're still going to lose your job and probably lose quite a lot of your money if the bank goes under. Why might that be the case? Well, for one, it's possible you as the executive or you as a bank manager or investor at the bank will be fired before the bank actually gets the bailout. For example, the former CEO of Merrill Lynch, Stanley O'Neill, lost his job in 2007, nearly a full year prior to Merrill declaring bankruptcy and subsequently receiving some bailout funds from the US government. The other way this might happen is you might run a bank and expect to be bailed out, and the bank goes under and no bailout comes. The most famous example of this that you should memorize is Lehman Brothers was not bailed out in September 2008 when it failed. Dick Fuld was the CEO of Lehman at the time and certainly didn't get any bailout money. The probably most important reason, though, why managers recognize that counting on bailouts doesn't make sense is because bailing out banks is fiercely controversial for political reasons. And when governments do bail out banks, they have huge incentives to conditionalize bailouts on firing the managers that were responsible for taking too much risk. So, for example, long-term capital management was a very large and famous hedge fund back in the 1990s that went bust in August and September of 1998 when its financial models didn't price in the risk or the potential risks associated with the Asian financial crisis and what ultimately became the Russian financial crisis. What happened with long-term capital management was that it did tacitly get bailed out. A consortium of banks led by the Federal Reserve Bank of New York agreed to bail out the fund to prevent a broader financial meltdown on Wall Street. But just about all the people at long-term capital management lost their jobs. They didn't get to stay around in the fund. The fund was functionally dissolved, even though its creditors were repaid. And the reason is because there's fierce political pressure to not be seen as a government that you're giving huge cash handouts to the very people who engineered a financial crisis. And so for that reason, if you're a manager, yeah, maybe the bank is going to be fine, but you individually aren't. The response to this argument, if you want to still claim that managers have the incentive to take on too much risk, is first, if a bank is bailed out, that typically means its share price recovers. So even if the bank manager loses their job, most bank managers and executives are heavily compensated through stock options. So as long as the share price of the company remains reasonably high, you're going to be fine because most of your compensation isn't the salary from your job, it's the stock options that you receive. The second response is if you're a manager working at one of these large firms, written into your contract often is what's called a golden parachute, which basically means when you are fired, irrespective of the conditions under which you're fired, the bank has to pay you a large severance package when you leave. So even if, for example, the bank managers lose their jobs, they're still going to end up just about fine. The second reason why moral hazard might not be a concern is just that bailouts are not, in fact, guaranteed. The most famous example is Lehman. There's lots of political reasons for that, like a fear of populist backlash. There's also technocratic reasons, like governments know that there is a very real moral hazard concern associated with bailouts. So famously, Hank Paulson, the Treasury Secretary back in '08 in the United States, was very concerned about being seen as bailing out banks. He did not want to cause that level of moral hazard, even if that meant short-term pain for the US economy. And one of the more boring reasons why bailouts aren't guaranteed, especially in not US countries, especially in countries that have limited tax bases, is just it is a lot of money to bail out multi-billion-dollar banks. And lots of governments are too cash-strapped during a recession, which is often coincides with bank failures, to engage in mass bank bailouts. So an intuitive example of this would be lots of banks in Greece circa 2000, or sort of early 2000s, theoretically could have thought, hey, if we ever go bankrupt, we're going to get bailed out by the Greek government. The problem, of course, is when the Greek financial system went belly up and the Greek government defaulted on its sovereign debts, the Greek government was drowning in debt and was barely able to keep essential services running, much less provide capital to bail out the banking sector. And so in that respect, there are reasons to believe bailouts aren't guaranteed, which in turn mitigates the moral hazard argument. Third reason moral hazard is not a major concern is just that the financials, sort of the architecture of financial regulation has changed since 2008 to specifically signal to markets that future bank failures will not be met with bailouts. So one of the major examples of this is what are called the TLAC requirements, which are total loss absorbing capacity requirements. Basically, these are requirements that require banks to explicitly set aside money that more or less could be used during the failure of a bank. It's literally intended for money to be there in the event that a bank goes under, as money that can be burned through in the event that a bank faces major financial difficulties. The other element of this is what's called, this is the least snazzy title for a financial reform ever, but the key attributes of effective resolution regimes for financial institutions. It's this sort of comprehensive approach laid out by the FSB, the Financial Stability Board in the United States, working in conjunction with a series of global regulatory bodies. Basically, what this is most regulatory bodies in most advanced economies now have basically required banks to draw up plans for what would happen if they were to ever go bankrupt. And in particular, what these plans aim to do is, what are the essential services that your bank provides to financial markets, and how can we keep those things running? So just to give an example, BNY Mellon is a very large bank in the United States. BNY Mellon does lots of things. It runs deposits, it issues loans, it does underwriting, it helps with a whole range of financial activities. But one of the most important things that BNY Mellon does is something called the tri-party repo clearing system. The specific details are a little bit complicated, and we'll talk about them later. But the TLDR of what BNY Mellon does is it acts as a sort of intermediary in a multi-trillion-dollar debt market called the repo market. And BNY Mellon is one of the only major financial institutions to do this. It controls something like 80% of these intermediated transactions. If BNY Mellon went under, there is a huge risk that the tri-party repo market would suffer dramatically were it to go out of business. So that's why, if you have a what's called effective resolution regime in place, there would be a drawn up plan that would allow BNY Mellon's core essential functions, like its tri-party repo clearing system, to remain intact, while the rest of BNY Mellon is basically allowed to cease functioning and to go bankrupt. And so in that way, you can prevent sort of system-wide failure in the financial system while also ensuring an orderly wind down of banking systems, of individual banks to prevent collapse of the banking system. A fair question you might ask is, well, why do these reforms reduce moral hazard? Well, the logic is the main reason that governments bail out banks is because they have no better alternative. If they let the bank fail, the global financial system collapses. And if they bail out the bank, that's a huge transfer of wealth from regular taxpayers to shareholders on Wall Street. And that's a huge moral hazard concern, not to mention a political concern as well. If you have a better solution available, which is to say a way to orderly wind down banks in a way that keeps their core services running, and provides for a bail-in system. A bail-in system basically is when the people that are owed money by the bank are basically forced to accept losses, but the bank itself is allowed to continue operating in some capacity. That's different from a bailout, where the government steps in and gives money, and then the money now available to the bank can be used to repay creditors. The logic is if there's sort of a middle ground solution in a quote unquote resolution framework, well, that reduces the probability a bailout comes. And importantly, it reduces the expectation a bailout will come, which in turn reduces moral hazard. Last thing just to point out is if the moral hazard argument was true, you'd expect to see some evidence for it. But interestingly, the evidence for too big to fail hypotheses is somewhat weak. So one of the simplest pieces of evidence is that back in 2008, lots of people seriously thought that when the United States government bailed out Bear Stearns, that was a major investment bank that failed in mid-March 2008, lots of people were terrified that it would cause a huge moral hazard crisis. And lots of people say, look, Lehman Brothers failed just 6 months later in September of 2008. Clearly, moral hazard was at play. The problem is, if you look at how banks treated Lehman Brothers in between March and September of 2008, just about everyone on Wall Street expected Lehman to fail, and just about everyone was trying to get out of Lehman Brothers. They were trying to stop trading with Lehman. They were trying to wind down their exposure to Lehman, etc. That's not the behavior you'd expect if everyone thought that Lehman was going to be bailed out and would receive government funds. And what this is sort of evidence of is two things. First, moral hazard might just not itself be true. Markets don't price in expectations of bailouts nearly to the extent that doomsday sayers say they do. But the second thing is that bailouts have a sort of weird effect, which is once you bail out the first firm, it counterintuitively might reduce the probability that you bail out the next firm to go under. The logic is after the first bailout, so for example, the US bails out Bear Stearns in March of 2008, there's mass political uproar and huge, huge opposition, both from the left, which sees this as a sort of capitalist intrusion on the well-being of the working class, but also on the right that has a deep-seated distrust of large financial institutions. The consequence is the next financial institution to go under doesn't get the same treatment. And so in that sense, markets don't really behave as if moral hazard is true. For example, there's pretty compelling evidence that the borrowing costs claim, i.e. the claim that large banks can borrow at artificially low interest rates, well, it's true. The actual change in borrowing costs is not massive. It's something like 0.3%. That's what at least one study that I read a couple of months ago, or probably actually a few years ago now, but I've linked it here, found, even if you control for other variables. And yeah, that does mean that banks can borrow at lower rates when they're systemically important, but 0.3% reductions in interest rates is just not enough to cause banks to behave in a systemically risky way. The Other argument you could make against moral hazard is just that systemically important banks are so large that they're too big to fool, which is to say that these are the most scrutinized and monitored banks in the history of mankind, which means that these are the banks that are the least able to get by on fraudulent investments or the least able to invest in systemically risky strategies without drawing the ire of regulators and also their counterparties. By the way, this is sort of a graphical argument against moral hazard in banking systems. So the argument is a little bit complicated and requires a bit of context. Credit default swaps, we'll talk about swaps later, but the TLDR of a credit default swap is it's basically a bet on whether or not a company is going to go bankrupt. And the idea is that the higher the premiums are, that basically means a company is more likely to go bankrupt. The specific technical explanation here is a credit default swap is basically a contract that says if this company defaults, then you owe me money. You basically cover the money that should have been paid to me by this company but wasn't because now they're bankrupt. And in exchange, I will pay you monthly premiums. The size of those premiums is proportional to the probability that the underlying company goes bankrupt. So, for example, if a company is extremely unlikely to go bankrupt, then the premium should be very low because the cost of insurance is very low. The risk of failure is very low. But if a company is very likely to fail, then you would expect to see high premiums because, oh my gosh, I'm selling you an insurance contract on a very risky business. That's naturally a risky endeavor. And so I'm going to expect a higher interest rate as a consequence. So credit default swaps are basically ways of investing in credit risk. That's the concept. And the premiums on those default swaps represent the probability of bankruptcy. This here is a graphical representation on what's called the CDS spread. That basically means the spread or sort of the gap or difference between different types of banks and relatively risk-free assets. The idea is the higher the spread, in other words, the larger the gap, that entails that markets are pricing in a higher probability of default. So a high spread means markets think that this company is going to fail. And what each of these lines on the graph shows is the probability that different types of banks fail as represented through CDS spreads, i.e. CDS premiums. And if you look at this, what you'll notice is, okay, non-systemically important banks are deemed riskier by markets. So you might say, aha, that means moral hazard's true. And that's fair, but also remember, non-systemically important banks are also more likely to fail by nature. They're less diversified, they're smaller, so they're naturally more prone to individualized shocks. They're less able to engage in sophisticated forms of risk management, et cetera, et cetera, et cetera. There's lots of exogenous reasons not related to moral hazard here. But what's notable about this chart is, although it is, while it is certainly true that non-systemically important banks are deemed more likely to fail compared to systemically important banks, if you don't look at the non-systemically important banks, the main takeaway you should have from this is markets really do seriously think that large financial institutions are capable of defaulting. Now, does that mean that everyone in financial markets thinks the default is guaranteed in the event that does that mean that everyone in financial markets thinks that bailouts won't come? No. It just means that there's some balance in markets between creditors that do think that the government would bail out banks and creditors that don't think that governments will bail out banks. And the resulting consequence is that banks are not considered by any stretch of the imagination risk-free. The fact that their premiums on default swaps are very high during moments of distress. Look at the jumps, for example, in 2008 and 2012, is pretty compelling evidence that moral hazard has some empirical arguments against it. And so if you were to actually turn this, for example, into a debate argument, you might make arguments in favor of large financial institutions, like they can access economies of scale by distributing their fixed costs over many more loans, many more investments, et cetera, in a way that means that they can offer lower interest rates and pay higher deposit rates to their depositors. They can remain competitive because they face competition both from other mega banks, but also from other financial institutions like private credit firms that are also competing in the lending and wholesale funding marketplace. And then, of course, you could identify a range of reasons moral hazard might not be a particularly major problem. That being said, we have spoken only thus far about two types of risk, which are liquidity risk and credit risk. Credit risk is the risk that a borrower defaults. Liquidity risk is the risk that you don't have enough cash or cash-like assets on hand to meet short-term liquidity needs. But there are many types of risk that banks can face, and it's worth talking about one of them in some depth, which is called interest rate risk. For this, we'll talk a little bit about Silicon Valley Bank as a case study. So brief context, Silicon Valley Bank failed back in March of 2023. You might remember it. At the time, Silicon Valley Bank had around $200 billion in deposits. Notably, around 94% of them were uninsured. That's fairly important context because it's why a bank run happened. If Silicon Valley Bank had like 90% of its deposits being insured, no one would have run on Silicon Valley Bank for the most part because there wouldn't be concerns about deposits being lost. As it turns out, most of Silicon Valley Bank's clients were companies, and companies typically exceed the $250,000 FDIC deposit cap because they're putting tons of money into banks and they're not all going to be covered by FDIC insurance contracts. So Silicon Valley Bank, for context, invested very heavily in the early 2020s into long-term fixed income assets. Fixed income assets basically are assets that pay a fixed rate of interest, a fixed rate of return. And Silicon Valley Bank invested very heavily into a particular type of fixed income security called Treasury bonds. It's just bonds issued by the US government. The US government agrees to pay you a certain amount of money. Also coupons, basically semi-frequent, like monthly or biannually interest payments until maturity is reached. Why did Silicon Valley Bank, by the way, invest so heavily in these assets? There's lots of reasons. They're not really central to the case study. One of them, for example, is just that the rate of deposit inflows into Silicon Valley Bank increased dramatically, particularly as crypto took off. And so Silicon Valley Bank had lots of money sitting around in deposits that it didn't have loans that it could issue for just yet. So it parked lots of this money into long-term treasury bonds. Now, accounting rules around finance are typically uninteresting and unimportant, but they're important in one context, which is interest rate risk. So for context, there's two ways that you can value an asset. In other words, something that's going to pay you money. The first is what's called held to maturity. Held to maturity accounting says, look, you have a 20-year bond, you bought it at this price. Its value is basically that price. Now, is that objectively true? Well, there's an arguable sense in which it is. Like if the bond is worth $20 million, say, sure, its value is $20 million. Great, that's its value. Mark to market, though, says, look, that's not actually what the security is valued. Here's why. If you went to sell a 20-year treasury bond, in other words, a bond that's due for repayment in 20 years, if you went to sell it right now, it would not be selling at its face value. For example, if the bond promises repayment of $10 million in 20 years, no one's going to pay $10 million for a $10 million bond. Why? Or $10 million bond. Why not? Well, this is what's called the time value of money. The time value of money basically says money today is better than money in the future. Why? Because inflation eats the purchasing power of money over time. So you'd rather have $10 million today than $10 million in 20 years because $10 million today is going to buy you a lot more than $10 million down the road. So you're only going to pay a discounted price for that $10 million treasury bond today. In other words, you're going to pay less for it today than its face value. That's why its present value is different from its face value. The face value being, okay, this is what the bond's going to pay out to you at maturity. Its market value is, what would someone actually pay for this thing today? Like if you went around to a market and said, hey, everyone, I have a 20-year treasury bond. What are you guys willing to pay for it? That's its market value, its market price. Mark-to-market accounting says, look, if you're a bank, the actual value of a 20-year treasury bond on your balance sheet really isn't its face value or the price that you paid for it, what's technically called amortized cost in accounting speak. Really, the value of an asset is what you can get for it if you sold it today, right now. That's what market value means. And so mark-to-market says you as a bank should be constantly adjusting the value of the securities on your balance sheet based on their current market value. And if the value of something goes down, you should have to represent that on your balance sheet. So here, for example, is a graphical representation of Silicon Valley Bank's assets. And what you'll notice here is that it's held to maturity securities, which are considered long-term securities like 20, 30-year treasury bonds, which are for accounting reasons considered held to maturity securities. Those bonds really took off, you can see, after 2020. The Silicon Valley Bank really stocked up on things like long-term treasury bonds. Here's the problem. Long-term bonds are considered held to maturity for accounting purposes. So Silicon Valley's balance sheet, quarter after quarter, kept showing values of this is basically what we paid for these securities back a couple of years ago and doesn't reflect any changes in their market price. Now, a fair question you might ask is, but why would their market price change? Like, why would the amount of money that an investor is willing to spend for a 20-year treasury bond change over time? Well, the main reason is Changes in interest rates will change how much money investors are willing to spend to buy previously issued securities. Again, in this case, you can think of a fixed income security as just a form of debt or something that can be traded that promises to pay you money in the future, promises to pay you interest. That's what a security entails in this context. Now, here's the problem. When you buy a treasury bond, there's an interest rate on that bond, right? So I'm making up numbers here. Maybe it's something like 0.5%. That's basically the interest rate that's going to be paid on the bond. Higher interest rate means higher profit, higher yield, in other words. But imagine that 2 months from now, interest rates go up. Now, the US government starts issuing new bonds that pay a higher interest rate. So instead of them paying 0.5% interest rate, maybe they pay 0.75% interest rate. That means more profit. So naturally, people are going to prefer buying newly issued bonds to the bonds that you own, the bonds that were issued previously. Now, simple law of demand stuff, when demand goes down, price goes down. So what happens if you own bonds that were issued previously at lower interest rates and then interest rates go up, demand for the stuff that you own is naturally going to decrease. And that means that the market price of your bonds will decrease as well, because the newly issued bonds are naturally more attractive and naturally will attract greater levels of demand. By the way, when you read about bonds, you'll typically hear people talk about bond price and bond yield. It's a little bit complicated when you hear yield versus interest rate. Here's the technical distinction. Most bonds trade below face value. So if a bond promises to repay you $100 million, that's an exaggeration. Let's make it more reasonable. A bond promises to pay you $1,000. You might be able to buy the bond today for $980. And the logic is, I'll spend $980 today, and a couple months or years will go by, and then I'll be paid $1,000. And I'll make a profit of $1,000 minus $980. $20 is my profit. The idea is the difference between the face value of a bond and the price that it's actually trading for, that basically constitutes its yield, which is basically if you buy the bond at 980 and it is going to pay out $1,000, the price difference basically gives you a profit. And so the idea is lower bond prices mean higher yields, because the lower the bond price is, the greater the difference between the price you spend today and the amount of money the bond pays out at the end. So when you hear people talk about bond prices and bond yields being inversely related, that's what they mean. The other thing that you'll often hear as well is the relationship between yield and interest rates, which is a little bit tricky. When current interest rates go up, that makes previously issued bonds less valuable, which means that demand will go down, which means prices go down, which means yields go up. So in that sense, there's a different relationship between current interest rates and the yields on previously issued bonds. So that's the context on interest rates. This constitutes what's called interest rate risk. Interest rate risk means changes in interest rates affect the mark-to-market value of previously issued securities. That was a very technical statement, so I'll rephrase it. Interest rate risk basically means when interest rates change, it changes the price that you can sell existing stuff for. And if interest rates go in an unfavorable direction, it can make the stuff that you own less valuable today. For example, when interest rates go up, it can cause previously issued treasury bonds to decrease in value. So let's go back to Silicon Valley Bank. Silicon Valley Bank, you might remember, bought a lot of treasury bonds in 2020 and 2021. What happened to interest rates in that period? They were basically zero. Then, starting roughly around March of 2022, the Federal Reserve, the central bank in the United States, starts to raise interest rates. What happens to the value of a fixed income security when interest rates go up? The answer is its price goes down. So what happens to Silicon Valley Bank's balance sheet? Well, it has all of these long-term securities on its books, and interest rates are going up. So the value of those securities starts to plummet. And you can see this visually here. Those blue bars represent losses that are sort of not yet appearing due to accounting reasons. Again, Silicon Valley is not marking those losses to market. It's just showing the amortized cost of those securities on its balance sheet. But Silicon Valley Bank basically has a bunch of long-term fixed interest rate bonds that are bleeding in value because interest rates are going up, which means newly issued Treasury bonds are more attractive, which means that investors would prefer to buy new bonds as opposed to Silicon Valley Bank's old bonds, which means that the price of those bonds is going down, which means the market value of Silicon Valley Bank's long-term securities is decreasing, and that's creating these quote unquote unrealized losses. The reason, and just to finish the story before I implicate this more broadly, Silicon Valley Bank ends up failing in March of 2023. The context is Silicon Valley Bank ended up suffering such huge losses on those fixed income securities that it had to announce that it was raising capital. Investors, specifically depositors, realized how bad things were at Silicon Valley Bank. They ran on the bank. Silicon Valley Bank was dead in a matter of days. That panic spread a bit as well. First National had troubles as well. Credit Suisse had issues as well. It ended up being absorbed into UBS. Credit Suisse's problems were different. You can read, if you want a kind of mini assignment to test your finance knowledge, you can read about AT1 bonds and their role in the Credit Suisse meltdown. But that's a slightly unrelated issue that only has some connections to the March 2023 banking issues specific to Silicon Valley Bank. The reason I bring up Silicon Valley Bank, though, is to point out that a common narrative in debate about risk is often wrong. You'll often hear people say banks fail because they're so risky and they invest in these crazy complicated products like mortgage-backed securities. Now, there is some truth to that. Lots of banks that fail do fail because they take on too much risk, et cetera. Totally fair, totally reasonable. At the same time, Silicon Valley Bank failed because it invested in the simplest instrument ever constructed. It invested in the Treasury market. And the thing that caused Silicon Valley Bank to fail wasn't some complicated, highly risky bet. Silicon Valley Bank did the opposite of making a highly risky bet. Silicon Valley Bank invested in the least risky asset known to man. It invested in Treasury bonds. Why did Silicon Valley Bank fail? It failed because it didn't implement very simple measures to hedge against risk. We'll talk about that in a bit. But this is just to emphasize that bank failure is distinct from banks being crazy risky. Banks can fail even when they're not deliberately investing in the most complicated high-risk products out there. They can often do fail as a simple consequence of poor risk management. By the way, if you just think I'm cherry picking examples, like, well, Silicon Valley Bank, maybe an outlier. This exact issue, rising interest rates causing unrealized losses on long-term fixed income securities, it's happened repeatedly. Back in the 1980s, there was what was called the saving and loans crisis. Saving and loans are basically thrifts. They're institutions that accept kind of deposits and then use that to fund particularly mortgages, specifically relating to housing and small businesses. Saving and loans institutions faced the same exact problem. It was made a bit worse by a series of regulations that had some real restrictions on what saving and loans institutions were allowed to do with respect to paying interest on deposits. But the important thing to understand about the S&L crisis of the 1980s is interest rates went up dramatically under Paul Volcker, the Federal Reserve chairman, in the late 70s, and throughout early mid 80s. And as interest rates went up, guess what happened to saving and loans institutions? Well, it turns out that all of these S&Ls had huge amounts of fixed income securities on their balance sheets. And although some of the crisis was caused by external factors like poor risk management and tons of risky investments, lots of S&Ls failed because of a similar underlying problem of interest rate risk, particularly in the early 80s. And so there was a huge wave of banking failures in the mid and late 1980s that was causally related to interest rate risk. And this even happened again in what was called the Great Bond Massacre of 1994. The Federal Reserve unexpectedly raised interest rates, and it caused a huge catastrophe in the fixed income securities market, the bond market, in other words, because all of these long-term fixed income securities suddenly were worth quite a lot less. By the way, you can also turn this into actual arguments and debate. So, for example, the Round 8 motion back from Vietnam Worlds in 2024 was about whether central banks should raise interest rates during periods of economic growth. You can make an argument about interest rate risk on this and say commercial banks will suffer huge losses as a consequence of this strategy, just like Silicon Valley Bank did in March 2023, just like the saving and loans institutions and thrifts did in the 1980s, just like what happened in 1994 with the Great Bond Massacre. And what happens is hiking interest rates reduces the present market value of fixed income securities in a way that causes banks to suffer huge write-downs on their balance sheet. That means that banks have to raise capital by selling assets. That causes asset prices to go down, and it creates a sort of spiral in which banks bleed money on their balance sheets. So all of this should hopefully convince you that risk is a little bit more complicated than just banks giving loans to people who are maybe shoddy borrowers. Risk entails a set of different risks like liquidity risk, credit risk, interest rate risk. There's even other ones that we'll talk about later. But it also emphasizes that risk taking is not inherently bad. In fact, we want banks to take risk. A risk-free banking system would be terrible because only the most safe borrowers on the planet would get loans. Part of the financial system is making healthy risks, like investing in startups that have promising ideas that could potentially save lives, improve medicine, reduce emissions, etc., but are unproven and need capital. That's a risky bet, but we want the financial system to be capable of making those bets. So risk is not inherently bad as long as it's managed properly. And in particular, there's three things that you want when it comes to risk management: diversification, accurate pricing, or what's called price discovery, and hedging to at least some extent. So diversification is something you've probably heard of before. The simple way of thinking about it is don't put all your eggs in one basket. The more complicated way of saying it relates to what's called Markowitz's optimal portfolio theory. The concept here, or modern portfolio theory, I think is its technical name. Basically, Markowitz was an economist back in the 20th century, did a lot of cool financial proofs, and basically the outcome of it is pretty intuitive, which is the best way to build a portfolio is just a collection of different investments, is to make sure that the risk correlation between the assets in your portfolio is limited. The idea is you don't want to be investing into a bunch of things that would all fail if one thing happened that all of them had in common. We'll talk about this a bit later in the context of mortgage-backed securities, but one of the biggest problems that caused the 2008 financial crisis is that banks assumed that the US housing sector was not going to fail because the securitized products that they were buying that were stuffed full of mortgages assumed that the mortgages were not correlated in their default tendencies. The idea, in other words, was, well, we're buying tens of thousands of mortgages all at once. What's the likelihood they all default? As it turns out, the likelihood was quite high because they all had a common characteristic in many of these mortgage-backed securities, which is they were subprime mortgages. They were shitty loans to borrowers that couldn't repay. And as a consequence, there actually was a real risk that as the economy went into a downward spiral and borrowers couldn't refinance, as it turns out, actually, yeah, there was a pretty high correlation of risk, which caused those mortgage-backed securities to lose value and to default. But the broader takeaway for diversification is it's a bad idea to invest into just one region or just one type of asset or just one industry, because that creates idiosyncratic risk that is specific to a particular type of company, a particular industry, a particular sector. And if you invest in many different types of assets, many different regions, that reduces the risk that you lose all of your money because poor performance in one area is probably offset by better performance in some other region. By the way, you can turn this into debate arguments. One example of this would be an argument in favor of banking consolidation that says larger banks are less risky because they can better diversify. For example, they can invest in more countries, or they can use greater numbers of financial instruments, or they're less sectorally concentrated, so they can invest in the manufacturing sector in Germany, and the winemaking sector in France, and the tourism sector in Italy, just to pick some stereotypical examples. And in that sense, you can sort of diversify away. The other reason, by the way, diversification is a useful argument to keep in mind is a common way that people will make arguments in debate about finance is they'll impact their arguments to, and this causes this type of company to lose money. And that's bad because it will cause regular people to suffer because, their pensions are invested in that industry, or because they've invested into that sector. So here's an example. Maybe you make an argument that says it would be bad for us to reduce the profitability of the oil sector because lots of pension funds are invested into oil. And so if pension funds lose money, then regular middle-class people lose money, right? Because pension funds are what people use to finance their retirements, and it's going to be bad if people don't have money in their pension funds. Of course, there's a problem with that argument, and the problem is not that it's wrong. Yeah, it's true, pension funds have invested in oil. The problem is most major institutional investment funds, like pension funds, are very well diversified, or at least the pension funds that are managing middle-class people's money, those funds are very much diversified. So yeah, the reduction in profitability of oil companies will in fact hurt the profitability or returns on pension funds. But at the same time, those pension funds are extremely diversified. And yeah, they're invested in oil, but they're also invested in dozens of other industries and dozens of other specialties and geographic regions and asset classes. And so a reduction in one particular profit pathway for the pension fund doesn't mean that regular middle class people are going to be losing thousands of dollars in their pensions. The second thing to understand about risk relates to this thing called price discovery. Price discovery is basically the idea that the best way to figure out what something is worth is for lots of people to bet on it. The idea is, well, what is a company worth? Just let investors figure it out. The market will naturally equilibrialize as supply and demand come to a natural equilibrium. And so the idea is you want markets to accurately price risk. So here's a simple example. If a bank issues a loan, you want the interest rate on that loan to reflect the riskiness of the underlying investment. For example, if a bank gives a really risky loan at a very low interest rate, that's a terrible outcome. Why? Well, because the bank has made a very risky loan, but it hasn't priced the risk appropriately. In other words, the loan has a high probability of not being repaid. So the loan only makes economic sense from an expected value point of view if the interest rate on the loan is high. That's the only way that this can be a profitable bet, because that's sort of how the expected value calculus works, right? If the investment doesn't default, then the payout is high. And if the investment fails, then you get nothing in return. So the interest rate needs to be high for a risky bet to be worth it. What you therefore don't want is a very risky investment to be priced, for example, with its interest rate as being a low risk investment. And so what you want in financial markets is efficiency. The purpose of an efficient financial market is a financial market that engages in price discovery, in the sense that the riskiness of assets is accurately priced in. The price reflects the risk of the asset. So a good example of this is what happened in 2008. Why did so many banks and so many investment funds invest billions of dollars into subprime mortgage-backed securities? Well, they thought that they weren't risky. They thought that these were great investments, that they were very unlikely to default. Credit rating agencies gave them very high approval ratings. They said these are AAA bonds. They have a low probability of default. By the way, credit rating agencies, there are three major ones: Moody, S&P, and Fitch. Those three credit rating agencies collectively control something like 85 to 90% of the rating business. The way that rating agencies work is they basically review companies and investments and debt securities, and they basically issue credit ratings. Like, look, here's roughly how risky we think that this company or this investment is. And you can categorize investments as either investment grade or non-investment grade. One of the major implications, by the way, of rating agencies that matters for banks is that rating agencies play a pretty important role in the risk weighting of a bank's assets, because banks have regulations about the degree to which they have to invest in only investment grade securities and can't invest in other types of securities. And that's part of the reason why rating agencies play a rather major role in banking regulation. In any case, what happened in 2008 was not just that the banking system was flooded with all of these risky subprime mortgages and subprime mortgage bonds. The problem is that the prices of those bonds didn't accurately reflect their risk. These bonds were trading at prices that suggested that they were very safe investments, whereby the yields on these things were far too low relative to their actual risk. Subprime mortgage-backed securities are not inherently bad as long as the prices, the yields, for example, the returns on those investments are sufficiently high to signal to markets, this is a risky bet. Only invest in these subprime mortgage-backed securities if you're willing to take the risk. What instead happened is markets didn't price risk in sufficiently to those mortgage bonds, which meant that tons of pension funds, commercial banks, etc., ended up massively overindulging in mortgage-backed securities that they thought were safe, but were in fact very, very risky. By the way, brief side tangent on the efficient market hypothesis and its sort of bearings on price discovery. Back in 2013, the Nobel Prize in Economics was awarded jointly to three separate economists. And what's very funny about this is two of these economists are some of the most famous, well, all three of them are, of course, famous. Hansen as well. But for a moment, I'll just focus on Fama and Schiller. So these two figures jointly won the Nobel Peace Prize. This is kind of funny because the two theories that these figures represent are polar opposites in very many ways. They're not actual polar opposites, but you can sort of think of them as being competing theories of financial markets. Robert Shiller, he's a Yale economist, great writer. He has some public lectures as well. I highly recommend Irrational Exuberance. It's a good read. Shiller is most famous for what's called behavioral finance and behavioral economics. He didn't invent the discipline. There are plenty of other people before him who talked about behavioral finance. But the core argument that Shiller makes in Irrational Exuberance is that markets are often inefficient with respect to price discovery. This is a fancy way of saying that the factors that determine which assets get bought and sold is not a purely efficient and information aggregating homo economicus system where investors only buy and sell strictly on the basis of this company is overvalued, that company is undervalued, this is a good investment, this is a bad investment. In fact, markets often are inefficient because psychological and cognitive biases affect investor behavior. So, for example, if you wanted to make an argument that the current investment into artificial intelligence is a bubble, you would basically be making an argument about irrational exuberance. You'd say markets are demonstrating herding behavior, whereby lots of investors are following what other investors are doing. Lots of investors are irrationally overconfident in the returns on AI companies. And as a consequence, markets are overvaluing these companies relative to their fundamental value, creating a bubble. That's the core argument that a behavioral financial economist would make. Behavior and cognition affects investment decisions in a way that's not strictly rational or strictly homo economicus. By contrast, Eugene Fama and the sort of EMHers, the efficient market hypothesists, they have a different view, which is markets are for the most part efficient. This is not to say that markets are always efficient. Temporary deviations are expected. But the idea is basically the price of an asset reflects all information available at any given moment in time. There are stronger and weaker variants of the efficient market hypothesis, particularly with respect to the role that inside traders play, like people that have inside information about a company's value, for example. But the core argument that's made by efficient market hypothesis is there are strong incentives in markets for people to trade on information. If you have information to believe that some particular stock is overvalued, you'll short it. Shorting a stock, by the way, is just a fancy way of saying bet against. It's a way where you borrow the stock, you sell it, and then you buy back the stock at a lower price. And so the price fall allows you to pocket a profit. So the efficient market hypothesis would say, actually, for the most part, asset prices are largely accurate. And to that extent, perhaps letting markets roam freely without extensive government regulation is the best way to allocate capital. This actually does have some implications for debate. So, for example, suppose you're debating the motion, this house supports the rise in retail investing. Common argument you'll hear in favor of retail investing in debate would be something like, well, we think that people are capable of making good, well-informed, knowledgeable decisions, so it's good that people are taking more ownership of their own finances and investing on their own accord. By the way, we'll talk about retail investors in greater depth later. A fair response on op would be, actually, that's a lie, and that's largely true. Lots of retail investors don't make good bets, and on average, retail investors underperform markets. But you can make a simpler argument, which is it doesn't matter whether individual retail traders are really smart and really well informed. We're just going to make the bold claim that markets are efficient and you're never going to beat the market as a retail investor. And frankly, if you're not beating the market, you are implicitly losing out on money. You're just better off putting your money into your pension fund or just, putting your money once into an index fund. And yeah, some retail investors invest in index funds, but it doesn't make sense to be shifting around and investing in lots of different index funds. Just invest in the S&P 500, sit back and let your money grow. Retail investors might have all the information and knowledge and incentives in the world. It doesn't matter because, we can sort of structurally demonstrate reasons why the wisdom of crowds means that even the smartest retail investor, heck, the smartest hedge fund out there isn't going to beat the market. It's just not something that people can consistently do. To be clear, the efficient market hypothesis does not say it is impossible to beat the market. It's just saying that there's no reliable way to consistently beat the market. Wisdom of the crowds means that information is rapidly priced into stock prices, asset prices, debt prices, etc., and stock behaviors behave sort of like a random walk, so to speak, to invoke the sort of calculus conceptualization of asset prices. So just to review, Risk is not inherently good or inherently bad. We just want risk to be diversified. We want risk to be priced accurately. And the final thing when it comes specifically to banks is that we want risk to be hedged. So just to be clear, every financial product that's ever been invented ever, even the safest ones imaginable, have some sort of risk. So for example, Treasury bonds are basically considered risk-free assets. Their probability of default is considered zero because the United States government is considered an ironclad creditor, in large part because it does control its own currency, and for that reason is considered a very safe borrower with a basically zero probability of default. But it still is not an entirely risk-free asset in a different sense, which is Treasury bonds are vulnerable to interest rate risk. So you can never eliminate risk from investing, ever. Even the safest investments out there have some type of risk, like interest rate risk. By the way, your reaction to this might be like, well, couldn't we solve interest rate risk by just making Treasury bonds adjustable rate? Well, then that increases other types of risk. So, for example, adjustable rate bonds increase default or credit risk because when interest rates hike or go up, that in turn increases the probability of default. So you can never eliminate risk from investment. You can just diversify, you can price risk, and the last thing that you can do is you can hedge risk. So what is hedging? Hedging is the idea that you can basically make competing bets that limit the potential losses, and they also limit the potential gains, but they can potentially limit the losses that you suffer as markets change or evolve. And derivative contracts are probably the straightforwardest way to think about hedging. So what is a derivative? I'm just going to quickly flag as a meta comment. It is not a good use of your time when learning about debate or learning about finance to understand the mechanics of all of like the individual specific details of like how options trades work, etc. It's not because it's not important for markets. It's just that you'll basically never have to actually explain in extreme detail how these contracts work. Like, oh, here's what a call style or put option entails, or an American versus European derivative. That level of detail is very unlikely to show up in debate. What is important is you understand what derivatives are. So derivatives are financial contracts, and what they basically do is they represent or they reference some underlying asset or some underlying index. So what a derivative does is allow for risk to be transferred. So in other words, you can swap different types of risk between parties. That's a little bit abstract, so here are some tangible examples. Imagine you're a farmer. Let's say you're a carrot farmer, for example, and suppose it's the beginning of carrot planting season, whatever that happens to be. Admittedly, I'm not so sure. Haven't filed that one yet. So you're a carrot farmer, and what you are worried about is what happens if the price of carrots falls between now, when I'm planting, and a few weeks or months from now when I harvest my carrots. That's price risk, the risk that the price of the good that I'm selling decreases. And that would, of course, cause me to suffer a loss. I've already had to spend money buying the seeds, getting the farm set up, buying the tractor, yada, yada, yada. And so if the price falls, I might potentially have to go bankrupt because I'm not going to have enough money to cover my costs. So that's price risk. If you're a farmer, you might hedge against price risk. And the way that you'll hedge against price risk is what's called a futures contract. A futures contract is basically a very particular type of derivative contract that says, I'm going to agree with someone now in advance to sell carrots to them at a specified date in the future at a specified price. So, for example, maybe I'll agree to sell them all my carrots at a price of, I don't know, $1 per carrot in 6 months' time. Now, this eliminates price risk for me in some sense, which is just to say, imagine in 6 months, imagine if carrots are actually selling at half a dollar per carrot. Well, in this case, the futures contract worked out great for me because I've locked in this dollar per carrot price. So I'm not affected by the fact that carrot prices have actually fallen. Of course, there is a corresponding downside to this contract. Imagine that it turns out carrots are actually worth $1.50 per carrot in 6 months' time. Well, in this case, I've kind of been hurt by the commodity futures contract because I've locked myself into selling at a price of $1. But what I've done is I've eliminated price risk. I've eliminated, or to put it in slightly more technical terms, hedged against the risk that a price decline will cause me to lose revenue. That's the logic behind, for example, a futures contract. We talked previously about a different type of derivative called a credit default swap. That's where you can bet on whether or not a company is going to go bankrupt, more specifically, whether it'll default on its debts. That's why it's called credit default. Why is it called a swap? Well, it basically allows you to swap your position on risk. So here's an example. Imagine that you buy a company's bonds. You are now exposed to credit risk. If the company doesn't repay, you're going to lose money. So you could enter into a credit default swap. You could go to an investor and say, hey, look, I am going to pay you monthly premiums. And if this company defaults and doesn't repay its bond to me, you are going to pay me what I'm owed. In this way, I am no longer exposed to credit risk. If the company defaults and doesn't repay the bond, I'm covered. Of course, there's also a corresponding downside to the default swap, which is I now have to pay this guy monthly premiums because I've entered into a credit default swap with this counterparty, as it's called in derivatives transactions. So there's a transfer of risk. I used to be exposed to credit risk. Now I've transferred that risk to someone else, but in doing so, I've paid for that. I had to pay a premium. So the logic of derivatives is that they are mechanisms, they're financial contracts that enable risk to be bought and sold. That's what a derivative contract is fundamentally. Are derivatives good? That's a useless question. The better question to ask is, when are derivatives good? Derivatives are good because they can allow for hedging. You can use a derivative to hedge against your risk. So, for example, think for a moment, we'll do this with a worked example in a moment, but think about Silicon Valley Bank. What was the risk that Silicon Valley Bank faced? SVB's big risk was interest rates go up. So Silicon Valley Bank could hedge by using derivative contracts to profit if interest rates went up. Why would that constitute a hedge? Because if interest rates go up, this hedging strategy using derivatives will be profitable, and that will limit the losses that Silicon Valley Bank takes on its fixed income securities that lose value as interest rates go up. So the concept of hedging is you can use derivatives to reduce your risk by taking offsetting positions. By the way, though, derivatives can also be used for speculation. For example, you can buy a credit default swap as a way to speculate on the probability that the company is going to go under. And so in that sense, derivatives aren't risky or risk reducing. It depends on how they're used. You can use derivatives to hedge. You can use derivatives to speculate. Here's an example of an actual application of derivatives and why they matter, because it's a little easy to get lost in the abstract sort of complex jargon around like interest rate swaps. So here's an example of where this is relevant. Imagine for a moment that you're a Silicon Valley bank, except this time you have competent risk managers circa January of 2022, and you're realizing, shucks, we're vulnerable to interest rate risk. And just to be clear, most banks realize this. Silicon Valley Bank just happened to have incompetent risk managers and incompetent and negligent executives that didn't realize this. But if the Silicon Valley Bank interest rate risk argument was universal, then all banks would have theoretically failed when interest rates were aggressively hiked under Jerome Powell circa March 2022 through early 2023. But they didn't. Why was it contained to Silicon Valley Bank and just a handful of other banks like First National? Well, most banks hedge against the risk of interest rate hikes. How do they do it? Well, they have lots of ways to do it, but one of them would be using swaps. So here's an example of how Silicon Valley could have used swaps to hedge against interest rate risk. Silicon Valley Bank, circa the time of its default and kind of the build up to its default, had something like $210 billion in assets. Just for easy sake, we'll just say it's $200 billion. And something like 50% of those assets were fixed rate long-term securities like Treasury bonds, agency, that's a typo, it's meant to say agency mortgage-backed securities, which are a very particular type of mortgage-backed securities that are have mortgages guaranteed by Fannie Mae, Freddie Mac, or Ginnie Mae in the United States. That will come later. In any case, what we'll sort of say here is that Silicon Valley Bank is going to use an interest rate swap to hedge against the risk that interest rate hikes will cause 50% of its assets to lose value. So again, big picture, Silicon Valley Bank is using an interest rate swap to hedge against the risk that interest rates go up. So what we want to do is to build a strategy that will make Silicon Valley Bank make money if interest rates go up. Why? Well, if interest rates go up, Silicon Valley's assets will lose value, as we saw earlier. So in order to hedge, we need to build an investment strategy that sees SVB gain money in the event that interest rates go up to offset those losses. Here's how you could do it through an interest rate swap. The way an interest rate swap works is one side of the contract agrees to pay a fixed rate of interest. The other side agrees to pay a floating rate of interest. Floating just means it changes based on market conditions. The way this typically works in the context of swaps is you'll pay a bit above SOFR. So for context, there used to be this thing called LIBOR, the London Interbank Offering Rate, I think is the official acronym. It's LIBOR if you want to look it up. LIBOR, SOFR, these are basically just benchmark interest rates that represent current interest rates that are being set in markets. The exact details aren't super important. LIBOR was phased out because of a sort of corruption scandal around interest rate rigging, but it's not particularly important in this context. So here's how the rate swap is going to work. Silicon Valley Bank needs to gain money if interest rates go up. So Silicon Valley Bank is going to pay money at a fixed interest rate, and it's going to receive money at a floating interest rate. What that means is, as interest rates go up, Silicon Valley Bank is going to keep paying the same old interest rate. But as interest rates go up, the counterparty, in this case, just hypothetically, we'll say it's Deutsche Bank, a German bank. Deutsche Bank is going to be paying a floating rate. So as interest rates go up, Deutsche is going to pay more money to SVB. And by the way, if interest rates went down, then Silicon Valley Bank would still pay the same fixed rate, probably 2% roughly, but Deutsche Bank would pay a lower interest rate because it's floating. So here's how this would work in practice. Based on the actual interest rates at the time, these numbers are roughly accurate. They might be off by a small margin, but I try to be reasonably accurate. Suppose it's January 2022. At this point in time, interest rates are basically zero. So Deutsche is going to pay Silicon Valley Bank something like 0 plus 0.5%. That plus 4.5% is just so that you're paying slightly above whatever the current interest rate is. It's a typical component of swaps. So Silicon Valley Bank in this case is going to receive a payment of something like $500 million. But Silicon Valley Bank is going to pay money to Deutsche Bank at a fixed interest rate like 2%. So Silicon Valley Bank in this month is going to lose some money. By the way, this is a little bit of an unrealistic example. In reality, this wouldn't be the full value of the contract being evaluated by the interest rate every half year, but for sake of the example, we're going with it. 6 months later, it's June. This time, interest rates have gone up. So interest rates are now about 1.5%. Here's what happens. Remember, Silicon Valley Bank does not like that interest rates have gone up. Why? Because its treasury bonds have lost value by this point. But the swap helps to protect Silicon Valley Bank. Why? Because as interest rates go up, Deutsche Bank is paying a variable interest rate to Silicon Valley Bank. So the increase in interest rates means that Silicon Valley Bank is now going to receive $2 billion in payments from Deutsche. And that means that Silicon Valley is now hedging, basically, because as the interest rate goes up, the payment that Silicon Valley Bank receives from its interest rate swap counterparty also goes up. And by January 2023, the situation is even better for Silicon Valley Bank because, sure, its fixed rate or fixed income security portfolio is losing money in a mark-to-market sense, but its interest payments from the interest rate swap is going up. Now it's receiving $2.8 billion more than it's paying in this interest rate swap example. This constitutes hedging. SVB is making money on the swaps and losing money on the bonds, but those two effects mitigate each other, which means that Silicon Valley Bank no longer goes bankrupt in this sort of hypothetical. By the way, you can actually deploy this in motions that aren't directly about the banking system. So an example of this is derivatives matter a lot to agriculture. They play a very major role in stabilizing food prices because farmers use futures contracts and forward contracts to lock in prices between planting and harvesting. So an example of this would be if you're debating about the merits of agricultural companies, this is an old WSDC motion, you might make arguments about the ability of ag companies to use sort of sophisticated agricultural commodity derivatives to hedge against price risk and why farmers cooperatives might be less able to do that. I haven't made the argument in full here, of course. This is just a potential way that you might approach this motion on prop. It shouldn't say op. This is a wrong side. Oops. Oh well. So that so far is the case for derivatives. They do lots of good things. They allow for hedging of risk, transfer of risk, all that good stuff. That being said, there are obvious downsides to derivatives. Warren Buffett famously called derivatives financial weapons of mass destruction. And part of the reason for this is that they did play a fairly major and fairly pronounced role in the 2008 financial crisis, particularly credit default swaps. For example, AIG was a very large insurance provider, still around today, was bailed out in 2008, that went bankrupt almost exclusively because of its involvement in credit default swaps on mortgage-backed securities and collateralized debt obligations. So why are derivatives potentially risky? So the first reason that derivatives increase risk is that they are by default leveraged. So for context, the word leverage, you can basically in your head think of leverage meaning debt. Leverage basically means investing through borrowed money. Now, leverage is not inherently bad, but it's risky. So think about it like this. Imagine that you have $10 and you invest $10. What is the worst outcome? Well, the worst outcome is like you invest $10 and you lose $10. Aw, shucks, you're out of $10. Very sad. Imagine that you have $10 and you borrow another $10. So now you've got $20, but only 10 of it's actually your money. The other 10 is borrowed money. And now imagine that you invest that $20. What's the worst outcome here? Well, the worst outcome is you lose all $20, but it's actually much worse because you haven't lost $20 of your money. You've lost $10 of your money and $10 of borrowed money, but you owe that $10 of borrowed money. So in the first scenario, you invested just 10 of your own dollars. Yeah, it sucks you lost $10, but the loss is contained to you. If you invest borrowed money, the loss is no longer contained. You have what's called contagion. Your loss spreads to whoever lent you the money, because not only have you lost your money, the person that you borrowed from has also lost money. So that's the concept of leverage. Why do you use leverage? You use leverage because it amplifies returns. So for example, if you invest $10 and the investment doubles, okay, great. You invested $10 and you got $20 back. Great news. If you invested $20 by adding $10 of borrowed money into the picture, you're now going to get $40 back. So you're making a $20 profit as opposed to just a $10 profit. So leverage maximizes gains. It amplifies gains. That's the logic. You can use borrowed money to lever up, so to speak, to turn small gains into huge gains. For example, LTCM, the firm, the hedge fund that failed back in 1998, they were famous for using, and hedge funds generally are famous for using leverage, but long-term capital management was particularly famous for it because lots of the strategies that long-term capital management was famous for were strategies that relied on investing in very, very low yield or low return investments. For example, not Silicon Valley Bank, mixing up my examples, LTCM would make investments that the return on each individual trade was like a penny, but LTCM would borrow hundreds of millions, even billions of dollars to finance these investments. And so even if each individual trade only brought in a penny, if you do a billion of the trades through borrowed money, that brings in a lot of money over time. So that's why leverage is potentially good, which is it potentially maximizes gains. The, of course, downside with leverage is if you're using borrowed money to make investments, the losses aren't contained to you. So leverage is a double-edged sword. It amplifies gains, but it also magnifies losses. So why does that relate to derivatives? Well, derivatives are by sorry about that. Screen sharing temporarily cut out. Anyways, the relation between leverage and derivatives is that derivatives by nature are leveraged, which is just to say that you only need to put up a very small amount of money to enter into a derivatives contract. It might be a fee, for example, that relates to the procurement of the derivatives contract or some money that's involved in the derivatives counterparty or clearinghouse. But derivatives allow you to gain huge exposure with very little upfront capital. So here's just a kind of illustration of this. Suppose you want to invest in NVIDIA, the big chip designer. There's two ways you could do so. One is you could just go on the stock market and buy 100 shares of NVIDIA. But NVIDIA is a huge company. Its stock price is massive. You're going to be spending thousands of dollars to buy 100 shares of NVIDIA. Now, if the price of an NVIDIA share goes up, great, you're going to make a profit. But you're going to have a lot of money up front to make that investment. By contrast, what happens when you use derivatives? Well, you could use what's called an options contract to bet on the price of NVIDIA stock. But when you use an options contract, you no longer need to be spending hundreds of dollars per contract to enter into the contract. You're basically just making a bet with someone, and after the bet's maturity date has been reached, then you pay out. That's more or less how it works. So the risk with derivatives is not that derivatives are inherently risky. The risk is that derivatives are fundamentally leveraged. The consequence is that derivatives can cause huge losses where you otherwise wouldn't expect a financial institution to take huge losses. For example, if a bank issues $100 billion in loans, you know the potential size of the losses. It's $100 billion. If a bank has huge derivatives exposure, it doesn't show up as an initial amount of money that's being put in. So banks can take, hedge funds in particular, can have huge, like literally billions, even trillions of dollars of exposure via derivatives that doesn't cost almost any money up front. So derivatives make it very, very easy to have hugely risky investments. Not because derivatives are inherently risky, but because derivatives enable leveraged investing on a huge scale. The second implication of derivatives vis-a-vis risk relates to model risk. I'll talk about this more in the context of securitized finance and shadow banking later, but one of the biggest problems with derivatives is their value is tied to an underlying asset. So, for example, if you think back to the interest rate swap example with Silicon Valley Bank, what is the value of that contract? Well, it relates not to some fundamental value of a company per se, it relates to the value of interest rates. So derivatives themselves are priced according to the value of some underlying asset. But the problem is that the more complicated a derivatives contract becomes, for example, as it starts to involve more and more and more underlying assets, like multiple mortgages, for example, being referenced by one credit default swap, it becomes harder and harder and harder to accurately figure out the probability of default or the likelihood of gain. And so it becomes harder and harder to price derivatives accurately. So to some extent, there's a bit of an irony here. One of the purposes of financial derivatives is to enable the hedging of risk. But one of the other issues that is involved in risk management is price discovery, determining the correct price of a financial product that reflects its risk and potential gain. Derivatives, particularly what are called exotic derivatives, things like credit default swaps, for example, or bespoke derivatives that trade over the counter, in other words, not on a centrally cleared exchange, those derivatives are naturally more vulnerable to what's called model risk. When you use complicated computer algorithms and financial models to determine the value of these things, you're more likely to have risk because what if the model's parameters or assumptions are wrong? Long-term capital management is probably the most famous example of this. LTCM failed in large part because of the size of its derivatives portfolios. And what happened for LTCM, it was run by literally the smartest people on Wall Street. It had something like 3 to 5 different Nobel economics prize winners working on its staff. It had the best bond traders on Wall Street working on its desk. LTCM failed. And why did LTCM fail? Well, its models made inaccurate assumptions. Particularly, they made inaccurate assumptions about the tail risk of things like, for example, the Russian financial crisis. And so when the model assumptions about volatility were wrong, it turns out that LTCM's bets, they had an arbitrage strategy, as it's called. Arbitrage is a financial strategy where you identify two prices that should be the same but are different, and you sort of bet on those prices in a way that gives you a near risk-free or actually risk-free return. And so LTCM had models that were built by the smartest financial engineers on Wall Street, but even those models couldn't fully accurately price derivatives. The third and final concern with derivatives is counterparty risk. So a derivative is, just to be clear, a contract, and every contract has at least two parties. And in any contract, one party can fail. They can not do their part. And so the risk with a derivatives contract is one side might not uphold its terms of the deal. So, for example, if Deutsche Bank and SVB enter an interest rate swap, there is a risk that Deutsche Bank doesn't uphold its end of the swap. And that potentially means that Silicon Valley Bank now is left without its hedging in the form of variable rate payments via Deutsche Bank. Now, to be clear, this is less of a risk for some types of derivatives. So, for example, counterparty risk is less of a problem for the futures contracts we talked about earlier for carrot farmers, for example, because those are what are called exchange-traded derivatives. They trade on major exchanges, and there are these big clearing houses or central market makers that sort of ensure that these contracts are fulfilled. But the major risk with counterparty risk relates to what are called over-the-counter derivatives. Over-the-counter derivatives are things like swaps, for example, where there's no central exchange that's like producing these products on a standardized basis. So, for example, the stock market is an exchange in the sense that there's a standardized stock contract. You can go on right now onto Fidelity or Charles Schwab or Robinhood or whatever, and you can buy shares of companies because there's a standardized, central, publicly accessible exchange for the buying and selling of stocks. That is not true for OTC derivatives, which trade over the counter. They are custom arranged contracts between individual financial institutions. They're bespoke. Now, what's the problem with over-the-counter derivatives? Well, the natural problem with them is that because they're not traded on a central exchange and they're not cleared by a central body, clearing, by the way, is the sort of back end part of the financial market. Clearing houses, for example, are responsible for ensuring the delivery of payments, the warehousing and temporary ownership transfer of stocks, all of the sort of back-end work that's required for financial markets to hum and hem properly. Because there's no central clearinghouse for over-the-counter derivatives, they're less transparent and there's no public record of them. Now, there are some more novel regulations, like the swap execution facility, for example, that's run out of the United States, that have tried to increase transparency around OTC derivatives. But by and large, over-the-counter derivatives, especially for less regulated types of financial institutions like hedge funds, are still very much non-transparent and opaque. And so, for example, it's pretty difficult to determine the exact level of exposure that, for example, a particular hedge fund will have towards over-the-counter derivatives. Why is a lack of transparency a problem? Well, the main problem is in times of financial distress, it's very difficult to determine exactly how badly exposed everyone on Wall Street is. In other words, it's very difficult to tell, okay, we know that there's some problem in some market. Maybe it's the Treasury market or the housing market or the AI equity market, whatever it happens to be. If you don't know what derivatives different banks or funds own, you don't know how badly exposed they are. Is this fund going to suffer a huge loss? Is it going to lose tens of billions of dollars? Is it going to lose barely anything because they didn't invest that much? If you don't have clarity about exposure, it's very difficult to determine what banks are going to survive and what banks are going to fail. And that lack of transparency means fear. If you don't know who's going to fail, you naturally assume the worst. If you don't know, I don't know how bad JP Morgan's exposed. I don't know how bad Goldman's exposed. I don't know how bad Deutsche is exposed. I don't know how bad any major hedge fund or pension funds is exposed. You're not inclined to lend to them, and you're inclined to close out your existing transactions with them. And that causes credit markets to freeze, to basically stop lending in a way that causes a financial crisis. So many financial crises, it's worth remembering, are caused by a loss of confidence as much as by a loss of capital. And a loss of confidence is what triggers lenders to stop lending. In turn, that's what triggers financial crises to become large scale. By the way, you can sort of consider the role of derivatives in one specific case of government action, which is the Bear Stearns bailout. Bear Stearns was a major investment bank back in the United States that encountered major difficulties during the subprime mortgage crisis. Back in March 2008, Bear Stearns neared bankruptcy. It was ultimately bailed out in a somewhat odd deal. It involved $30 billion of government money in addition to an acquisition by JP Morgan, which agreed to purchase Bear Stearns and buy out the bank on the condition that the government provided capital, $30 billion worth, to facilitate the transaction. But if you read, so Tim Geithner, for context, was at the time president of the New York Federal Reserve Bank, which is sort of the most influential of the 12 Federal Reserve banks that is sort of overseen by the centrally managed Federal Reserve out of Washington. Tim Geithner at the time was running the FRBNY, the Federal Reserve Bank of New York, and the FRBNY was centrally involved in the Bear Stearns bailout negotiations. And Geithner later was asked by Congress, like, why did you do this? Why did you bail out this bank? And one of the large reasons for this is Bear Stearns had billions of dollars in derivatives contracts on its books. The problem is that most of Wall Street didn't know the exact scale or size of Bear's derivatives portfolio. Once Bear went under, all of these different banks on Wall Street that are counterparties to Bear's derivatives, they're going to lose money. These derivatives contracts are not going to be useless because Bear's not paying up. And so that's going to spread risk in a massive way. And would trigger, as Geithner put it in very clinical terms, quote, dislocation in markets. And that would cause these sort of huge runs on markets in a way that would be very devastating. By the way, Geithner's testimony here references this concept of margin requirements. The concept of margin is worth understanding when talking about derivatives. So here's basically the idea. Clearinghouses are these big financial institutions that help manage this buying and selling process. And clearinghouses, the way that they do this is they basically work as buyers and sellers. So for example, if you and I enter into like an interest rate swap, the clearinghouse will sort of stand in the middle to take payments and give payments to both of us, so that if one end of the deal fails, the other end doesn't lose out as well. So for example, if Deutsche fails, SVB still gets paid because the clearinghouse is there to maintain the transaction, or ideally to find a new counterparty to match Silicon Valley Bank with. Now, clearinghouses face counterparty risk, which is, well, gee gosh golly, what happens if one of these firms involved in the derivatives transactions goes bankrupt? And so the way that derivatives markets deal with counterparty risk is through margin requirements. The way margin requirements work basically is you're required to post collateral. Post here just means give. Collateral is just some asset that can be sold for money. And so the way that clearinghouses mitigate counterparty risk is they say, look, if you want to enter into a derivatives contract, that's great. We love it. But you're going to have to post margin. You're going to have to provide collateral. If you end up defaulting on this contract and you can't pay as you are obligated to, we will seize that collateral and we will sell it. So you're going to give us treasury bonds or cash or something that's very safe and very liquid. And in the event that you can't uphold your end of the bargain, we are going to take that collateral and we're going to sell it so that we can recoup the losses. Now, the reason why margin requirements matter is not because margin requirements individually are important. It relates specifically to what are called margin calls. There's an entire movie named after margin calls. The concept of a margin call is the value of derivatives contracts are marked to market at the end of each day. What marked to market means, again, just for clarity, referencing the SVB stuff, marked to market means the market value or price is reflected on the balance sheet at the end of each day. So for example, the relative gains or losses on a derivatives contract are marked on the value of the contract at the end of each day. Now, if your derivatives contract starts to post big losses and the losses keep getting bigger, you're going to have to start providing more and more collateral. That's what a margin call is. It's basically when you're in a derivatives contract, your contract is losing money. You've made a bad bet and you're losing money, and you have to basically post more and more collateral. Why? Well, it makes sense. If you're the clearinghouse and you're involved in these counterparty obligations, and you see that your counterparty has made a bet that's losing them a lot of money, you're going to start worrying, like, is this guy good for their money? What if this bank ends up failing in 2 weeks and doesn't have any, like the measly little collateral they gave me at the beginning is all I have to recoup the losses? No, they're going to hit you with a margin call. They're going to say, in order for you to keep in this transaction, you have to give more collateral now because I'm worried about the potential losses you're suffering. And I want to guarantee that I'll have enough collateral that I can cover these losses in the event that you fail. To be clear, if the counterparty never fails, they get the collateral back. The collateral is theirs to keep. Collateral is there in the event that you default and can't repay your debt obligations. So that's investment banking and the role of exchange-traded and over-the-counter derivatives and sort of the impact of margin calls. Margin calls, by the way, will show up again in a little bit when we talk about the Treasury basis trade and the role that hedge funds play in it. Briefly, it's worth mentioning investment banks. Interestingly, investment banks is a word that gets thrown around a lot in debate and is very, very popular in pop culture. I think Wolf of Wall Street, American Psycho, that sort of stuff. But investment banks are actually not that important in most debate rounds. So part of the reason for this is that the term investment bank is a bit of a misnomer in the sense that when you think of investment bank, what you probably think of in your mind is like a bank that invests money. As it turns out, that's not really what investment banks do. What investment banks are really centrally involved with is basically intermediating capital markets and large clients. So most of what investment banks are doing is not actually investing money for themselves. Most of what they're doing is doing things like advising on mergers and acquisitions, doing what's called underwriting of securities. For example, initial public offerings, that's the process by which a private company goes public. It issues shares of ownership to the public via stock markets. That typically involves an investment bank. And what the investment bank does is it underwrites the initial public offering. So it looks over the company. It says, hey, how safe are you of a company? How profitable are you as a company? What are your growth prospects? How good is the quality of your management, et cetera? And then the investment bank determines, okay, here's the stock price that you're going to list at. Here are the number of shares that you're going to issue. Here's the market that we can get you listed on, et cetera. Here's all of the legal proceedings that need to be involved. And so the investment bank will go through this underwriting process, but they themselves are not going to be the one, for example, that's like actually investing billions of dollars into, say, real estate trusts or bond markets. They're facilitating clients' demands and needs in capital markets, like helping companies merge or underwriting securities. And so for that reason, they typically don't show up nearly as much in debate, though, of course, they're important to understand in the role of facilitating the behavior of other actors. So, for example, a company that wants to go public is certainly going to need the assistance of an investment bank. The real important concept to understand with respect to investment is not investment banks, which are probably better called or better understood as securities firms. The better thing to understand are financial markets and capital markets. And so the very simple question that you should ask when thinking about capital markets is a very straightforward one, which is, companies, households, and governments need money. Now, most households, nearly all households, in fact, are going to get most of their money from banks. And there are, of course, other sources, think pay-as-you-go services. But for large ticket items, think houses, for example, you're going to get most of your lending done by banks or by bank-like companies, like mortgage lenders or finance companies. Finance companies, by the way, are typically the arms or the financial arms of large industrial firms. So, for example, if you're a car company, you'll typically have a financial wing of the car company that provides auto loans to people who want to buy a car. So there are other examples of non-bank lenders that regular households interact with. But when it comes to larger dollar borrowers like governments and companies, they've got lots of options in terms of where to get their money from. So it's worth kind of going through each of these in turn. I'll sort of talk about the four core fund markets in the form of money markets, bond markets, equity markets, as well as a series of NBFIs like private credit and private equity, and then also talk subsequently about the firms that are providing capital to these markets. So in other words, there are the firms that need capital that turn to capital markets. Those are companies, governments, et cetera, and also other institutions as well to some extent. So there might be cases where nonprofits, for example, or universities might need to borrow money. But for the most part, it's corporate and sovereign borrowers that dominate capital markets. And then there's the separate question of, okay, those are the companies that need to borrow money or need to get investment. Who's actually giving them the money, and where's the ultimate source of investment coming from in those contexts? So we'll dive into that next. So the first thing that is worth understanding is the distinction between debt and equity, and relatedly, the distinction between public and private capital markets. So debt and equity is a distinction you're probably somewhat familiar with. The concept of debt is you lend money and someone repays. And in the context of capital markets, that means companies or governments raise money by borrowing. So they basically agree to repay money that's given to them by some creditor. Creditor just being a financial institution that provides credit, or debt, in other words. Equity is distinct because equity involves the sale of ownership. So rather than promising to repay a specific amount of money within a specific amount of time at a particular interest rate, equity involves sale of ownership, and that entails voting rights. So, for example, if you sell ownership in a company, that means that you're selling a entitlement to future profits, and you're also selling partial control over corporate decisions, management decisions, the direction of the company, so on and so forth. So naturally, if you're a company, there are some upsides and downsides associated with equity. For example, if you're a company and you sell stock to the general public through an initial public offering or IPO, there is an upside, which is that you gain cash. And the other upside is you don't have to repay that cash. That's the benefit of equity. The downside is you are forfeiting ownership of your company in a way that can be potentially problematic. The other corresponding upside, though, is that forfeiting ownership can be good if it improves corporate governance. For example, lots of companies might benefit from going public because it means that major mutual funds or asset managers now play some role in your corporate governance in voting to determine who sits on your corporate board in a way that can improve institutional expertise because you now have powerful, experienced, knowledgeable financial institutions that have input over your management decisions, your choices vis-a-vis products, so on and so forth. So that's the debt equity distinction. It's worth noting along those lines that companies almost always find it cheaper to borrow through debt as opposed to equity. In other words, if you're a company and you need money, it's typically easier to raise money from a financing perspective or a cost perspective by acquiring debt as opposed to issuing equity. There's two reasons for this. One of them is an economic reason, and one of them is a legal reason. The economic reason is that debt has to be repaid. Equity is just an ownership stake in the company, which means that shareholders, or in other words, people that own equity in a company, are the first to absorb losses, whereas creditors, those that give you debt, are the first in line for repayment, which means that when a company fails, debt holders, in other words, creditors, receive priority treatment. So, simple example, a company fails, say it has $100 million left over, for example, from asset sales, that $100 million will first go to paying off the investors that lend money to the company, like a bank, and any leftover money then goes to shareholders. Because equity ownership is riskier by nature than debt ownership on a basis of how bankruptcy proceedings work, unless the debt has been specially arranged to be lesser in value than equity in the sort of hierarchy of liquidation, most equity shareholders will demand a premium, so to speak, in the sense that the return that you expect on an equity investment sort of has to be higher than the return that you expect on a debt-based investment. So a bank loan, for example, is theoretically less risky from the investor's point of view than an equity investment on the basis that, well, the debt is repaid first during bankruptcy. The legal reason why debt is typically cheaper than equity is slightly technical. The reason is that interest payments are tax deductible. I'll talk about that in a moment on the next slide. So before we chat about that, I'll just briefly summarize the public-private distinction and then move into the actual mechanics of these markets. The public-private distinction will probably become a bit clearer through examples. But the important distinction to understand between public and private capital markets relates to two things. A, who can invest, and B, the liquidity of markets. First, in terms of who can invest, a public market at first sounds like it's a government-run market. That's not true. A public market just means that general investors can invest into these particular assets, or more technically, there are relatively few limits on who's allowed to invest. So here's a simple example. The stock market is a public equity market. In other words, public equity means companies are selling ownership shares and they're doing so in a public market. Anyone that has a brokerage account can go and buy stocks in a company. You don't need to be a hedge fund. You don't need to have lots of money. You don't need to be an accredited investor. You can just go and buy stocks. A private market, by contrast, limits access. So a private market restricts the pool of investors that are allowed to invest. So, for example, public equity involves the sale of ownership stakes in a company through a stock market where anyone can invest, including retail, i.e. regular investors. A private equity market limits who is allowed to invest. So, for example, you might have what are called private equity transactions that we'll talk about in greater detail later, where a company privately transacts with a PE firm to sell ownership stakes in the company, but it's not like a random Joe Schmo can invest, for example, in that transaction, at least not directly. The other distinction relates to liquidity. Remember, liquidity just means how easy is it to turn some investment into cash without affecting its price. Public markets are generally more liquid. So, for example, if you own stock in a company, you can sell the stock, and that means that you can sell it to a different investor without suffering a major loss in price. Private markets, it's much harder to sell your shares. For example, a private equity fund can't easily sell its ownership stakes in companies without having to find a buyer, arrange the transaction, and so forth. So before we talk about the mechanics of these two markets, I'll just briefly discuss the dividend tax argument. There's a proposal that you'll periodically see in financial debates, not debate finance motions per se, but in public debates about the financial system as to whether dividend payments should be tax deductible. So just to be clear, there are two costs associated with debt and equity, respectively. When you take out debt, you have to pay interest. So if you take out a $1,000 loan and a 5% interest rate, you're going to spend, say it's a 1-year loan, $1,000 repaying the loan itself, and you're also going to spend an additional $50 on your interest payment. That interest payment is tax deductible. It reduces your taxable income, so to speak, in a way that makes your taxable income more favorable. It reduces your tax burden, so on and so forth. By contrast, dividend payments, that's when a company that's issued ownership shares agrees to pay profits to shareholders. For example, if you're a large company like Microsoft, at the end of the year, you're going to have a healthy profit, and dividend payments would involve Microsoft issuing those profits back to the people who own ownership stakes in Microsoft. Those are called dividend payments, and they are not tax deductible. The logic behind this is not particularly crazy. So the logic in theory is a interest payment is a business expense, whereas a dividend payment is something that happens post-profit. And so therefore, you can consider interest payments to be a expense that relates to business production. And for that reason, it's tax deductible, much like other business expenses are, whereas a dividend payment is not. The argument that you might make for why reducing this distortion is good, for example, by making dividend payments tax deductible, the benefit is that it would remove the current distortion. That distortion is debt is artificially, at least in theory, made slightly cheaper by the tax deductibility of interest payments, because if you borrow money, the interest payments are tax deductible. If you issue equity, dividend payments are not, which artificially tips the balance in favor of debt as opposed to equity. The argument you could then make is that reducing that imbalance is good because there are lots of risks associated with companies relying overly on debt. Of course, the response that you could give to this argument is the argument that I was just mentioning before, which is that debt already has a structural advantage over equity vis-a-vis the cost of financing, which is just that because dequity, dequity, that's not really a concept, because debt receives priority in bankruptcy proceedings, there's already a natural advantage for investors to invest in debt, which means that debt borrowing costs are naturally lower. And so the distortion between debt and equity from tax law is, if anything, restorative as opposed to distortionary. That being said, that's not particularly important. What is important for debate is understanding the mechanics of financial markets. So let's get into it. We'll start by talking about public equity markets. These are more commonly called stock markets. So an example of this would be the New York Stock Exchange, NASDAQ, etc. So what actually happens in public equity markets? Well, one of the biggest misconceptions about stock markets is that stock markets are directly where companies make money. And this seems intuitive. So for example, lots of people probably hold the intuition that when you buy a stock and you spend money to buy the stock, the money goes to the company. But that's actually not what happens. The reason why is that there are distinctions between primary and secondary markets. A primary market is where a good is first sold, and a secondary market is where it's subsequently traded by people who already have previously purchased that underlying good. So in the context of stock markets, the stock that's being bought and sold every day on the New York Stock Exchange or NASDAQ or what have you, that stock that was already issued years, even decades ago sometime, and it's just being bought and sold amongst investors in general markets. A primary market is where a company, using what's called an underwriter, that's what we talked about in the context of investment banks, that's where a company issues shares of ownership to an initial pool of investors. Those investors buy the ownership stake in the company, and then those investors are free to sell on the secondary market. A very crude analogy of this would, for example, be suppose you buy an iPhone, for instance, direct from Apple, like you buy it direct from Apple, the company. That would be a primary transaction. If you then sold the iPhone to one of your friends, that would be a secondary transaction, i.e. you purchased firsthand the original good on the primary market and then resold in the secondary market. Now, this might seem confusing because a fair question you might ask is, wait, so why even have secondary markets? What's the point of having the New York Stock Exchange if the benefits or proceeds of sales on the stock exchange don't actually go to the company? Well, the logic is that having a deep and liquid secondary market increases the number of investors that are willing to invest in the primary market. So think about it like this. Imagine that a company is going public. It issues an initial public offering. In other words, it sells shares at some pre-agreed upon price that's typically determined by the underwriter, which evaluates the quality of the company, its health, its financials, etc., and then determines how many shares to issue, the price to share, the price to issue shares, etc. If you're an investor and you're looking at this company and you're thinking, well, this may be a good investment, there's a risk if there's no secondary market. And the risk is you buy stock in the company. But what happens if it turns out the investment's not great? Well, you're stuck with the stock. There's nothing that you can do with it. You just have to own it. Or selling it to some other person would be very difficult. There's not established market infrastructure like a central clearinghouse or an exchange to do that. But if there's a secondary market where you can just sell the stock to someone else, well, now it makes it much more attractive to buy the stock in the primary market because, hey, if this doesn't work out, if my needs change, if I suddenly need cash, I can very easily sell this. So the existence of secondary stock markets, something like the New York Stock Exchange, increases the willingness of investors to buy companies' publicly traded equity in the first place. That's the value that's provided by a stock market. It is worth noting, by the way, that issuing stocks on stock markets is generally quite expensive. The biggest cost is the underwriting process. Investment banks are well known to charge quite a lot of money for this process, but there are also a whole slew of regulations after a company has decided to go public, before it becomes public, that it has to satisfy. There's lots of compliance costs associated with proving you've disclosed the relevant information. There's lots of governance regulations once you've gone public that require companies to disclose things like their financials, their balance sheets, their cash flows, etc. And all of that requires audits because of previous corruption scandals like the Enron accounting scandal back in the early 2000s. That led, for example, to something called the Sarbanes-Oxley Act in the United States, or SOX as it goes by, SOX. SOX is a particularly well-known piece of legislation that basically affects the requirements on companies to disclose information publicly, and the costs of proving you're compliant can be very steep, often upwards of $1 million, and consequently going public often can be reasonably expensive. Partially for that reason, the number of publicly traded companies in the United States, and for that matter in many European stock markets, has actually gone down over the last 20 to 30 years. You can sort of see that trend visually, and even amongst the companies that are deciding to IPO, they're often waiting later into the existence of their company to IPO. I'll talk about that a bit later in the context of the illiquidity problem currently facing private equity and why IPOs are becoming harder and harder to justify. That being said, this trend is not universal. So, for example, many stock exchanges and stock markets in emerging markets, China, for example, as an example that has had this trend on go for decades now, have actually seen an explosion in initial public offerings, partially driven by the financialization of economies in developing countries as large financial institutions, including, for example, stock exchanges, arise in those markets. So that's what a stock market is. A real question that people don't ask enough in debate is, why do companies care about their stock price? It sounds intuitive that companies don't want a low stock price, but why do they actually care what their stock price is? Remember, whether your stock price is high or low, the price doesn't immediately affect the company because the company has already made the money from that initial sale in the primary market. So the share price, and whether it's high or low, doesn't affect immediately, at least, money that's coming into the company. But nonetheless, companies obviously do care about their stock price. The most immediate reason for this is that the people who run companies, like executives and managers, they're often compensated through what are called stock options. The idea is your compensation involves ownership shares in the company. Now, lots of people know that fact. It's often used in debate, but you might not understand why so many managers and executives are paid through stock options. And there's actually a pretty important reason why, which relates to the principal agent problem in investing. The principal agent problem is a game theory problem where a principal who, for example, in this case, invests money in a company, doesn't actually run the company, and the running of the company is delegated to an agent, for example, the executive or manager of a company. And the principal, in this case, the investor, sort of assumes that the agent is going to act in the principal's best interest, but there might be a mismatch between their interests. So, for example, if you're an equity investor, you might give tons of money to a company, but hypothetically, what's to stop that company from taking all of that equity investment and just paying really huge bonuses to the existing management and running the company into the ground? Unlike debt, equity investments don't have to be repaid. So if you get $10 billion in equity, for example, you could theoretically, although you'd be violating your legal obligations, you could theoretically use that to not maximize the value of shareholders' investments. The way that this principal agent problem is minimized is through stock or equity-based compensation packages. If the executives and managers of a company have a direct financial stake in the stock price, which is what shareholders are trying to maximize the value of, then executives and managers have an incentive to improve the company's governance quality, product quality, et cetera, in a way that results in the stock price being higher. Of course, there's also a flip side of this argument, which is that if the stock price goes down quite a lot, shareholders ultimately determine the composition of the corporate board, and the composition of the corporate board ultimately has quite a lot of influence over executive positions, management, and so forth. So if the company's management runs the company into the ground, shareholders will get pissed. They'll exercise their voting rights to demand leadership change or a leadership reshuffle, and in turn that causes existing executives and existing managers to lose their jobs. There's also other reasons companies care about their stock price. One of them, for example, is just that if you want to issue more equity in the future in what's called a follow-on public offering, you intuitively want your share price to be high, which signals the value of your company. You also care, in many cases, about having a high stock price so that it makes it easier to borrow money, because investors will look at the direction of your stock price. For example, has your equity value gone up or gone down in the last 3 months, 6 months, year, 2 years, 5 years, et cetera, as an indication of the general health of your company. So imagine, for example, you're a company and you need to borrow money. If you go to a bank and the bank looks at your stock price and it's down in the dumps and it's been tanking for years, they're less likely to give you an affordable interest rate. So stock prices, and in particular, changes in stock prices, influence the cost of debt. So that's why companies care about their share price. There is a fair argument that comes up quite a lot in debate that companies arguably care too much about their share price in the future. So in theory, as the technical definition goes, the share price of a company, in other words, the price of a stock, reflects the present discounted value of future dividend payments. That's a very fancy way of saying that the present value of a company's stock should be equal to all of the dividends that the company is going to pay out to shareholders across time, discounted by the fact that money today is worth more than money tomorrow. For example, if a company pays out an annual equity payment or a dividend payment of $100, $100 this year is great. It's worth $100 to you now. $100 next year is going to be worth less. Maybe it's $97. $100 down the road is going to be worth even less, maybe $93. And that process goes on and on and on. And in theory, the price of a stock reflects the present value, the discounted value, if you will, of all future dividend payments. That's the theoretical definition of a stock price. In actuality, a stock price is just determined by supply and demand. How much do investors want to buy the stock? That influences the price at which the stock sells. There's a fair argument that says in the modern day, the people that are investing in stock markets care an awful lot about a company's share price in the short term. And that often leads to a reduction in long-term investment. In particular, it results in companies focusing too much on maximizing their earnings now, so that when they report earnings at the end of every quarter, investors look at their earnings and say, you are really growing, this is good, I'll buy your stock, and that causes the stock price to go up. But companies don't care as much about things that are good for long-term growth, like investing in research and development, investing in capital goods like machinery or factories, for example, or investing in human capital. Think employees, for example, giving employees better pay, better training, etc., to increase morale, increase retention, and so forth. And there is some evidence, to be clear, that that hypothesis is true. One piece of evidence, for example, is just that CEO tenure is declining. So the average CEO is in a company for lesser and lesser amounts of time. That might be evidence, for example, that CEOs are increasingly ousted when shareholders dislike the inefficacy of short-term returns. Of course, that might also have exogenous explanations, like CEOs increasingly move between companies voluntarily. So that piece of evidence itself might not be definitive. But perhaps the other piece of evidence is that you could cite are companies often will delay long-term investments when quarterly earnings happen to be disappointing. So, for example, it's pretty common when a company loses lots of money or doesn't meet earnings expectations, it's pretty common to see companies declare strategies that will increase the profitability of the company the next quarter or the next 2 quarters or the next year, even if, for example, that means scrapping, say, a new factory plan or a new product plan, something along those lines. And the causal mechanism here is that if a company's executives are compensated based upon the value of the share price increasing every quarter, well, naturally, executives' incentives is to focus on how do I make sure the company is more profitable in 6 weeks, even if that means, for example, I'm not going to invest in making the company grow over the next 6 years. There are a series of reasons why companies, and in particular investors that invest in companies via stock markets, care too much about short-term results and don't care nearly as much about long-term results. One of them is the time value of money problem. So for example, you could have what's called a DCF or a discounted cash flow model that basically says money in the future is worth less than money now. So just on a very simple basis of accounting, you'd rather have money today than you'd have money in the future. So if you're a company and you're deciding, should I invest in something that gets me a 10% profit increase or revenue increase in the next quarter, or a long-term project that will increase profits by 15% in 6 months, or sorry, 6 years, say, you'll probably opt for the short-term project because the long-term recurrent returns are discounted based upon the time value of money problem. That being said, that discounting is directly related to the level of money that you could make on an investment into the risk-free asset. So for example, the degree to which you care about discounting relates to the current interest rate. And so in cases where interest rates are fairly high, you'll discount long-term returns much higher because the alternative place that you could invest, like a treasury bond, will offer a higher return. So the time value of money is not a static concern. It relates directly to current interest rates. A second reason why investors might care too much about short-term value and short-term stock prices is just that they're irrational. By irrational, I don't mean they're stupid. By irrational, I mean investors are very much subject to what's called hyperbolic discounting. That's a very well-documented cognitive bias where people prioritize short-term gains over long-term benefits that are greater in magnitude. There's lots of psychological studies that demonstrate that's pretty compelling. Robert Shiller, the behavioral economist from earlier, has done excellent research just on that topic alone. A third argument is that because investors have imperfect information about what's going to make a company grow in the long term, they default to caring mostly about what's best in the short run. So for example, if you're a major investor in a company, you don't really know exactly what's going to happen in the future or which projects are going to pan out. And you don't have lots of immediate insight into what's the quality of the management like, which products will succeed, etc. So there's relatively greater certainty in saying, I want the company to increase its profits quarter over quarter, even if that means the company is not going to make as much money in 5 years because it's unclear or difficult to determine if the company will, for example, become more profitable in 5 years by focusing on long-term projects. The fourth other argument that's worth knowing about this is the sort of principal agent problem in asset management. The concept here, and we'll talk about this more when we get to major institutional investors, but if you're a major institutional investor like an index or a mutual fund, you're given money by lots of people and then tasked with investing that money. So imagine that you're a mutual fund, for example. You get lots of money from pension funds. You get lots of money from hedge funds, maybe, probably not realistically. You might get some money even potentially just from individual retail investors, and you as the mutual fund that then get to determine where you're going to invest the money. But there's a principal agent problem here because the mutual fund's interests might not immediately align with the interests of the people giving money to the mutual fund. And so lots of mutual funds, for example, are going to adjust to or adapt to the principal agent problem by providing performance indicators to their investors to say, hey, just so you know, we're actually doing what you asked us to do, i.e. investing your money responsibly, making sure we're getting stable returns. Here is a performance tracker for how much money, for example, the fund is bringing in, the size of your retirement account, if you're involved with the pension, so on and so forth. Of course, the issue there is that if you're an asset manager or a portfolio manager in an asset management fund, that means that you need to prove that you're making money over the short term. And to that extent, if you're, for example, investing in the stock market and you have some influence over corporate decisions, or you're determining where to put your money, you need to meet those quarterly or, say, biannually metrics in order to sort of convince the people that are putting money in your fund that you're doing a good job of managing their money. And to that extent, you do care about short-term results, even if that means down the road, your overall investment will be worth less. The final argument that might be worth thinking about vis-a-vis the problem of quarterly capitalism, like the obsessive focus on short-term results, is about dispersion of ownership. One of the main trends in public equity markets over the last 75 to 100 years is that an increasingly large number of investors own stock. And in theory, that sounds great, and to some extent it is. But one of the downsides of that is if you only own 5 or 10% of a company's shares, there's not really a huge incentive for you to spend lots of time figuring out how to make the company more profitable in the future. Because that's going to require a lot of time and a lot of money. You're going to have to hire financial accountants and investment bankers and lawyers and auditors and all of these sorts of highly paid professionals to figure out how to make the company better, how to identify its weak spots, et cetera. And that's going to require lots of time and lots of investment to potentially increase the value of the company in the long run. The other way that you can make money as an investor that is never going to be able to outright own a company is to do the simpler thing, which is you just buy into the companies that happen to be doing well right now. And then once you get an indication that things are going poorly, you just sell, as opposed to doing the other thing, which is trying to improve the company, improve the quality of the company's management, implement activist shareholder policies. That's basically where a shareholder tries to affect change in the company, like lobbying other shareholders to vote for a proxy or changing the composition of the corporate board. And so to that extent, the dispersion of ownership in publicly traded companies might reduce the incentive for shareholders to focus on the long-term value of the company when there's a much easier option, especially in the age of cheap, low-fee trading, which is you just sell your stake in the company. Look, there's a collective action problem, right? Which is, if you're the 5% shareholder, you're never going to be enough to change the company's composition or management structure outright. So the easier and cheaper thing to do is just to sell when the company starts to perform poorly. And for that reason, companies have to constantly be proving these short-term results. And if they don't, investors are going to sell. By the way, this is one of the arguments you might make for why IPOs could arguably be bad. So if you remember the SOX example from earlier, SOX is that piece of regulation that imposes very stringent accounting and auditing requirements on publicly traded companies. That has arguably deterred some companies from going public because being publicly traded on stock markets means you have to comply with SOX, and that costs quite a lot of money for companies that don't really want to pay that money when they could be spending that money elsewhere. And so if you're a prop team here, you might argue, hey, if we repeal SOX, we're going to get more IPOs. It's plausible that you on op say, we think that's bad, actually. We're happy for these companies to stay private because when they're not beholden to quarterly capitalists on Wall Street, they're more likely to focus on research and development that actually produces long-term growth and drives innovation. Next thing to know about public equity markets is about the mechanics of equity markets. I'll note that this is less useful for debates that are not directly about financial markets, but when you happen to debate specifically about stock markets, understanding the mechanics of what goes on under the hood can probably be fairly useful. So what actually happens in these secondary markets where stocks are bought and sold and traded and all of that? Well, the first institution to understand is a broker. A broker is basically just a very specific type of institution that places orders on behalf of clients. And when I say clients, I don't even just mean like retail traders. Brokers also place trades for huge institutional funds like pension funds and even hedge funds. There are these things called prime brokers, for example, that offer specialized services to large investment funds, particularly hedge funds, in order to place trades, manage transactions, hold securities, that sort of stuff. And if you're a broker, the main way that you're going to make money typically, or more importantly, historically, was through commissions. So if you're a broker, what you do is you take orders from lots of people and then you buy or sell the stocks that they want to buy or sell. Same thing for derivatives. And every time you transact a trade, you charge a very small fee or a very small commission, and that money adds up. Now, there's an interesting trend of what's called low or no fee brokerages. Robinhood is the most famous example of this, but there are plenty of them in the modern era. In fact, very many online or digital brokerages have gone low or even zero fee. The way that they make money is through something called payment for order flow, which I'll talk about in just a moment. But in order to understand payment for order flow and its implications, you sort of first need to understand market making. So market making is complicated. It's probably easiest to think about it visually. So when you are in a stock market, it's very easy to think of stock markets as being literal exchanges where buyers are matched with sellers. So for example, it's easy to think of stock markets as these big anarchic spaces. You could even think about it physically prior to the age of digital trading, where a bunch of investors all come together. Some people want to buy, some people want to sell, and buyers find sellers and sellers find buyers, and they shake their hands and say, you agree on this price? And they say, yes, I agree on this price. And congratulations, the transaction's done. As it turns out, that's a very inefficient model of trading. So for example, what happens if there are 500 people who want to buy and 400 people who want to sell? Well, suddenly you've got a problem at that moment in time. So the way that stock markets work is they don't just have this abstract system of a buyer needs to find a seller and vice versa. What you instead have are what are called market makers. And market makers are a special type of institution. Sometimes it's done by hedge funds. Sometimes it's done by large banks. Really, any major financial institution can make a a market, so to speak, though it does in some cases require regulation or cooperation with stock exchanges. But what a market maker basically does is allow a stock market to have liquidity. So the way a market maker operates is they basically stand by ready at all times to buy and to sell some stock. And the way that they do this is they have a huge inventory of stock and they have a huge inventory of money. And when someone comes to the stock market and says, I want to buy this stock, they buy the stock from the market maker. And when someone has the stock and wants to sell, they sell the stock to the market maker. Now, you might look at this and think, well, that's really nice as a market maker. That's very generous of them. They are in this position where they're buying and selling, and in doing so, they make markets work because they allow for buyers to always have a seller and they allow for sellers to always have a buyer. But how on earth does a market maker make money? Well, it turns out that market makers profit from what's called the bid-ask spread. The bid-ask spread basically is market makers charge very slightly different prices to buyers than to sellers. The idea is if you're a market maker, you can charge a slightly higher price to someone who's selling to you than the price that you charge to someone who's buying from you. Now, to be clear, this is a very small difference. It's not multiple dollars in most cases, in the context of stock markets at least. It might be as low as a fraction of a penny, a fraction of a dollar, in other words. Now, that means that each individual transaction does not make much money for the market maker. But if you're a market maker and you're involved in a major stock exchange or stock market, and every day tens or hundreds of thousands, even millions of shares of stock are being bought and sold and sold and bought and sold, that very, very small spread between the price that you're charging and the price that you're selling at, that adds up. So if you buy and sell a stock to buyer and seller respectively, and you make 1 penny off of that transaction, but you do that transaction 10,000, 100,000, a million, 10 million times a day, well, that money really does start to add up. So the way that market makers make money is by setting slightly different prices to buyers than to sellers, and they pocket the difference. Now, notably, what this means is that when there are lots of buyers and sellers in a market, market makers can charge lower bid-ask spreads. That means the market is relatively more liquid because the price difference between buying and selling is smaller, and the market maker still makes a profit because although the bid-ask spread is lower, there are so many more transactions that the money still adds up. But markets become relatively less liquid in the context where there are fewer buyers or sellers, because the only way that a market maker can make a profit in that context is to make more money per trade, which requires them to have a higher bid-ask spread. In general, low bid-ask spreads are good. The reason is the lower the bid-ask spread, that means that less money is quote unquote getting stolen in a sense from buyers and sellers in stock markets. Because if the quote unquote true value of a stock is between the bid and ask spread, then the larger the bid-ask spread is, the more money is being pocketed by the market maker as opposed to by the investment funds or retail investors that are actually buying and selling. So low bid-ask spreads make trading cheaper because less of your money gets eaten up by the market maker. And for that reason, you care, or you should care in capital markets, about having efficient stock markets where market makers are setting low bid-ask spreads. And the way that you have that is by having a high volume of transactions. That brings us to payment for order flow. Lots of people have a very legitimate question, which is how on earth do firms like Robinhood make money if they're not charging commission? And the main way they do it is they engage in contracts with market makers whereby brokers agree to direct trades to specific market makers. The market maker then profits from the bid-ask spread and the resulting transactions. And in exchange, the market maker pays a small fraction of that bid-ask spread, so to speak, or a fixed pre-agreed upon commission to the brokerage. So for example, here's a simple illustration. Suppose I'm going to make up names here. I don't know if this is actually true. Suppose JP Morgan is a market maker for some stock. And Robinhood knows that the traders on its platform are going to love to buy that stock. JP Morgan might go to Robinhood and say, hey, we really like what you're doing for investing, and we want to play a role in it. So what we're going to do is, every time you send one of your traders to us, as opposed to a different market maker, a different firm that's doing the same exact thing for the same exact stock, we're going to pay you a small, small cut of the slice. We're going to give you a fraction of a penny. But if you send lots and lots and lots of orders to us, that money's going to add up. And in exchange, this is still a good deal for us because when all of these Robinhood clients place trades that go through our market maker, we're going to make money off of that transaction. And so in that sense, Robinhood's going to benefit. They get money from the market maker. And the market maker also benefits because they get more trades going through their system as opposed to some competitor. After all, multiple firms can make a market for the same stock, the same bond, the same commodity, the same derivative, etc. So what this means is that payment for order flow reduces trading costs because the people that are investing through brokerages and brokers no longer have to pay a fee. The downside is it means that large brokerages like Robinhood have pre-agreed to send trades to specific market makers, even if a different market maker might, for example, have a lower bid-ask spread, or might, for example, have better deals. And the consequence is, although payment for order flow reduces the initial trading cost, the downside is that the market maker that ultimately executes these transactions might not be strictly optimal because there's a pre-agreed upon contractual obligation for the brokerage to send orders to a particular market maker. By the way, market making has interesting relationships with insider trading. It's one of the interesting arguments that you'll often hear against insider trading. So suppose you have a motion like this house would legalize insider trading. One of the main arguments you'll hear for why insider trading is normatively bad for financial markets is about the profitability of market making. The idea here is this. If you're a market maker, you are every microsecond of every day slightly adjusting the prices of the stocks that you're buying and selling, because you want to make sure that the prices that you're setting are accurate reflections of what the market believes these assets are worth. That's what's going to drive investment into the stock. That's what's going to drive profits for you because you pocket that bid-ask spread. The problem with insider trading, by the way, insider trading just means someone with inside information that's not material, not publicly available. So, for example, imagine you're the CEO of a company and you know, but markets don't know, that the company is about to release a new product that's going to make lots and lots of money. Insider trading would be you're the insider, you're the CEO. In other words, you just buy a bunch of stocks in the company. That's insider trading. You know its stock price is going to go up. The rest of the market has no idea about that. So insider trading would result in that CEO making tons of money. Now, one of the problems with this is if you're a market maker, you have to assume that the people that are buying and selling stocks have the same information as you so that you can set prices fairly. And as a consequence, you're not having money, quote unquote, stolen from you by someone who realizes that the prices that you're setting are off. For example, if you're a market maker and you set a price 5% lower than the actual value of a company, an inside trader is going to come along and they're going to buy up that stock. And here's the problem. Eventually, the stock price is going to go up, but the resulting consequence is that the market maker is going to make an implicit loss in the sense that their lunch got eaten by the insider trader. And so the consequence of inside trading is it makes it less profitable or riskier for market makers to do their thing, to do this bid-ask buying and selling behavior, because market makers don't have the same information as insider traders, and inside traders trade on that information in a way that results in market makers making a loss. The consequence is insider trading makes markets less liquid because either market makers drive up the bid-ask spread to compensate for the risk that they get their lunch stolen or eaten by inside traders, or market makers just outright leave securities markets wholesale. This is related to a separate concept called high-frequency trading. High-frequency trading, you'll often see abbreviated as HFT. It's a very weird type of trade that at first glance just seems kind of odd and niche and computerized Wall Street geek stuff, but it relates pretty cleanly to market making. High frequency trading is sort of what the name suggests, which is just that it's trading at a very high frequency. In other words, it's using very, very powerful computers and these big complicated algorithms to buy and sell a ton of stuff in a really small amount of time. Now, you might ask why in a really small amount of time? Well, the reason is if you are doing high frequency trading, this stuff is happening faster than you can blink. It's literally happening in microseconds. And because these trades are happening so fast, they have to be algorithmically preset. In other words, the algorithm is just determining when to buy and when to sell, and the computer's just executing the trade. And because this can't involve human judgment on the microsecond by microsecond level, you have to trade at an interval where algorithms are functional. The problem is algorithms can really accurately predict what's going to happen in markets in the next 2 to 3 seconds because there's not going to be any major change in interest rates or geopolitical conditions or market conditions or whatnot that's going to change the value of the security. But an algorithm can predict, okay, there's a temporary change in the price. It doesn't reflect any change in the actual value of the company, so let's buy, for example, because the price is naturally going to correct back. And so algorithmic trading, at least prior to the age of big data and advanced analytics and artificial intelligence, most algorithmic trading focuses on small, short-term periods of time where algorithms are effectively able to identify price deviations in markets, and you can then use very, very fast trading to bet that those market inefficiencies are going to go away. So, for example, if you notice that a stock price has temporarily gone 2 cents above what its real value is supposed to be, you might reasonably bet, hey, that stock price is going to come down by 2 cents in a couple of minutes. And so if you're a high frequency trader, you can, in a couple of microseconds, short the company stock. And so when the company stock goes down, you make a rather handsome profit. By the way, Michael Lewis wrote a very fun and interesting, controversial, but interesting book called Flash Boys that's more or less just about high frequency trading. Now, why does high frequency trading exist? Well, what it's trying to do basically is identify inefficiencies in markets and profit from them. So, for example, if you're a high frequency trader, you might recognize that prices are deviating from their natural prices, and you bet that the price is wrong and it's going to eventually correct back as other traders in the market realize the price is off. And so you can bet through long or through short positions that prices are going to converge to their real value. So the purpose of HFT is to use algorithms and supercomputers to make tons of trades and make very small profits that are magnified by the scale of trading. That's why you would do this with millions of stocks as opposed to just doing this with 5 or 10. You're going to make a fraction of a fraction of a fraction of a cent if you don't do this at scale. That's what high frequency trading does. People who like high frequency trading will say, look, high frequency trading has a huge benefit for markets, which is because there are these massive institutional traders that are buying and selling, millions of shares at any given moment in time, it drives down that bid-ask spread because high frequency traders are basically market makers. They're basically always buying and selling stocks. And that means that if you, a retail investor, or you, a pension fund, want to go to a market and buy or sell stocks or whatever you happen to be buying or selling, like maybe a derivatives contract, maybe a bond in a secondary bond market, although high frequency trading doesn't exist nearly as much there, high frequency traders are going to provide you with liquidity. It's going to be easier for you to buy and sell at a lower cost. In other words, that bid-ask spread is going to be lower, and that puts competitive pressures on designated market makers, the funds that do this for a living, like Citadel, for example, to lower that bid-ask spread because they have to compete now with high frequency traders for their business. And so the benefit in theory of high frequency trading is it makes trading cheaper because you reduce that bid-ask spread. There's always a buyer to match sellers. There's always a seller to match buyers. That means liquidity is improved because when you want to buy or sell, the impact on the price is smaller. So there's a guaranteed buyer seller and the impact on the price is lower. So that's the major benefit of high frequency trading. There's also an argument that high frequency trading reduces volatility. I'm personally not sold on it, but there's lots of cool literature out there that you can look up. That being said, there are lots of arguments against high frequency trading. One of them is the volatility concern. The issue basically is high frequency traders focus on very, very short-term profits in a way that maximizes gains to a very small number of very, very rich hedge funds, but more importantly causes harm to the broader market because there are periodic crashes caused by algorithmic trading. The most famous example of this is the flash crash back in May 2010. It was a scenario in which tons of high frequency traders used algorithms to make predefined bets. When certain conditions in the market were satisfied, there was suddenly a halt of lots of these trades, and it caused a huge and unexpected and completely inexplicable crash in stock and asset prices that was largely blamed on high frequency trading. So there are some concerns, given that high frequency trading relies on algorithms and high speed trade transactions that can't be monitored in real time by humans. There's a concern that it periodically causes huge shocks to markets. The other more interesting argument against high frequency trading, the one that I think is much more interesting, is although high frequency trading reduces bid-ask spreads, that's not really the major cost of trading for most large investors because the bid-ask spread is maybe a few pennies on a given transaction. The real threat to institutional traders, and by institutional traders, I'm talking largely here about funds that are buying and selling a huge amount of stock like pension funds or mutual funds. The major risk that they face is price impact. So what is price impact? Well, if you think back to your Econ 101 basics, you'll remember that the law of demand says that when demand goes up, price goes up as well. Now, in very simple microeconomics, the way that you think about demand differentiates between individual sort of quantity demanded versus aggregate demand as a whole. And the part of the reason why you would make that distinction is because whenever you're thinking about demand at the individual level of, say, an individual consumer, you don't really think of an individual consumer's behavior as changing the price of some product. So here's an example. If you go to the store to buy, I don't know, apples, you're one person buying apples. Your transaction technically increases demand for apples. Like you are buying apples. Your appetite for apples has gone up. Therefore, global demand for apples has increased. But in the grand scale of things, one person buying like 6 apples from Walmart is not going to change the price of a multi-billion-dollar industry. But when you're a huge firm investing billions of dollars into something, when you do something like make a multi-billion-dollar purchase, that increases demand, and the law of demand says the demand goes up. And so it turns out that when you place really large orders for something, maybe the first good of that order will sell at the price that currently is set, but successive items that you're ordering will have higher and higher prices because the increase in demand caused by a large transaction will cause the price of each item in that trade to go up. So why is that relevant to high frequency trades? Well, one of the issues that large institutional investors face in financial markets is price impact. If you're a pension fund and you're buying 30,000 shares of a company, well, when you make that transaction, it's going to cause a slight increase in the price of the stock. It's not going to be a huge increase. You're not talking about doubling the share of a stock. But if you're a pension fund that's selling or buying tens of thousands, hundreds of thousands of shares of a company, it's going to have an impact on the price. It's going to cause the price to go up in a way that's unfavorable because it makes it more expensive to buy the stocks that you want to buy, or it reduces the price when you're trying to sell. High frequency traders realized this, and what they basically did, and still do to this day, is adopted something called front running. Sometimes you'll hear it called latency arbitrage. The concept is basically this. High frequency traders can figure out through a series of fairly complicated mechanisms when large investors are placing a large order. So for example, the way this typically works is a pension fund will typically place orders on multiple different stock exchanges to try to find the best price for whatever it's buying up. And high frequency traders will detect the order in one market, and then they'll realize that the order is coming through in other stock markets for the same underlying security. Because high frequency traders can trade so fast, you're often talking literally nanoseconds. They have computers that are co-located often with stock exchanges. They have the fastest wires and cables known to man. High frequency traders will realize institutional investors are about to place a huge order. And when that order comes through, it's going to cause a price impact. It's going to cause the value of the security to go up. So there's an opportunity here. The high-frequency trader can get ahead of the institutional firm. It can place a large order for the same stock, buy up the stock before the large institutional investor has the chance to do so. Then, when the price has gone up, the high-frequency trader can sell that same stock back to the institutional investor that's still looking to buy at a slightly higher price. Now, to be clear, when I say slightly higher price, I'm not talking about $10, $20, $30 higher. I might be talking about this is a price increase on the order of maybe a few cents, 5, 10, 15 cents, whatever it happens to be, which doesn't sound like a lot. But if you're a pension fund, mutual fund that's buying millions of dollars of stocks, that's going to be a few $1,000s taken out of your investment, because if you thought you were going to buy the stock at $30 per share, just to make up a number, but it actually turns out the stock, by the time your order actually executes, is now trading at $30.10 because the high frequency trader got to you first and realized your order was incoming, but beat you to the punch and then sold that same stock back to you at the slightly higher price. You're now paying at a slightly higher price than you intended to. Or on the flip side, if you're selling at a slightly lower price than you thought you'd be selling at because the high frequency trade shorted the underlying asset. So that's what front running means. And the consequence of front running is it makes trading more expensive for large investors. The reason is because high frequency traders front run large orders submitted by institutional investors and cause a price impact, which the high frequency trader then exploits to make a very small profit at the expense of the institutional investor. Why is that bad? Well, if you're a pension fund and you make less money, guess what that means? Regular middle class people's pension savings are not as as valuable because a few $1,000s in all of these transactions get lost to high-frequency traders. Now, if you're a large institutional investor, this sucks. And so you'd obviously try to find workarounds. And one of the major workarounds is turning to what are called dark pools, or sometimes what's called dark liquidity. Dark pools have a very ominous name. In practice, they're not that ominous, but the premise of a dark pool is it's basically an exchange where you can buy and sell stocks or assets where the order submission and the original price orders that are submitted are kept anonymous. And the purpose of a dark pool, basically off-exchange trading, is to stop this HFT front-running strategy. Now, the upside of trading in a dark pool, for example, trading off of the New York Stock Exchange, where you just have a private transaction with someone who wants to sell the stock that you're buying, the upside is that you eliminate the risks associated with front running, and you to some extent limit the problem of price impact. The downside is that it reduces transparency. See, in a public stock market, all of these bid-ask spread, all of these bid and ask prices, all of the order submissions, it's public information. It's coming into markets, it's identifiable, it's verifiable, it's analyzable. Dark pools eliminate that transparency and that information. And the consequence is you don't have nearly as much information about the value of assets because a lot of that information associated with the submission of orders, bid prices, ask prices, etc., is eliminated in dark pools, which in turn reduces the information richness of markets. That's bad because what we talked about earlier in the risk management section, which is you really want financial markets to accurately price assets because that's what helps to determine which are the most productive firms in the economy. And that's where you want capital to be allocated. To put that in more simple terms, the reason dark pools are bad is because they reduce transparency. Reducing transparency is bad because it makes it harder for markets to figure out the true value of companies. And when it's harder to figure out the true value of companies, it's harder for markets to allocate money to the firms that are going to use it in the best ways to make society better. And just to be clear, this isn't some abstract, hypothetical, academic inkling about what might happen. This is the ongoing trend. If you look, for example, in the early 2000s, as high-frequency trading really starts to take off, and there are, of course, many factors that drive the rise of off-exchange trading, but certainly one of them is the rise of high-frequency trading. And you'll notice that nowadays, the volume of stock transactions that happens on public stock exchanges like the New York Stock Exchange is actually comparable to the volume of stock exchange transactions that happen off exchange in these so-called dark pools. By the way, I doubt you'd ever get a motion about market makers. An interesting motion that I've thought about in the past that you might potentially see at some point would be a motion about the rise of quote unquote voluntary liquidity providers. Voluntary liquidity provider is a fancy euphemism for high frequency trader. It's technically not true. There are other institutions that could constitute a VLP, but what a voluntary liquidity provider is a financial institution that does so many trades in the stock market and is doing all of this high frequency trading stuff that in practice, they end up providing liquidity to markets, i.e. they're always buying, they're always selling, and as a consequence, other investors can buy and sell without a major impact on price. Notably, voluntary liquidity providers represent an increasingly large amount of liquidity provision in markets compared to what are called designated market makers, which are firms that enter actual contractual agreements with regulators and with stock exchanges to provide liquidity to markets by buying and selling stocks and standing ready to post bid and ask prices and then sell and buy at those pre-agreed prices. There are reasons to believe that the shift is bad. One of the biggest ones is that voluntary liquidity providers aren't contractually obligated to buy and sell. And the consequence is that market making is not always profitable. There are cases, for example, in severe volatility where market making can in fact be unprofitable or have risks associated. And the consequence is that voluntary liquidity providers are unwilling to provide liquidity in the times when markets most need liquidity, i.e. the times when investors most need to buy or sell assets because, for example, there's new information that just hit the market and investors need to adjust their portfolio rapidly. Designated market makers, firms like Citadel, for example, that actually do this for a living and have contractual relationships with, say, the New York Stock Exchange or NASDAQ and are recognized by those stock exchanges as market makers, they are obligated to continue buying and selling even when it might be unprofitable to do so. Next thing to talk about in public equity markets is the sort of polar opposite of high frequency trading. So high frequency trading is done by a relatively small number of huge financial institutions or very niche hedge funds with enormous amounts of money, extreme amounts of talent, extreme amounts of computing power. Retail traders are the opposite. Retail traders are non-professional, regular-ish, everyday folks who invest their own money. That's not entirely true, to be clear. Some retail traders might be upper middle class people who happen to have extra money and extra disposable income and are willing to invest. But lots of non-professional investors, i.e. retail traders, are just regular people who are working a 9-to-5 day job and invest some money on the side. Now, retail traders contrast with institutional investors, and the two core distinctions between a retail and institutional trader are: one, an institutional trader is investing someone else's money. For example, a hedge fund pools money from very rich people or other large investment funds and then invests that money on their behalf. Same is true for mutual funds, same is true for index funds, same is true for exchange traded funds, same is true for a whole range of other specialized investment funds. Pension funds would be another obvious example. Retail investors are investing their own money. They're people who want to invest on their own account. The second core distinction is about expertise. Institutional investors are companies. They're run by people who work in financial markets, analyze markets, so on and so forth. Retail investors are not professionals. They're not people who do this in a professional capacity where they're employed, for example, to analyze or invest in financial markets. Retail trading has really exploded in the last, particularly 5 to 10 years, but more broadly in the last 15, maybe 20 years. There's a couple of reasons for that. One is that no-fee brokerages make it cheaper for retail traders to invest. Robinhood, for example, makes it cheaper for regular folks to put their money in the stock market. Second, there was a huge boom in savings during the pandemic. This was both because consumption rates fell during the pandemic, people just spent less, and also because people got huge stimulus checks from the government, a lot of which was then funneled into retail trading. A third is that lots of people increasingly don't view housing as affordable, particularly in advanced economies. And so lots of young people are increasingly opting, rather than trying to save up, for example, for a mortgage, to instead invest, say, into crypto, into index funds, etc. A fourth is just generally the stock market has performed reasonably well since COVID. It's been particularly strong thanks to the rise of artificial intelligence and the Magnificent Seven. And of course, there's a most famous explanation for the rise of retail investing, which is the rise of social media platforms like r/Wall Street Bets. I'm a huge Reddit user, and I think that that subreddit is really an interesting experience, and I do not mean that in a positive way, but that certainly has contributed to the rise of investing communities that democratize information, that recommend particular investments to retail traders, so on and so forth. And so if you just look at the statistics, retail trading actually now comprises a surprisingly large quantity of actual trades, in the sense that the number of people that are investing has gone up, the number of households that invest in the form of retail investing has gone up. The demographics have also changed. Retail investors, on average, are increasingly young. For the most part, retail trading has always been more male than female, but there's also a rise of low-income retail investors, i.e. people with below median income, investing their money into stocks, bonds, options, so on and so forth. And as a consequence of that rise, retail investors now are a real force in the sense that something like 20 to 30% of the daily buying and selling of stocks is increasingly done by retail traders, and something like 30 to maybe up to 40%, depending on what estimates you trust, of stocks are actually owned by retail investors. Though it's worth noting that some of that statistic comes in the form of either index funds or pension funds where people own stocks, but it might be because it was allocated there, not necessarily by their own immediate choice. That being said, a common error in finance debates is to pretend like retail investors have a major impact on all markets globally, or that retail investors, because they own 35-40% of stocks, are determining what companies do, or they are the predominant determinant of stock prices. That's typically true for limited stocks that have huge amounts of retail trading activity. The most famous example of this by a fairly large margin is GameStop, which had a sort of huge amount of retail investor activity back in January of 2021. I'll talk about that in a moment. But for the most part, retail investors are not dominating financial markets. There's a couple of reasons for this. The first is that retail investors are precluded. They're legally not allowed to invest in tons of markets. So, for example, at least as of right now, private equity funds are not allowed to directly accept retail investment. So there are some markets where retail investors are not deemed quote unquote accredited investors. They're not rich enough, in other words, or they don't have enough assets under management to invest. A second reason is, although retail investors collectively invest a lot, retail investors are also extremely decentralized. So if you're a pension fund and you own 20% of a company, you're a pension fund. You are a company. You have centralized governance and a singular vision, which means that you exercise your control over the company to push for certain reforms. But retail investors aren't homogenous in the sense that there are literally millions of different retail investors with different investment agendas, political beliefs, aims, values, etc. So although retail investors collectively make up a large amount of daily trading activity, they don't all behave in similar ways and often demonstrate huge heterogeneity in their trading strategies, which means it's not like retail investors invest monolithically, which means that maybe some retail investors buy stock X, others sell stock X. The net effect often tends to cancel out. But probably the most important reason why retail investors aren't dominant in financial markets when it comes to ownership is that very few retail investors are major forces in corporate governance. Remember, one of the most important purposes of the stock market isn't just buying and selling stocks for sake of making money. One of the important purposes of the stock market is buying and selling ownership so that the owners of stocks can then vote in corporate governance matters, like determining whether or not the current corporate board is performing well enough or not. Retail investors are often leaving their positions fairly quickly because they can't, for example, buy a stock and hold on to it for 10 years. So in that case, they're not necessarily determining corporate board policy because they're not sticking around for the long haul. But the more important retail investors, the more important reason why they're not involved in corporate governance is just a game theory problem. If you're a retail investor and you buy 3 shares of Tesla, congratulations, that's a huge investment for you. Tesla has tens of thousands, hundreds of thousands of shares issued, and the vast majority of them are owned by large institutional asset managers. There is no possible way that your individual vote as a retail investor in, say, a board election is ever going to swing the outcome. So it's not even worth your time to read all of Tesla's financial reports or mull over the merits of different candidates in particular elections. It's just not worth your time or money because your vote is never going to matter. And so for that reason, most corporate governance issues are still largely under the direct influence of institutional investors. The other reason, by the way, why institutional investors just matter more is that they command orders of magnitude more capital. Remember, the fact that 20 to 30% of trading activity is comprised of by retail traders doesn't mean that 20 to 30% of the money invested in stock markets is held by retail investors. There are large investment firms that don't actively trade on the daily basis. Index funds might be one example of that. But the other reason why is that some of the largest investment funds in the world aren't necessarily just investing in public markets. A good example of this would be private equity, private credit, also hedge funds that invest in a whole range of investment activities that retail investors can't even touch. So you shouldn't exaggerate the influence of retail traders or retail investors in stock prices or in corporate governance. The other thing that you should know about retail traders is, to just put this pretty bluntly, most retail investors are really dumb. And I don't mean this in a personal attack way. I just mean it in the sense that retail investors would objectively, on average, be better off not trying to invest on their own. And there are lots of reasons for this. One of the big reasons is that they're not professionals. They have limited research. They have limited information. It's very hard to beat the market reliably. Think back to Eugene Fama and the efficient market hypothesis. So most retail investors are already starting off in a difficult place, which is it's hard for anyone to actively manage a portfolio that beats the market reliably. But retail traders are not professionals. They don't have expertise. That's already a huge hurt. The second problem is just emotion. Tons of retail traders are trading in very many ways driven by emotion or ideology as opposed to by hard analysis and data. For example, one of the main drivers of many retail traders' portfolios is a sense of sort of anti-elitist ideology. For example, there's a large current of ideology within lots of retail trading communities like Wall Street Bets that retail traders can regain power from large hedge funds by systematically betting against hedge funds. So the most famous example of this, I forget if I put this somewhere on the slides, I guess I didn't, but The most famous example that I can kind of describe here relates to a firm called Melvin Capital. It was a large hedge fund that placed a short position on GameStop. GameStop, the kind of big video game company. The logic of the short position, again, a short just means bet against. If the company's stock price goes down, you make a profit. The logic behind the short strategy adopted by Melvin Capital was, we think that GameStop is failing. The stock price is going to go down. We're going to make a lot of money. What retail investors did is they realized that this was Melvin Capital's decision, or the position that Melvin Capital had taken. And a huge number of retail investors sort of loosely collaborated through Reddit to do what's called a short squeeze. So the way that a short position works, remember, is that you're betting against a stock. So you're betting the stock price will go down. But if the stock price goes up, that means that you lose money. And because the stock price can keep going up and up and up, theoretically, the losses on a short position are infinite, in theory. Or they could be infinite, I should say. So what a bunch of Wall Street Bets investors did, remember, Wall Street Bets is the subreddit. It's not actual Wall Street. What a bunch of WSB retail traders did is they bought up GameStop stock. This pushed the price of GameStop stock way up, and it caused Melvin Capital to face a huge loss on its investment. Melvin Capital actually eventually closed down, not entirely because of that one individual trade, but it certainly did not help. And that's a good example of this quote-unquote stock market populist phenomena, whereby was the GameStop investment a smart bet from an economics point of view? Obviously not. There was no reason, for example, GameStop should have been trading at $400 a share as it did at one point. That's economically baseless. But the reason it happened is because there was a huge belief within retail trading online communities that you could stick it to the hedge funds that are controlling the world by betting against the hedge funds and making them pay. And in the end, it worked in the sense that Melvin Capital went under, but a ton of the people that invested in GameStop lost huge amounts of money because that price increase is not sustainable. Eventually, the price does end up going down. And the consequence is that ideologically driven trading might be nice emotionally in the short term, but tends to be financially ruinous in the long term. That being said, one of the most interesting implications of retail trading relates to this strategy called BTFD, or buy the fucking dip. Buy the fucking dip is basically a philosophy that says whenever a stock price goes down, you should buy it because the stock price is going to go back up. In other words, whenever a company's stock price goes way down, you should buy it because the market is probably overreacting or it's an irrational position as a consequence of hedge fund shorting. What you should do is you should buy the dip, i.e. when the stock price is at its low, because it's going to rebound. In other words, the dip is going to result in a price increase and you're going to make money. And this is a major strategy adopted by many online retail trading platforms and communities. And one of the interesting implications is that it actually makes short-based hedge fund strategies less profitable. So this is a fascinating graph if you think about what it represents. So this is from the Financial Times, and the graph here shows two bars. The first is that line in blue, which basically shows the average price or the average market value of the typical stock in U.S. stock markets, average U.S. equity, in other words. So if you average out sort of the S&P 500 or a range of other market indices, that's sort of what your average stock looks like. And what you have there in sort of pink reddish is a line showing the prices of the most heavily shorted stocks in the stock market, where most heavily shorted means those are the stocks that have the most short positions taken out against them. To be clear, if a lot of short positions are taken out, that means that there are lots of investors out there who expect that stock price to fall. Those often happen, not always, but they often happen to be hedge funds. Part of the reason for that is that lots of other major institutional investment funds, like lots of mutual funds, for example, are legally restricted from using short positions because there's more risk associated with short positions than long positions, because the worst outcome of a long position is you lose everything. The worst outcome of a short position is you lose infinitely much money because the stock price goes up and up and up and up and up more or less forever. Obviously, that's an exaggeration, but the point is that the downside risk of a short is much, much larger than the downside risk of a long position. But the interesting outcome of this graph is if you're a hedge fund that is primarily focused on shorting companies, it is arguably harder than ever before for this to be a winning strategy. Because interestingly, heavily shorted companies, which are supposed to see their price go down quite a lot, actually have seen their prices outperform the average equity markets in the United States over the last 5 years. There are multiple reasons for this, of course. One of them is the buy the fucking dip strategy, which is when you short a stock, that temporarily increases the supply of stock in the market because you've sold the stock, you've borrowed the stock and then sold it into the market, causing the supply of stock available for purchase to increase. That means its price goes down. When retail investors see that and then start buying the dip, that causes demand to go up and causes prices to go up. And so the consequence is that short strategies are increasingly challenging if a bunch of retail investors are just going to buy the dip of the most heavily shorted stocks on the market, which is sort of an interesting challenge to traditional hedge fund investment strategies. So now that we've talked a good bit about hedge funds and the relationship between institutional investors and retail traders, it's worth pivoting into a more proper discussion of institutional traders and what they actually do. So just as a reminder, what we've talked about thus far basically is a very specific type of market called equity markets, and in particular, we talked about public equity markets. There are three other markets we've yet to discuss, and we'll talk about after this section, which are private equity markets, public credit markets, also called bond markets, and private credit markets. Before we talk about those, because we've talked so much now about institutional investors, it's worth taking a detour to say, okay, who's actually investing money in stock markets? Who's actually investing money in bond markets? Who are the people putting money into the stock market, buying bonds, that sort of stuff? Before that, just one brief note about debates over institutional investors. There's a fairly common archetype of motion these days, which basically is this house supports the rise of X type of investor in Y market. So a very common motion, for example, to see would be this house supports the rise of private equity in some industry. Oftentimes, these debates become very messy because there is a lack of clarity about arguments regarding credit expansion versus credit substitution. What this means is there are some cases where the rise of institutional investors putting money in some industry constitutes a net expansion in investment, or whether the rise of some institutional investor investing in some industry trades off with some other investor investing into it. So here's a simple example. Suppose you have a motion like this house supports the rise of private credit. We'll talk about private credit later. There should be a core clash in this debate about what private credit is doing. Private credit might result in credit expansion. That is, there is a subset of borrowers who would not otherwise be able to borrow money from banks or from bond markets, but now can borrow from private credit. And so the debate there is about credit expansion. Is it better to have private credit lending to these companies or no one lending at all? The other type of characterization that could come up is a credit substitution argument that says private credit funds are by and large lending to companies that otherwise would be able to get money, but it's worse or better for private credit to be the ones doing it. Because the alternative is, and then maybe you say, I don't know, the alternative is a bank loan or junk bonds or whatever it happens to be. The important point here is when you debate about the merits of private equity in this industry or private credit in that industry or pension funds investing in this or investing in that, you should be very careful in prep time to think about whether credit expansion or substitution is occurring and which is more strategically advantageous for you to discuss. Is there a net increase in the total amount of money going into some industry or a new category of borrowers or investment targets that's now receiving capital? Or is there a trade-off between some new investment fund or new institutional investor focusing on some industry trading off with some other investor that counterfactually would be doing that investment? So with that caveat out of the way, let's talk about institutional investors. As a reminder, institutional investors have two key features. A, they're investing other people's money. B, they're run by professionals. Two major first types of institutional investors you should know about are pension funds and insurance companies. These are the relatively longer-ish term institutional investors out there. By the way, that might be an interesting way that you could rebut arguments about quarterly capitalism and the obsessive focus on short-term results in stock markets. So what are pension funds? Well, pension funds are probably the investment fund you're the most intuitively familiar with because they're the ones that most people actually interact with. Pension funds are large investment vehicles. They pool money from employers and employees, and in some contexts from governments as well. And they use the money that's paid in by employers and by employees to invest in stuff, stocks, bonds, sometimes riskier things like private equity and hedge funds or private credit. And those investments pay returns to the pension fund, and the pension fund uses the money it's made from its investments to pay retirement benefits. Now, because pension funds are paying pensions, often to workers who won't be retiring for 10, 20, even 30 years, pension funds have to both balance paying current beneficiaries, so people whose pensions are due now, but they also need to have enough invested in long-term assets that will pay out in 10, 20, et cetera years, such that the people who retire in the future but are still promised benefits from the pension fund receive their money back. So what do pension funds do? Well, they manage billions, even trillions of dollars in assets. Depending on what numbers you're looking at, there are literally tens of trillions of dollars managed by pension funds globally. The largest pension funds tend to be public pension funds. Those are ones associated with or run by governments, though the actual people running public pension funds themselves tend to be not political in the sense that they are investment managers or portfolio managers who are making decisions on the basis of maximizing risk-adjusted returns. Pension funds, you might think of as, oh, well, pension funds are investing regular people's money, so pension funds have to be very, very safe. That's kind of a misconception. It's not to say that pension funds are risky, but it's rather to say that pension funds focus on diversification. And one important aspect of diversification, as we talked about earlier, is investing in multiple levels of risk. So public pensions will invest a lot of their money into relatively safe investments like investment-grade bonds. That's, in other words, bonds issued by companies that are considered very creditworthy and unlikely to go bankrupt. They'll invest in some treasury bonds. They'll invest in some stocks of fairly well-reputed and what are called blue chip companies. But public pensions and pensions more broadly will also invest lots of money in what are called alternative assets. So things beyond just stocks, bonds, or cash. That might be private equity. It might be hedge funds. So for example, the largest pension fund in the United States, which is the one run out in California, invests something like $100 billion now into private equity. And the reason why pension funds do that is to sort of give themselves a long-term, potentially higher yield investment that can diversify their portfolio that also consists of long-term safe investments, short-term safe investments, et cetera, et cetera. Insurance companies are another similar-ish type of investment fund. The reason I say similar is because insurance companies are also involved in long-term investments, and for that reason are able to invest in relatively less liquid assets. So for example, private equity might be one illustration. Private credit would be another. Lots of people are confused at first glance why insurance companies are such a huge source of investment. It's not at all intuitive. Like pension funds, it makes sense, right? Workers are giving money to a pension fund. The pension fund uses that money to finance investments. The investments pay returns. And then that is how the pension fund pays out benefits to beneficiaries, i.e. retirees. How do insurance companies invest? Well, think about it like this. Imagine you run a life insurance company, and the whole point of a life insurance company is people are going to take out an insurance policy. They're going to pay monthly premiums to you, small bits of money every month. And then there will be periodic events that require you, the insurance company, to pay out a large amount of money. So in the context of life insurance, it's when someone passes away. In the context of home insurance, maybe it's when there's a natural disaster or some damage that affects the house, and you have to pay money for the repairs, et cetera. In the context of car insurance, you're going to have people that drive cars will pay monthly premiums for their car insurance. And then when they get in an accident and need a repair or a new car, that's what the insurance covers, so on and so forth. But there's an interesting temporal or time-based disconnect between the receipt of premiums and the paying of benefits. So to put that in less technical terms, if you're an insurance company, from day one of the contract going into effect, you're collecting premiums, but you might not be paying out money in the event that some incident occurs, like death or a car crash or a hurricane. That might happen 10, 20, 30, 40, 50 years down the road. Just think about a life insurance policy, for example. If a person in their 30s takes out a life insurance policy that has a duration of, say, 30 years, you as the insurance company agree that if this person dies within that 30-year period, you'll pay out a large sum of money. But that might not happen. And if it does happen, it might happen in 25, 28 years, whatever. You have many years of premiums just piling up. Now, theoretically, one thing that you could do as an insurance company is you could just hold on to all the cash, or you could invest it in super risk-free, highly liquid assets like treasury bonds. But Realistically, if you're an insurance company, you can make a fairly reasonable bet, which is it's unlikely that all of these events are going to happen in the short term. And as a consequence, you as the insurance company can actually make a profit by doing what's called investing the float. That is, take the premiums you get and invest them in markets before you have to pay out claims. That way, not only by the time you get the investment returns back, you'll have enough money to pay out the claims, you'll actually make a profit on the investment. So, for example, if you invest your money and you make a 10% return, I'm just making that number up, and when you subtract away all of the money that you have to pay out to claims, i.e., invoked insurance contracts, maybe that constitutes 5% of the profits. You've made a net profit on the whole. And for that reason, you as an insurance company can make quite a bit of money by investing the float. Now, because insurance companies are sort of have such long-term time horizons, insurance companies have to balance both between the need for, we might have a sudden sharp uptick in people suddenly needing their policy to be paid out now, like a natural disaster, but you also need to care about long-term returns on the insurance fund, because if you're an insurance company, most of the contracts that you've signed are typically decades-long contracts. Now, to be clear, there's two different types of insurance. There's property and casualty insurance, and there's also separately life insurance. Life insurance comprises the majority of investment from insurance companies, but P&C plays some role as well. The reason why pension funds and insurance companies are worth thinking about in debate is because they constitute patient capital, which is just to say that they are relatively less focused on immediate short-term returns in comparison to stable diversification over the course of years or even decades. If you wanted to contest that characterization, probably the easiest way to do it would be to point out that although the fund itself has a long-term time horizon, for example, the horizon for a pension fund might be a 30-year payout, the people who run these funds and make the investment decisions, their compensation is typically performance-based, so they get paid more money in the form of bonuses when their investments do well. But most of the time, your compensation in the bonuses that you receive are tied to performance in the relative short to medium term. So, for example, imagine that you're running some investments for a pension fund, and they say, hey, we're going to give you a bonus if in 30 years your investments work out. Well, there are lots of risks associated with that. The most obvious one being you're going to lose a lot of talented employees who say, fuck this, I can get a better bonus package if I work at Goldman down the street, who's going to pay me bonuses every quarter based on the performance of my investments in much shorter term assets. So although pension funds themselves might have long-term time horizons, the people that manage their capital still have relatively short to medium term incentives because that's what their bonus ultimately is based upon. Two trends that are worth noting about pension funds and insurance companies. One is that pension funds are increasingly investing in what are called alternative assets. So things beyond, for example, just stocks, bonds, cash. That includes private equity. The other major thing it includes is is real estate, and to some extent hedge funds as well. Lots of people get kind of scared about that. I'll talk about that argument in a moment. But part of the reason for this, i.e. the causal explanation for why pension funds are shifting towards investments like hedge funds or private equity, is because investments in riskier assets, yeah, they have a higher risk of default. For example, the investment might not pay out, but they also have much higher returns. In particular, they have something called higher alpha. Alpha is a Greek letter, and what it means in the context of finance is the return on some investment relative to some risk-related benchmark. So what that means is you typically don't measure returns in finance in absolute terms. Like, well, this investment grew by 16%. Because maybe your investment grew by 16%, but maybe everything in the stock market grew by 22% on average. 16% sounds great when you say it like that. We made a 16% profit. But if you would have made a 22% profit by just buying the S&P 500, in other words, the 500 major stocks established by S&P, well, you've kind of made an implicit loss because you invested in something when there was a much better investment opportunity available. So alpha is a statistical measure of returns relative to some underlying benchmark. The reason why there's not a universal benchmark is because there are differences in risk strategies. For example, investing in the S&P 500 entails some degree of risk, but it entails much more risk than just investing in treasury bonds, which are basically risk-free. The other trend that you should be familiar with relates to insurance companies. I'll talk about this more when I talk about the mechanics of private credit, but one of the largest sources of investment for private credit firms, which by the way also have a pretty major role in AI capex or capital expenditures, particularly AI data centers, one of the largest sources increasingly for private credit is insurance companies. Also, by the way, pension funds. So both insurance companies and pension funds have invested billions, hundreds of billions of dollars, in fact, into private credit. One of the major reasons for this, beyond the fact that private credit can offer higher yields, in other words, returns, is the fact that private credit is a fairly illiquid investment. It's hard to pull out of a private credit fund within the span of just a few years. Your money is typically locked up for 5, 8, maybe 10, even longer number of years. That's fine if you're an insurance company. That's fine if you're a pension fund because your time horizon is fairly long. So other major institutional investors might have shorter term horizons. For example, some institutional investor might take money from a bunch of investors and have to give it back to them in 3 years. In that case, private credit's not a great investment for you because private credit takes a lot longer to return a profit. But if you're an insurance company, you might be willing to quote unquote invest, as the phrase goes, invest the float into private credit. The next set of institutional investors that you should be familiar with are the asset managers out there. And technically, all of these are asset managers because they're managing assets, but these are the ones that are the most important when it comes to the term asset management, capitalism, which we'll talk about in a second. So what are these? Well, mutual funds are a type of investment fund that is just pooling money from the public. That might mean investors, that might mean pension funds, that might mean insurance companies. And mutual funds borrow or get all of this money, basically, and they then use all of that money to buy just a bunch of securities. So stocks, bonds, money market, debt instruments, whatever it happens to be. Now, what's very important to understand about mutual funds is that they're actively managed. And what that basically means is the people running mutual funds are determining, okay, these are the stocks that we think are going to go up in value. These are the bonds that we think are safe investments. These are the repurchase agreements that we think are good bets. And there's a team of portfolio managers that are determining how to invest the money. Now, a potential thing that you might say is like, wait a second, I'm confused. Doesn't the same thing happen at insurance companies or at pension funds? That's true. But most of what a pension fund is doing, yeah, it might involve some picking and selecting of individual stocks or picking and selecting of individual bonds. But the more common way that a pension fund, for example, is going to invest, rather than having a huge team that's determining which individual stocks to sell, it'll put money into a mutual fund and say, hey, you portfolio managers of the mutual fund, you guys know what you're doing. Pick and buy a bunch of good stocks and make money on the funds that we happen to give to you. So a mutual fund is basically just an investment vehicle that takes a lot of money from investors, whether those are retail investors or institutional investors, and then invests them in some basket of liquid securities, things that can be bought and sold. Now, a fair question you might ask is like, okay, why do mutual funds need to invest in liquid things? By liquid, again, it just means easy to turn into cash without a major effect on price. Stocks, bonds would be good examples of this. Bonds that can trade in secondary markets, that is, that you can resell to other investors, like investment grade corporate bonds or treasury bonds. Those would be liquid bonds, for instance. A fair question is like, why do they have to be liquid? The main reason why is that mutual funds are required to be redeemable. What that basically means is that you can buy into the mutual fund, but you can also sell out of the mutual fund. And the consequence of that is that mutual funds need to be able to provide liquidity to investors that want to pull out of the fund. That's very different from other types of funds. So if you're a pension fund, for instance, you're paying benefits at a fixed schedule. And if people demand their pension early, there's lots of penalties associated with that. If you're a hedge fund, you're going to take money from investors and it's locked up for a period of years. Same is true for private equity. Same is true for private credit. If you put money into a private equity fund as an accredited investor, it's not going to get back to you for 5, 7, maybe even 8 or 10 years. Sometimes potentially even longer. Same is typically true for hedge funds, though typically a little bit shorter. Mutual funds are more liquid in the sense that you can buy into and out of the fund. The consequence of that is that mutual funds are very major active participants in liquid secondary markets for things like stocks and bonds. The money market we'll talk about in a bit, because they need to be buying and selling things that can also be sold relatively easily, relatively speedily, and with a relatively small price impact. The consequence of that is that mutual funds, because they're actively managed and because they invest in liquid markets, play a huge role in price discovery. They play a really important role in determining which stocks are overvalued or undervalued, which companies are good investments or bad investments. And they therefore play a major role in affecting the demand for and supply of assets in markets, which in turn affects price. Now, index and exchange traded funds are a type of mutual fund with a key distinction, which is that they are passively managed. The way that an index fund works is you just buy all of the stocks in a particular index. So for example, the S&P 500, that's just an index. It's a collection of stocks. So an index fund that tracks the S&P 500 is just an index fund that invests in those stocks. And consequently, the performance of the index fund is just tracking the performance of the underlying index. That's all an index fund is. So here's a simple example to make things a little bit more straightforward. Imagine that, for instance, there are 10 stocks that you think are really good, and you say those 10 stocks constitute the Ryan index. You could create a Ryan index fund that is just investing into those 10 stocks. When those 10 stocks go up, the value of the fund goes up. When those 10 stocks go down, so too does the value of the fund. Exchange-traded funds work very, very similarly to this. The difference between index and exchange-traded funds is very technical and narrow, which is about when they can be bought and sold. An index fund you can buy into and sell out of once a day. So in other words, you can buy into an index fund or sell your share in the index fund once a day at the end of trading. Exchange-traded funds change throughout the day. So the major distinction between an exchange-traded and index fund is an exchange-traded fund involves greater variance in price throughout the day because you can buy and sell your shares in the index fund. Just to be clear about what's happening under the hood, as a reminder, in mutual index and exchange traded funds, the way that these funds get money is they allow investors to buy into the fund. And when you buy into the fund, that literally means you give money to the fund, you now own a share of the fund, and the mutual fund, the index fund, the managers of these firms, then invest your money into the underlying index. Consequently, your money is invested into the underlying assets. When the underlying assets go up, you can sell your share in the fund and then make a profit. If the underlying index goes down, or if the underlying investments in the mutual fund go down, you can sell your share in the fund and you can subsequently incur a loss. The distinction here between a mutual fund or an index fund or an exchange traded fund and something like a bank, for example, that's quite important to remember, is that the losses that are incurred in these funds, they're not the loss of the fund itself. They're losses that are borne by the people that put their money into the fund. So just to give an example of that, BlackRock runs a bunch of index funds. Let's say that BlackRock runs a fund that tracks a bunch of large tech companies. That index fund is an opportunity for investors to invest in an index that represents basically the health of the tech sector. What happens if the prices of those tech stocks go down? BlackRock doesn't suffer a loss. The index that BlackRock is managing loses money, and those losses are passed on to the investors that invested in the index fund. But just to be clear, there's a difference between, for example, what a bank is doing, where a bank is taking depositors' money and then investing the money as the bank sees fit, and then the bank still owes you the same amount of money that you gave it. That's very different from a mutual fund or an index fund, where you're buying into the fund, and then the underlying performance of the fund's investments are proportional to the amount that your share in the fund is worth. The last thing that you should remember about these three types of funds before we talk about asset management capitalism and the rise of the big three is because mutual index and exchange traded funds prioritize liquidity, they can't invest in very illiquid assets. That's why, for example, you wouldn't see an index fund invest in private equity, or why you wouldn't see mutual funds invest in a hedge fund or invest in long-term real estate or infrastructure projects, because these are funds that have to be able to sell what they own in order to meet redemption requests. That brings us to the concept of asset manager capitalism. There are three major index/exchange traded funds out there, in other words, passively managed mutual funds, called BlackRock, Vanguard, and State Street. And they collectively own an enormous amount of the stock market, particularly in the United States, but also globally. This trend applies to places like the UK, most of continental Europe, some places in emerging markets. India is an example, for instance, etc. So what do these three companies do? They offer a bunch of exchange-traded funds, they offer a bunch of index funds, and they manage trillions upon trillions of dollars in wealth. BlackRock is the largest. It manages something like well over $10 trillion. Again, it's worth remembering that doesn't mean that BlackRock itself has $10 million that it gets to determine what to do with. That means that BlackRock runs funds that $10 trillion worth of investors have decided are good indices to track, and the quality of those indices, the prices, in other words, of the underlying stocks, determines the value of those funds. But what these three firms have done is they've basically set up these funds that invest in huge amounts of the stock market in the form of indices. The S&P 500 would happen to be one example. And you can just see graphically here on the right the rise of asset managers. And you can also sort of see, here's the cover from Bloomberg, for instance, how this has been received. This is so-called asset manager capitalism, total world domination. John Coates from Harvard back in 2018 wrote a very famous article that you should read that sort of famously describes the quote-unquote problem of 12. That's the name of the article. And the problem of 12, as Coates describes it, is there will be a day where control of the world's most powerful and influential companies is basically decided by a handful, maybe a dozen people, i.e. the people that run BlackRock, Vanguard, and State Street. Now, it's worth noting that arguably, the term Big Three, which refers to those three, is a little bit of a misnomer. Fidelity is a fourth very large passive mutual fund. Fidelity is a bit different because Fidelity has a long history of running actively managed mutual funds. Remember, the difference between a passive and active mutual fund is whether or not there is a portfolio manager that's actively deciding whether to buy and sell stocks based on performance and the quality of the company. A passively managed fund doesn't do that. It just buys the index. A actively managed fund is actively buying and selling and moving in and out of different positions. Fidelity is a longer history of running active funds, but it also now provides a whole range of exchange-traded funds, mutual funds that are passively managed, including index funds. And Fidelity itself now is roughly comparable in size to State Street. So you could arguably say it's the big four asset managers, not just the big three. There's lots of evidence for, and like lots of empirical research for why the quote unquote giant three have grown so large. One reason is just that in general, ownership of the stock market has become increasingly concentrated in the hands of institutional investors, as opposed to, say, high net worth individuals or banks. And the consequence of that is just that institutional investors own more and more of the stock market. And within the subset of institutional investors, it happens to be the case that more and more money has flown into index funds and exchange-traded funds. A fair question you might ask is why? Why are investors like pension funds, pension funds, insurance companies, even just regular retail traders, et cetera, why are they putting so much money into index funds? Well, there's kind of two reasons. One reason is they're super cheap. Because you don't need to pay a bunch of snotty Wall Street portfolio managers to pick and sell stocks and do all this research, it's a lot cheaper to run an index fund than it is to run an actively managed mutual fund. Cheaper means lower fees. That means more money for investors. The other reason why people are drawn to index funds, though, is sort of the efficient market hypothesis. It's really empirically hard to find compelling evidence that actively managed mutual funds offer better returns to investors compared to passively managed funds. So if you're an investor and you're just looking to make a stable return, you might very well be better off just investing into an index fund that tracks the stock market as opposed to having some Wall Street portfolio manager try to manage your funds. Endpoint is huge increase in institutional ownership of corporations via the stock market. Within institutional ownership, there's been a huge allocation of funding towards index and exchange traded funds. In other words, passive asset managers like BlackRock, State Street, and Vanguard. Now, the other related question that you might potentially ask is, okay, it makes sense that index funds have grown really large, but why three? Why aren't there 17 big index funds out there? In fact, it seems intuitive that you could very easily have anyone set up an index fund. Why aren't there dozens of these index fund operators out there? And in fairness, there are, but why are three of them so dominant? Arguably four. There's a couple of factors. The first factor is just economies of scale. There are some costs associated with operating an index fund, and the more people that invest in your index fund, the more people there are to distribute those fixed costs across, which means that fees are lower when you have tons of people buying your index funds. The consequence is that it's cheaper for a small number of asset managers to run all of these index funds because the fees that investors have to pay becomes much, much lower. That makes trading relatively cheaper. The other reason relates to liquidity. An exchange-traded fund or an index fund, remember, is just buying into and out of a fund. It's much easier to buy into and out of a fund, particularly in the exchange-traded context where trading is happening every day, and do so when there's another buyer or seller in the market, when everyone is working with the same underlying asset managers. Imagine, for example, if there were 18 different asset managers that offered S&P 500 index trackers. Well, in that case, there will be lots of people who want to invest in the S&P 500 by just buying the index fund. But if they're distributed across 18 different funds managed by 18 different asset managers, well, when it comes time for you to sell out of the fund, for example, there's less likely to be a buyer at that moment in time who's looking to buy into the fund. And that means that there's less liquidity in the market. There's going to be a greater fee, i.e. bid-ask spread associated with buying into or out of the fund. That also raises trading costs. And the final reason is just it's really hard to break into the index fund market as an upstart, because if you're a dominant player like BlackRock, whatever any competitor does to try to swoop investors in, for example, if some competitor says, I found a new collection of companies that constitutes a great index to track, and I'm going to offer an index fund, BlackRock can copy you in 2 seconds, and they're going to take all the funds because they've got a first mover advantage. So that's why there's been a huge rise in index funds. And within the rise of index funds, there's been a huge rise in consolidation towards 3 or 4 asset managers dominating capital allocation. By the way, a fairly major argument that you should be familiar with against passively managed investment funds like index funds is price discovery concerns. The argument goes like this. The purpose of a stock market is for a bunch of people to invest money in the market and try to figure out what companies are worth. And people will buy and sell, and they'll haggle, and they'll disagree, and they'll argue, and they'll research. And eventually, in this kind of messy wisdom of the crowd's marketplace of ideas type process, the price of a stock is eventually going to represent the true value of a company. But in order for that to work, we need people to be buying and selling stocks based on the fundamental value of the company, not whether they happen to be included in some index. For example, imagine the S&P 500 expanded to become the S&P 501. They added one other company. If that company gets added, it's going to see a huge increase in demand for its stock. Why? Well, because tons of people love to invest in the S&P 500 index funds that BlackRock and State Street and Vanguard offer. So if that additional company gets added, it's going to see its stock price go up. Simple supply demand. The stock price is going to increase as a consequence of increased demand for the stock because it's in the index, and as a consequence, its value increases. But that doesn't reflect any improvement in the company's value. There's been no shift in the company's management quality or future profitability or the discounted present value of future dividends. The company just happens to be included in an index. So arguably, the rise of index funds undermines price discovery in stock markets because stock prices don't reflect the actual value of a company. They just reflect which index they happen to be listed in. And as a consequence, because so much money is invested in index funds, that's where a lot of money is being allocated. That being said, there's a pretty fair pushback against this that most index funds or asset managers would cite, which is, look, something like 95% of trading is not being done by index funds. And the reason why that matters is that there's a huge amount of trading that still goes on outside the context of asset managers that sort of determines the price of these assets. And there's also, of course, a natural self-corrective mechanism at play, which is if a company is added to an index and its stock price goes up because the index fund is now buying that stock, other investors will realize, hey, this company is overvalued. It's not really worth that much. And eventually, markets are going to pick up on that, all short it. And as a consequence, that creates a self-fulfilling prophecy whereby supply of the stock goes up, price goes down, and markets eventually self-correct. Now, let's talk about the major criticisms of asset managers. There's a bit of an irony, which is that there are 2 major criticisms of asset manager consolidation, but they sort of run in opposite directions of each other. So the first argument you'll hear against asset manager concentration, the idea that there are 3 or 4 big asset managers that own huge amounts of the stock market, is about collusion. So here's a simple illustration of the argument. Imagine that 3 or 4 large asset managers own huge stakes in every major ice cream company. Now, in theory, if this wasn't the case, what each ice cream company would do in order to try to make profits is they would try to undercut their competitors by offering progressively cheaper and cheaper prices to woo customers to their direction. That's, in theory, what capitalism and competition is about. Competition drives prices down and drives quality up and produces innovation. But imagine for a moment that you are an asset manager or a collection of asset managers that owns all of these ice cream companies. When these companies engage in a bidding war, do you profit? Well, think about what happens. Imagine a simple model. There are 2 ice cream companies in the world, Haagen-Dazs and Ben & Jerry's. Let's just take a simple example. Ben & Jerry's says, we're going to cut our prices. So more people start buying Ben and Jerry's ice cream, fewer people buy Haagen-Dazs ice cream. There's a small increase in the stock price of Ben and Jerry's. There's a large decrease in the stock price of Haagen-Dazs. Do you, as the asset managers, benefit from this? No, because from your point of view, you have not internalized any net gain. The benefit to one company, Ben and Jerry's, is either mitigated by or offset by the loss to another company, Haagen-Dazs. And to the extent that you as an asset management fund make money by seeing the stock prices of your indices go up, because that's what attracts investors to invest in the index fund, and that's in turn what allows you to collect a small fee from each investment, you actually suffer from this because the value of the index is now less valuable. That means that investors are less inclined to invest in the fund. That means that you get fewer fees as the asset management firm. So if you're an asset manager, in theory, if you have ownership stakes in every major company in a particular industry, it is in your incentive to encourage or even demand anti-competitive behavior. In other words, price wars are not good for you. Profit margin hikes caused by higher prices are good for you because that increases profits across the industry and in turn allows for the stock prices of all of the firms that you own to go up. So, for example, there's one interesting paper on this that was published back in 2014 that you can read that looks at this in the context of airline companies. And what the paper basically finds is that increasing common ownership of major airline companies results in something like a 5 to 7% increase in ticket prices. And the authors look at a bunch of other potential variables that might explain it. And their conclusion, you can disagree with it, or there's lots of questions about the technical validity of the paper. But the conclusion they take away is that when a small number of investors own many airline companies, it's in their incentive for the airline companies to tacitly collude to raise prices, to increase profits, to increase the value of all of their shares collectively in a way that is anti-competitive but profitable for the asset manager. Now, a fair question that you might ask is, how would asset managers do this? Like, imagine for a moment that you're BlackRock and you're like, great, we own shares in both Haagen-Dazs and Ben and Jerry's. We want both of these two companies to raise their prices. How are you going to do this? Well, one thing that you could just outright do is like, you could just literally go to the board meetings and be like, you will raise your prices. This doesn't happen, both because these companies, i.e. asset managers, don't own majority stakes in these companies, so they can't just dictate corporate behavior. I'll talk about that on the next slide. But the other reason is because that would be explicitly anti-competitive, explicitly illegal. It would prompt a huge antitrust investigation. It would probably be blocked by the courts. So the real ways that you would do this would be a couple of things. One would be there's what's called engagement. Engagement is sort of what it sounds like, which is just people that work at asset management funds will, as a matter of policy, meet with the executives and corporate boards of the companies that they invest in. And those engagements have a pretty major, or could have a pretty major effect on what companies end up doing. Because if you're the CEO of a company or on the corporate board of a company, and you're meeting with the head of BlackRock, or if you're working with a State Street advisor, you sort of have to be aware of the fact that these guys own a huge ownership stake in your company. And you also know that they would benefit from you raising prices. And so those engagements and kind of behind the scenes interactions, they influence corporate behavior not through voting mechanisms, but just through implicit social mechanisms, like asset managers implicitly encouraging firms to behave in anti-competitive ways. And there's some evidence of that you can look at. One interesting example of this, it's a really cool paper. I'd recommend you read it. A series of authors wrote it last year. The paper basically looks at political donations from companies after they become acquired in part, or like a minority ownership stake is taken out by index firms. And what they basically find is when index funds expand their indices, so in other words, when new firms suddenly get investment from index or asset managers, what ends up happening, interestingly, is that the candidates that companies donate money to more closely mirrors the political views of the large asset manager that now owns 5 to 10 to 15% of the company's shares. And that might be some evidence that this implicit engagement between corporate leadership of companies on the stock market and the folks who run asset management firms can result in this kind of tacitly anti-competitive behavior, or asset managers' goals and priorities rubbing off on the people who run companies. There are also harder mechanisms by which asset managers have control over companies. One is pivotal votes. So pivotal votes basically means lots of what corporate boards do isn't controversial. Like most corporate votes are unanimous, but there are some corporate votes, corporate board votes, or shareholder votes that are highly, highly contentious, where there's a split between different shareholders on the basis of liquidity, on the basis of time horizons, et cetera. So an example of this would be, should we sell the company? Should we allow a merger and acquisition? Or should we oust the current corporate board and impose new leadership? Those are pretty controversial decisions, and they often result in split votes. In those cases, asset managers might only own 5 or 10% of a company, but that 5 or 10% matters a lot, because that basically swings the outcome of shareholder elections, for example, for corporate board positions or executive positions. And so in that sense, asset managers do have influence over corporate policy in a way that they can leverage to potentially encourage anti-competitive behavior. Now, for anyone who says, oh, this is, all bullshit, asset managers don't do this, it's not really in their interest to, there are some cases where asset managers very clearly do encourage all companies in a particular industry to do something that asset managers like. So I'll talk about this a little bit more later in the presentation, but the rise of sort of cross-industry governance standards is very much related to the rise of asset management funds. If you're an asset manager and you have particular ESG concerns that you want to standardize across an industry, even though the E and S in ESG has sort of fallen out of favor, particularly in the era of Trump, if you want to impose governance reforms, you as an asset manager can do that across all of the firms in your portfolio, and you have lots of hard mechanisms to do so. One of them is policy signaling, where if you're an asset management fund and you give a public speech or issue a public document that says, these are the sort of standards for governance or compensation packages that we think are productive for long-term growth, that there's a pretty high probability that will get incorporated into what corporations are doing, given the amount of power that asset managers have. So just to clarify, the first argument that's made against asset management consolidation is that asset managers leverage their power to encourage anti-competitive behavior. There is a second argument against asset management consolidation that's not directly contradictory to that, but is implicitly in tension. And this argument basically says the opposite. Asset managers are lazy as fuck. And that's not exactly correct, but the argument in its more technical rendition says the big issue with asset managers is that they don't actually have any reason to care about what companies are doing. Think about it. If you're an asset manager, why would you have any interest in improving the quality of what the companies that you've invested in do? If you're the asset manager fund, it's going to take you a lot of time and a lot of money to research the companies that you've invested in, figure out what's going wrong, figure out how to improve them. And you're going to have to hire lawyers and accountants and investment bankers and financial auditors. That's going to take time and it's going to take money, and there's lots of legal risks involved. And then you're going to have to petition corporate boards to implement particular changes. You're going to have to research the candidates that are running in particular elections. All of this is costly. What is the benefit to the asset management fund? Imagine you're BlackRock and you're thinking about doing that for some company in an index that you've invested in. What benefit do you get? Well, the benefit would be you do all of this governance research, you figure out how to make the company more profitable, you go to the corporate board, you try to leverage your power, these engagements, pivotal votes, policy signaling, you try to get the company to agree to your particular requests. What ends up happening? Maybe the company agrees. They say, great idea. Your proposals for how to make our company better are a great idea. We'll implement them. And suppose the company's stock price doubles as a consequence because it is so much more profitable. If you're the asset manager, how much do you benefit? Well, remember, the asset manager, again, to be clear, doesn't personally benefit when the stock price goes up, because the people that have invested in the index fund are the people who benefit from the increase in the stock price. The way that you as the asset management fund benefit is more people invest in the index fund. That's where you generate fees. So an increase in stock prices might in theory make the index more attractive to invest in, which might in turn increase the number of people investing into the index fund, which in turn generates fee revenues for you. But there's a problem, which is this. If you have, just take a simple example, a 300 firm index. If you do all of this time and due diligence to figure out how to make one company better, and it costs you $5, $10, $15 million, and then 1 in 300 companies in your portfolio becomes twice as rich. Well, the value of the index isn't doubling. The value in the index is going up by twice the price of 1/300th of the index value. And then that's going to have a very negligible effect on whether or not investors who haven't yet invested in the index fund decide, oh, your index fund is a really great one to invest in, and as a consequence, generate fee revenue. So if you're an asset management fund, your incentive, frankly, is to be lazy, to underinvest in corporate stewardship, to figure out what companies are doing right and wrong and adjust accordingly. And so the argument against asset management consolidation is actually the opposite, which is asset management, i.e. passive mutual funds, reduces the quality of corporate governance because it allows managers to live quiet lives. They can just quietly raise prices, not compete as hard, not push for advanced innovations or product improvements, because typically in a typical corporation, if you as an executive or corporate board slacked off, you'd be punished, you'd be fired, your shareholders would be furious. But if you're an asset management fund, you don't have any sort of ability to easily sell off all of your shares in a company because that's not what you're in the business of doing. You're not an actively managed fund. You're just tracking an index. And you're not in the business of being an activist shareholder, i.e. petitioning companies to fundamentally change their policies, because that's costly and doesn't increase revenues by a large enough margin to outweigh the costs of stewardship. And so the outcome of that might be price hikes because managers are just lazy and the easiest way to increase profits temporarily is to raise prices. But it also just results in worsened corporate governance because if asset managers own 25%, 30% of the stock market, but they're not using their votes in a way that's productive, they're just going to end up voting for whatever the existing managers propose and not do proper research and proper monitoring in a way that results in less innovation, less growth, lower wage increases, so on and so forth. That being said, the first argument and the second argument that I've just outlined are implicitly in tension. So there's a couple of ways that you could make arguments either way. One argument, for example, that you could say as to why the first argument's not a concern. That first argument is the argument that says, well, asset managers have lots of incentives to be anti-competitive and to encourage price gouging. There's lots of reasons why that might not happen. One simple reason is just that asset managers very rarely own more than 5%, maybe 10% of a company's stock. And even if the big three collectively own 30%, the big three or the big four, if you include Fidelity, are different funds. They have different priorities, different aims, different interests. They'll disagree on the quality of corporate governance. They won't all agree on the particular pathway forward. So you're not really talking about the big three as a monolith. You're talking about them as distinct firms with distinct ownership structures, distinct time horizons, and so forth. By the way, the reason asset managers rarely own more than 5 or 10%, in case that's not clear, one is a legal reason. If you own a large ownership or a controlling stake ownership in a firm, it's much harder to buy and sell stocks freely because it's more likely to be deemed insider trading. So there are regulatory limits on the ability to buy and sell once you have a controlling stake. The other reason is just if you're an index fund manager, remember, you're not investing based on what you think is a good investment. You're just investing in the entire index. So it's implausible that you'd ever end up owning more than 5 or 10% of a particular company. The other reason on top of this is that the whole point of an index fund is to be diversified. You're not trying to have a 50% ownership stake in a company. You're trying to have a 5, 10% stake in very many companies, such as to access the benefits of diversification. The final argument you might make for why asset managers don't pursue explicitly anti-competitive outcomes beyond the returns are limited argument is just the staffing constraint. Vanguard, as of today, I looked the other day, has something like, or at least they say publicly, they have something like 20,000 employees, which is, a lot. 20,000 people working for Vanguard, pretty large number. But Vanguard is invested in thousands upon thousands of companies, and doing proper due diligence and monitoring on thousands and thousands of companies, or even just, a few hundred of them, that requires huge, huge teams of accountants, lawyers, investment bankers, analysts, and so forth. As well as relevant domain expertise in those areas. So if you want to figure out how to make an airline company better, you might want to bring in airline experts or people who have relevant expertise in managing airline companies. If you want to improve a petrochemical company, the same might be true in that context. If you're an asset manager fund, you just don't have the human capital or personnel to be micromanaging all of these firms. It's simply not within your domain expertise, not within your labor capacity. If you want to make the argument that nonetheless, asset managers do still have influence and have the incentive to influence corporate behavior, there's two things that you might say. One is the whatever in here is the third point under defense, which is if you're an asset manager, you might not care about what one individual company does, but you do care about what all companies in a particular industry do, because you can leverage your power to influence market-wide or industry-wide norms. The other reason that asset managers do matter is because they don't need to necessarily control outcomes through votes. They can still heavily influence outcomes at corporate board meetings or votes by public statements and by pivotal votes, for example, on issues like proxy battles or mergers. And to the extent that they can increase profits, even marginally, the asset management fund that then still does profit as a consequence in a way that is fairly useful. So that's the rise of asset management capitalism and its consequences for price discovery and corporate governance. Next and last major institutional investor to talk about is hedge funds. So hedge funds are probably the most notorious of the institutional investors. Part of it is because this is sort of where the Wolf of Wall Street type mantra comes from, relatedly investment banking, but hedge funds in particular. And hedge funds are, of course, notorious in the sense that they are very opaque, highly leveraged investment funds that, unlike all of the ones that we've talked about thus far, are really only available to very wealthy investors, in the sense that pension funds, whose money are they managing? Middle class workers who are saving for retirement. Insurance companies, they're providing insurance contracts, yeah, to big companies, but also to regular people who have life insurance policies, for example. Mutual funds, index funds, exchange-traded funds are more accessible than ever before in the age of low-fee brokerages like Robinhood and the huge rise in retail trading. But hedge funds are unique because hedge funds are very difficult to invest in directly if you don't happen to yourself be rich. And the main reason for this is a legal one, which is it is not permitted for someone to invest in a hedge fund unless they're an accredited investor. An accredited investor is either a high net worth individual, someone whose net worth is greater than $1 million, or some institutional investor that's managing more than $5 million in assets. Hedge funds have a very unique and sort of unusual legal structure. They're structured typically as private partnerships, which means that they take money from what are called limited partners, they're investors, and they basically then manage that money for a period of some number of years. But importantly, because they're only taking money from accredited investors, they're very lightly regulated. They're more regulated today than they were 20 years ago as a consequence of the great financial crisis and the role of hedge funds, for example, in the subprime mortgage spree. That's partially why there's more SEC regulations on hedge funds than in the past. That being said, hedge funds are largely unregulated for the intuitive reason that they're not in the business of directly managing retail traders' money. And so for that reason, there's no reason for them, or on that basis, there's no reason for the government to be micromanaging what hedge funds can and cannot do. It's a sort of libertarian paradise down in Greenwich, Connecticut. I say that somewhat euphemistically and not literally, but there is some truth in that statement. The reason why hedge funds, I said, are unusual is not necessarily because it's weird to take money and invest it. They're unusual in the sense of how they invest. So if you look at mutual funds or index funds or exchange-traded funds, they have very predictable and easily monitored investment strategies. They invest in, for example, stocks and bonds. They might invest in money market instruments. They might invest in some unusual cases in some more exotic assets, maybe think crypto, although that's quite rare. Hedge funds invest in just about anything with just about any instrument available. They'll use derivatives, they'll short, they'll take highly bespoke contracts, they'll invent entire instruments outright. The other important thing about what hedge funds will do with their investment strategies is rely heavily on borrowed money to amplify returns. So remember, we talked earlier about leverage and its role in derivatives. Leverage is critical to hedge funds because hedge funds use lots and lots of borrowed money to lever up their returns. So rather than just investing, say, just the money given to them by their limited partners, i.e. their investors, they can also use borrowed money to maximize returns. And they do so, of course, through actively managed and very complicated trading strategies. I've listed just a couple of them here. Bridgewater is very famous for its sort of global macroeconomic trading strategies. There are firms that are called multi-strategy, like Citadel, where you have multiple different funds that are running different strategies focused on different markets or sectors or asset classes. There's this thing called convergence trading that long-term capital management was very famous for, where you basically identify slight price deviations between different securities and bet that those prices will converge. Famously, the reason that long-term capital management failed is because they bet that certain assets would converge on prices when in fact they diverged after the 1998 August Russian financial crisis. Lots of other strategies out there, lots of forms of arbitrage. Convertible arbitrage relates to these instruments called convertible instruments. There are lots of firms that focus on very specific types of quantitative arbitrage. So, for example, D.E. Shaw and slightly different, but Jane Street are very quant-heavy or quantitatively driven hedge funds that use lots of data analytics to figure out investment strategies for identifying inefficiencies in markets. The point is, hedge funds are complicated. They're relatively not transparent. They provide very little information to the public, and they're also very illiquid. They lock up investors' money for a good period of time. All of this is not super important to know for debate. The one thing that I think can be useful to understand about hedge funds that can sort of give you an advantage over other teams and other debaters is to understand what hedge funds are trying to do. Hedge funds are not in the business, per se, of just trying to beat the market, which sounds confusing at first because it implies that they're trying to not beat the market, which isn't true. Rather, hedge funds focus on absolute returns as opposed to relative returns. Here's a simple example. Suppose in a given year, the stock market loses 10% on average. A fund that loses 5% of its investment technically has beat the market because it only lost 5% and the market lost 10%. That's technically better. But a hedge fund will focus on absolute returns. The purpose of a hedge fund is to always make money independent of market conditions. So earlier I referenced the concept of alpha, which basically is returns above market returns or returns above some comparable benchmark like the S&P 500. Hedge funds are both trying to generate alpha above market returns while also minimizing beta, which basically means correlation with the market. And so what a hedge fund is more or less trying to do is always be profitable even when markets are in a period of economic downturn. So, for example, if you had to make the case for why it's good that pension funds invest in hedge funds, as they do in the status quo, you wouldn't contest the fact that hedge funds pursue very complicated, leveraged, risky trade strategies. That's fair. The argument in favor of investing in hedge funds from the point of view, say, of a pension fund would be hedge funds are striving to minimize correlation with the market, which means investments in hedge funds are a very effective way to diversify because the purpose of a hedge fund is to maximize absolute returns as opposed to just maximizing alpha. And so there's actually a lot of like empirical research on what hedge funds are in the business of doing. And there's a pretty well-established finding, which is hedge funds aren't great at reliably beating the market in good years, but one of the things that hedge funds are pretty good at doing is outperforming the market and even sometimes offering positive returns during market downturns. So here, for example, is a chart of 5 fairly recent downturns in stock markets or equity markets. So the first is the Great Financial Crisis back in 2007 and 2008. The second is the sort of bursting of the dot-com bubble back in the early 2000s. The third is all of the concerns that arose vis-a-vis stagflation after the Russian invasion of Ukraine. The fourth is sort of the period around weakness in Asian markets, and in particular triggered by the Gulf War when Saddam Hussein invaded Kuwait back in 1990. And the fifth, most famously, of course, is COVID-19 and the pandemic. And what that first sort of blue-purple bar shows is the effect on equity markets. It basically shows a weighted basket of stocks globally and the beating that they took. So, for example, back in the financial crisis, you can see that globally equities took something like over a 50% reduction. Those next two bars show two different benchmarks that represent hedge fund performance that differ a little bit based on which hedge funds and which performances you include. But what you'll notice is that hedge fund returns are either positive or significantly less negative in market downturns. And that's the logic behind why hedge funds pursue absolute returns, which is that their beta or correlation with the market is reasonably reduced. One other interesting trend to be aware of, in case you want to deploy in debate, is that hedge fund leverage, i.e. the amount of borrowed money that hedge funds use to lever up their investments, has increased by a fairly notable factor in the last 10 to 15 years, which potentially creates concerns around when investments start to go down in value, hedge funds might have a difficult time repaying all of the money that they've borrowed to finance those investments. That potentially creates risk. One example of how hedge fund behavior can create systemic risk, in other words, how hedge fund investments can affect the broader economy, is a very niche thing called the Treasury basis trade. You probably haven't heard of the Treasury basis trade outside of two contexts. One is COVID in March 2020. And the second is Trump's Liberation Day tariffs back in April. But the Treasury basis trade appeared in both cases, and it's the potential reason you've heard of it. So what I'm going to do is explain what the Treasury basis trade does, and then what happened both in March 2020 and in April 2025. The purpose of understanding the Treasury basis trade is not like this is individually going to be a motion. Rather, it's a useful example to understand A, why specific economic shocks can quickly cause financial panic, but also B, why hedge fund strategies are not just affecting hedge funds. In other words, one of the issues that you'll often face in debates is explaining, okay, hedge funds are risky and maybe they'll make some risky bets every now and then. Why do we care? If hedge funds lose money, who loses money? It's typically rich people or institutional investors. And the only reason institutional investors are investing in hedge funds is to diversify. If the hedge fund loses money, yeah, the pension fund loses money. But the whole point of the pension fund investing in the hedge fund is as a hedging strategy to give it diversification. The pension fund itself will be fine. So explaining why hedge fund investments affect the broader economy can be a bit challenging. The Treasury basis trade is an example of this. So how does the trade work? The TLDR is there are two primary ways that you can invest in the Treasury market. Again, the Treasury market is just the market for US government debt called Treasury bonds. The first way you can invest, you can just buy a Treasury. That's just buying a Treasury at its current price called the spot price. The value of the bond will change over time, but eventually if you hold the bond for long enough, it's just going to pay out its face value at par value. The other way that you can invest in treasuries is through derivatives. In particular, you can enter into a futures contract, which basically is a bet on the price at which treasuries will sell in the future. Now, in theory, if you adjust for lots of various factors, like financing costs and coupon payments, spot prices for cash treasuries, in other words, the price that you would pay right now to actually buy a real treasury, in other words, a cash treasury. The reason it's called a cash treasury, you can think of is just, well, you would pay for it in cash. Like if you want to buy a treasury right now, you just use cash. In theory, the spot price of a cash treasury should be equal to the futures price of a treasury when discounted by the appropriate rate, because they're referencing the same underlying investment, a treasury bond. Now, for a range of sort of miscellaneous reasons about institutional investment flows and timing of when large institutional investors buy treasury bonds, spot prices are often very slightly lower than futures prices. So there's a very slight pricing disconnect between the value of a treasury in the cash market versus the derivatives market. And this is sort of a quasi-arbitrage opportunity. It's not an absolute arbitrage opportunity because, as we'll see in a moment, there is some risk. But you can make money on this. How do you make money? Well, eventually these prices are going to converge the closer and closer and closer that you get to the treasury actually being repaid by the US government. So you can bet that the spot price, in other words, the price of a cash treasury, will go up and the futures price will go down. And there's a way that you can make money off of that. You bet that the price of the cash prices will go up. So you take a long position there and you take a short position in futures. You sell futures, for example. And that's what hedge funds do with the treasury basis trade. They go long in treasuries, they go short in futures. And what they're basically trying to do is cash in on the basis, the difference in price. Now, the amount of money that you make off of one of these trades is minuscule. You're typically talking like 5 basis points worth of profit, like 0.05% profit being made. You're talking about a few pennies here, not all that much money. But remember, we're talking about hedge funds. And what are hedge funds known to do? They're known to use leverage. So if hedge funds borrow a ton of money, they can do this trade on a huge scale. And if you do the trade on a huge scale, you can buy tens of thousands of treasuries and you can sell tens of thousands of treasury future contracts and you can make a good bit of money. Now, here's the important fact to remember about the treasury basis trade. The treasury basis trade requires that treasury prices, the spot price, in other words, eventually converges with the futures price. That's the way the trade works. And that is always going to happen at maturity. But before the bond matures, it's not guaranteed. So here is, for example, an illustration of the difference between the price of a bond paid in cash versus the price of a bond when bet on through the futures market. And what you'll notice is that there's that slight disconnect between the price of the bond in cash versus the price of the bond in futures markets. And of course, they come together, once the bond matures. So the x-axis here represents the distance in time until the bond is paid by the US government. And so the farther you get on the x-axis, the closer you are to repayment. And so what the hedge fund does in a treasury basis trade is just bet that eventually these two prices will converge. And when you converge, the long and short positions yield a profit. And just to be clear, hedge funds do this on a huge scale. So this is a rough representation of hedge funds exposure via short positions in treasury futures markets. It's worth noting that this slightly exaggerates the scale of the treasury basis trade because hedge funds might be shorting treasury futures for reasons independent of the basis trade, but this is a reasonably good representation of the rise of the treasury basis trade in terms of scale in the last 15-ish years, particularly since the 2008 financial crisis, in terms of something like $800-ish billion at peak being invested into this trade. The problem with the trade is it requires relatively limited volatility. Enter COVID. March 2020, you have a huge shock to global markets, particularly in March as investors realize what's going to happen to the global economy. And what this causes is a huge amount of disruption in the treasury market. And if there's one thing you take away from this presentation, it probably should be that you do not want to fuck with the treasury market because it is by almost all definitions the most important financial market in the world. It's worth something like $30 trillion. Yeah, you read that right. It's like $30 trillion is transaction in terms of the value of treasuries being traded, bought, sold, etc. And when there are disruptions or dislocations in treasury markets, the global economy tends to suffer quite an awful lot. Now, when COVID hit, there were two different effects on the treasury market, and they came at slightly different points. The first came in very early March, circa sort of March 1 to maybe March 12th. And the second effect came right around then, somewhere in like the March 8th to sort of mid-March, maybe March 18th or so. The first effect is what's called flight to safety. So here's what happens. COVID hits, everyone freaks out. Oh my gosh, stock markets are collapsing, bond markets are collapsing. Everyone flies to safety. What flight to safety means is they sell all of the risky stuff in their portfolio and they buy the safest thing there is, the treasury bond. So you sell all your stocks, you sell all your corporate bonds, you sell your real estate, you sell your crypto, and you buy treasury bonds. The flight to safety means everyone wants treasury bonds. So demand goes up, so the price of treasury bonds increases. But then, as this process is ongoing, a second effect kicks in, which is called the dash for cash. The dash for cash means as regular people start to panic about COVID, everyone suddenly wants their money out of their funds. So remember those mutual funds or index funds that we were talking about earlier, or even pension funds to some extent, heck, even some insurance companies? Suddenly, the people that have money parked in banks or parked in investment funds, suddenly they want their money back. Why do they want their money back? Because they're worried about the solvency of those institutions. Even if you're a depositor at a bank with some deposit insurance, you might have legitimate concerns about the solvency of your bank, especially if you're an uninsured depositor. So what happens is there's a sudden demand for liquidity in financial markets. Everyone wants to sell off because they need to give cash to their investors. People want their money out of banks. Retail traders want their money out of mutual funds, and there's a mass fire sale of assets. Why? Because everyone needs cash to answer redemptions and to answer deposit withdrawals. What happens when there's a dash for cash? People sell the most liquid assets in their portfolio. What is the most liquid asset in the world besides cash? A treasury bond. So although there is an increase in treasury prices in early March 2020, there is subsequently a crash, relatively speaking, in treasury prices because as investors need to liquidate the liquid assets in their portfolio to provide cash to meet redemption requests, particularly from mutual funds, they need to sell treasury bonds. And so what what subsequently happens is that treasury prices fall pretty sharply in mid-March 2020. And you can sort of see visually, there's this nice graphical representation here on the bottom. This is a representation of the volatility of the treasury market, basically variance in prices for buying and selling treasuries. And what you'll sort of see at the very far right end of that graph, right around March 2020, the volatility index spikes to levels that hadn't been seen since the financial crisis. So what happens is this. Suddenly, the hedge funds bet On that basis between the cash and futures prices converging, it's a terrible bet. Why? Because markets are in tumult. There's huge volatility. And crucially, treasury prices are collapsing. And so suddenly, the 5-point basis gap that typically exists between spot prices and futures prices balloons to 70 basis points, something like 0.7% gap in the prices between those two investments. And that creates a huge catastrophic problem for any hedge fund that's invested in this quote unquote cash futures treasury basis trade. These are sort of slightly confusing graphs, but they represent on the right hand side the difference between the prices for cash treasuries versus futures prices for treasuries. And you can see right around 2020, there's that huge spike in basis points, i.e. a huge spike in the gap between those two prices. Remember, hedge funds are betting that the gap will close. In reality, the gap expands dramatically. Over on the left-hand side are the relevant interest rates, both on short-term debt called repos that we'll talk about later that hedge funds borrow to finance this trade. Also, the borrowing rate and also the treasury price. And if you look at what happens circa March, basically markets go into a huge crisis in a way that causes the profitability of these investments to collapse. So here's what ends up happening. Hedge funds unwind the treasury basis trade. So unwind basically means you close out the trade. So here's how you do this. If you're a hedge fund, you have borrowed a lot of money, levered up, in other words, to make this trade profitable. And you've also taken short positions in the Treasury futures market by selling Treasury futures. Now, if you remember back to the margin call section from earlier, when we talked about collateral requirements and Tim Geithner's testimony about Bear Stearns, what you'll remember is in derivatives markets, the value of a derivatives contract is marked to market at the end of each trading day. So the value of the contract is adjusted at the end of each day. And if the value of an investment is going down by a lot, the other side of the investment, the counterparty, in other words, starts getting angsty and says, gosh, I'm worried that you're not going to have enough money to repay me. You need to post more margin, more collateral, so that I feel safe that in the event that you go under, I'm not going to lose everything. So what happens to hedge funds as the treasury basis trade blows up in their face is that hedge funds start getting hit with these huge margin calls. They're required to post billions of dollars in cash or highly liquid securities to meet these margin calls. Now, what do you do if you're a hedge fund? Well, if you're a hedge fund, there's really only one option. You need a bunch of cash, and there's only one way to get it. You can't borrow more money. The whole problem that you've run into is that you've over-borrowed to make this trade possible, and borrowers are now having concerns about your ability to repay. The best option you have is to unwind the trade. You are going to sell the treasuries that you've bought, and you're going to buy back the futures contracts that you've sold. You're going to close out the trade. You're going to make a loss, but it's better to make a loss now and on some of these trades and close out the contracts than to keep this unprofitable trade going, because the longer that you hold out the trade, the larger and larger the margin calls are going to get, and you're just going to keep on bleeding money. So the way that hedge funds unwind the trade, either in part or in full, is they sell treasuries. But wait, there's a problem. Once some treasuries start to be sold by hedge funds, and remember, we're talking about hundreds of billions of dollars worth of treasury bonds. That means that the supply of treasury bonds in the open market has increased and demand has fallen. That means that treasury prices fall even further. But remember what's causing this. What's causing the treasury basis trade to unravel is sudden volatility in the treasury market caused by a sharp and unexpected depreciation of treasury prices. By the way, if you're following closely, you might ask a reasonable question, which is like, all of this is fine, but theoretically, the treasury futures prices should also decrease. They do, but they decrease by much less than the actual decrease in the value of treasuries. Because remember why the value of treasuries is dropping. There's a dash for cash. Everyone's selling their liquid securities, i.e. treasury bonds. They're not selling or exiting out of their derivatives positions because that's not a liquid asset in the way that a treasury bond is. So that's why the reduction in value of futures prices is less than the reduction in value of spot prices for treasuries. The point, though, is that you have a negative feedback loop. COVID hits, there's a dash for cash, treasury prices fall, hedge funds are hit with margin calls. The only way to meet the margin calls and close out the trade is to sell treasuries, which causes treasury prices to go back down, which means other hedge funds now get hit with even larger margin calls, and the crisis goes on and on and on. Why is this a problem? Because if this Treasury basis trade unwinds in full, and every hedge fund on the market has to unwind their trade. You are talking about a dramatic shock to Treasury markets. And why is that a problem? Well, for one, this is going to cause a mass global financial crisis because the Treasury is the backbone of the global financial ecosystem. If Treasury prices keep free falling, as they would if the Treasury basis trade unwinds fully, remember, you're talking about multi-billion-dollar hedge funds that have invested maybe $1 trillion into this trade over the course of many years. You're going to see a vast reduction in the price of Treasury bonds that will have calamitous ramifications for financial markets throughout the world. The other implication is borrowing costs. Remember, this is a little bit technical, but when Treasury prices go down, yields on Treasuries go up because a yield is basically the difference between the cash value of the Treasury when it pays out and the price at which it's currently selling. So if you can buy a Treasury bond that's due to pay you $1,000 for $600 today, you're going to make a $400 profit off of that Treasury bond. Not a bad outcome. The bigger the yield on a Treasury bond, the higher interest rates have to be in the real economy. Because, for example, if interest rates that, say, banks charge to depositors is lower than what you could just get by investing in the Treasury bond market, you just invest in the Treasury bond market, and banks couldn't get deposits. So when yields on Treasury bonds are very high, borrowing costs for mortgages, for corporate loans, et cetera, also go up. That makes it harder for the global real economy to grow. It's harder for companies to finance investment, to pay employees, so on and so forth. And there's huge capital flight out of US financial markets. The point is things blow up. So the reason this didn't happen back in March of 2020 is because Jerome Powell intervened. Jerome Powell is the current chairman of the Federal Reserve. God bless my money printer. Jerome Powell and the Federal Reserve agreed more or less that week that they would buy $500 billion in Treasury bonds in what's called quantitative easing. The Federal Reserve injects liquidity into the financial system by buying US Treasury bonds. Why did they do that? Well, there's lots of reasons. The entire economy was in free fall. They needed to reduce interest rates. They needed to inject liquidity into the banking system for reasons independent of the basis trade. But a major reason was a real concern about the Treasury basis trade unwinding. By the way, a similar dynamic played out in April of 2020. You might remember that after Trump announced his sort of sweeping Liberation Day tariffs, there was dislocation in the US Treasury bond market. And there were lots of reasons for this, but part of the reason for it is because some hedge funds, as the price of US Treasury started to go down, because lots of dash for cashing institutional funds had to start liquidating their treasuries, some hedge funds had to start unwinding their Treasury basis trades, and that in turn started to cause a decline in Treasury prices on a fairly large scale before markets eventually stabilized. By the way, there was an interesting argument at the time, although it's since been proven, that the decrease in Treasury prices was partially caused by the People's Bank of China deliberately selling Treasury bonds. China holds around $750 billion of US Treasury bonds or US debt. And the logic was, well, maybe the Chinese government is sort of trying to worsen America's financial position at this moment of protectionism by inducing more or less a shock to the Treasury market in a way that would require hedge funds to liquidate their positions. It turns out that's not really true. China sold around $8-ish billion of treasuries back in that period of time in April 2025, which sounds like a lot, and to some extent it is, but this market's worth $30 trillion. That's kind of a drop in the bucket when you're talking that big of money. But there is an interesting argument that says maybe you could weaponize the Treasury basis trade. So one way that you could theoretically do that is to build up debt holdings of US bonds in China, such that China could then tacitly weaponize threats of fire selling its inventory of Treasury bonds. By the way, this argument has been tossed around for many years. It's the so-called nuclear option that lots of people are concerned about. The argument's not that persuasive in real life for two reasons. First, people exaggerate the amount of debt that China owns relative to the total size of US sovereign debt. In fact, Japan, for example, owns more US debt than China. The second and more important reason why is just it's not really wise for China's government to fire sell US debts. One reason for that is it would cause huge harm to China. China would suffer huge losses on those fire sold bonds, and it would also cause huge harm to the Chinese banking system. The other reason is it really wouldn't cause a huge shock to US Treasury markets because there would just be a bunch of investors that buy up the bonds, and the Treasury market would recover probably in the span of a couple of days. And even if it didn't, the Federal Reserve would just intervene with quantitative easing, pushing bond prices back up and sort of solving the problem. But nonetheless, it's an interesting thought experiment for the potential geopolitical risks surrounding bond markets and weaponization of the Treasury basis trade. So that is hedge funds, and that's an example of how hedge fund investments can potentially create systemic risk. In that context, if hedge funds were forced to fully unwind the Treasury basis trade, it would cause a huge reduction in Treasury prices, as nearly every hedge fund on Wall Street and in Greenwich sells off its Treasury portfolios, causing a huge decline in prices, causing in turn a series of rather terrible consequences for global financial markets. The next type of market, now that we've talked about institutional investors, just to kind of briefly summarize, we've thus far talked about pension funds, insurance companies, mutual funds, index and exchange traded funds, and hedge funds. Those were kind of five of the big ones. The other major fund that we didn't talk about are sovereign wealth funds, but certainly worth reading about, particularly the Saudi and Norwegian sovereign wealth funds might be good examples to read about. But the kind of next two big markets that we'll talk about are private equity and private credit, as well as the market for short-term debt securities that's called the money market. So those are the three major markets left to chat about. So let's get into it. Private equity. Private equity is probably the most commonly debated part of the financial system, save for commercial banks. It's probably also the least well understood. So the way that private equity works is private equity firms buy companies, they make them better, with an asterisk on better that we'll return to, and they then resell the companies for a profit. So the idea of private equity sounds snazzy, but it's really not that complicated. The idea is that the private equity firm gets money, it buys a company, it makes the company more valuable, and then sells the company for a higher price than the private equity firm spent to acquire ownership of the company. Before talking about the specific mechanics of that process, it's worth understanding the equity concept more broadly. So we talked about this earlier. Equity just means ownership in a company. So a public equity market would be like a stock market where you can buy an ownership share in a company. The distinction between public equity and private equity is A, about liquidity, and B, about access. So public equity markets are stock markets. Anyone can buy and sell, including retail traders. Private equity markets restrict access to investment opportunities. So private equity funds, for example, are involved in buying out ownership stakes. And the related consequences that private equity investments are significantly less liquid. I'll talk in a bit about how private equity exits its investments, but it's much harder and more timely and or more time intensive, I should say, more resource intensive than exiting a position in a public equity market. Now, the major concept that you need to understand for private equity is the leveraged buyout. I think the easiest way to understand what a leveraged buyout entails is just to look at a real example. So this is one of the examples that's often cited as the sort of spark moment for private equity. Buyout firms were all the rage back in the 1980s. And in particular, there was a real trend of leveraged buyout firms or private equity firms, not just buying out companies, but actually buying out publicly traded companies, literally buying out companies that were already publicly listed, turning them private, improving their governance, and then relisting them in the future or selling them to a competitor. So Wesray Capital was one of the first private equity firms to gain national prominence. One of the first or most sort of famous investments that they made was into Gibbs and Greetings, which was at the time a card making company. It's since been absorbed into a broader multinational conglomerate that sort of does the same type of stuff. But the way the deal worked was a classic sort of archetypal illustration of a leveraged buyout. So here's the way it worked. Wesray Capital is a private equity firm. So what Wesray Capital does is they go around to a bunch of investors, a bunch of rich people, a bunch of pension funds, et cetera, and they say, hey, we are a private equity fund. We're doing this buyout stuff. We're going to buy some companies. We're going to make them better. We're going to resell them. We're going to make a profit. Do you want in? So Wesray Capital gets money from these quote unquote limited partners, its investors, and then it goes around trying to figure out what companies might be good investment targets. It identifies Gibbs and Greetings as a company it thinks that has upside. It thinks the company is poorly managed, but if it had better management, the company could be very profitable. They could then resell the company to someone else or list it on the stock market and make a handsome profit. So that's what they do. So Wesray Capital buys out 80% of an ownership stake. So in other words, 80% of the shares of the company, even though they're not publicly listed, there's still ownership in the company that's held by some people, maybe the founders, maybe owners, maybe other people that have invested into the company, like an angel investor, or as we'll talk about later, a venture capital fund, though of course a VC firm is probably not investing in a card making company. But Wesray Capital basically says, hey, we're going to buy out 80% of the ownership of this company, making us the majority owners. Now, here's the critical part. If you're going to buy out 80% of a company, you're going to need some money to do that. Where does Wesray Capital get the money to buy 80% ownership stakes in Gibbs and Greetings? Well, as it turns out, you could, in theory, have Wesbury Capital take $80 million of its own money and buy out that ownership stake. But that's not what Wesbury Capital does. Instead, Wesbury does what's called a leveraged buyout. Leverage means debt. Buyout just means taking ownership of the company. So what Wesbury Capital does is it borrows, well, when I say it borrows, there's a bit of a caveat there. I'll come back to that in a moment. Wesbury Capital borrows $79 million, and then it adds $1 million of its own money, and that collectively gives it $80 million, and it uses the $80 million to buy out the 80% ownership stake in Wesbury, in Gibbs and Greetings. Now, here's what's critical about this. In total, Wesbury Capital has spent $80 million to buy out Gibbs and Greetings. Importantly, the $79 million in debt falls on the balance sheet of Gibbs and Greetings, not Wesbury Capital itself, the private equity fund. So the consequence here, it's a little bit weird, but the way that Wesbury Capital, and for that matter, private equity firms engaged in leveraged buyouts in general, approach this is it's acquired $79 million in debt. The collateral for that debt, in other words, the source of payments that will go to paying off that debt and the collateral assets to secure the loan, are future revenues of Gibbs and Greetings. So for that reason, the debt is put on the balance sheet of Gibbs and Greetings. This is probably one of the bigger misconceptions about leveraged buyouts that typically shows up in lots of debate rounds. In any case, Wesbury Capital finances this transaction and arranges for $79 million in debt to be taken out. It puts $1 million of its own money into the firm, and bada bing, bada boom, Wesbury Capital is now the majority owner of Gibbs and Greetings. For a couple of months, the folks over at Wesbury Capital tweak around with Gibson, they cut costs, they change management, and as it turns out, Gibson Greetings is suddenly a more valuable company, and so about 16-ish months later, Gibson goes public in an initial public offering, and that IPO is worth around $290 million, and the folks who put $1 million into the fund, into Gibson Greetings via Wesbury Capital, the private equity fund, they make about a 79x return on the initial $1 million investment. That's a pretty good deal. So let's talk a little bit about the mechanics of how leveraged buyouts work more broadly. So private equity funds start by raising capital. These are closed-end firms. That means that if you're a private equity fund, examples are Blackstone, KKR, Carlyle, big examples. QTY is another big one. Private equity funds raise money from accredited investors, so pension funds, large wealth management firms, high net worth individuals, that sort of stuff. And private equity firms raise lots of money. And then basically once they've raised that money can't be, at least not easily, withdrawn for several years. So private equity is an illiquid investment. It can't easily be turned into cash. Now, if you're a private equity fund, you're going to use that money to buy out ownership stakes in companies, but you want to maximize your return on investment. So rather than using all of your money to buy out companies, what you should rather do is use some of your money and a lot of borrowed money to buy out ownership in companies. And the way that leveraged buyouts work is that basically private equity firms put a bit of their own money and a lot of borrowed money into the purchasing of ownership stakes. And the assets of the company that's being acquired are then used as collateral for that loan. The implication is that the debt ends up on the balance sheet of the company that's being acquired as opposed to on the balance sheet of the private equity fund itself. Now, in practice, to be clear, the private equity fund is arranging for the debt issuance. The private equity firm is the one that's arranging for the borrowing. The private equity firm needs to get the approval of the existing shareholders before the deal goes through, but that's how the balance sheets end up playing out in this context. Now, a fair question you might ask is, okay, wait, so there are people giving money to private equity funds like pension funds or rich people, but who's lending money to make these leveraged buyout deals happen? Is it the same groups of people? The answer is no. So when the private equity fund raises money, that's raising money from the limited partners that are putting their funds into the PE firm. When the private equity fund goes to actually buy out a company, it needs to find a lender to provide the credit to finance the leveraged buyout. Typically, that comes from banks. sometimes from high yield debt. High yield debt is more commonly called, outside of finance, junk bonds, basically bonds issued by non-investment grade companies. By the way, junk bonds, when you hear the term junk bond, your mind might go to like, oh, these companies are actually junk. They're guaranteed to fail. Not really the case. High yield debt, or in other words, debt issued or bonds issued by below investment grade companies, actually doesn't have that high of a default rate. It rarely exceeds 9, 10, maybe at most 15% in terms of default rates in any given year. Still, of course, very risky, right? If the default rate on these loans is 9 or 10% in any given year, imagine what the default rate for a given company is over the span of 10 or 15 years. But high yield debt does very much exist. It's since reduced in size, at least relatively speaking, from the high point of the junk bond market back in the 1980s. There was a major scandal involving the junk bond market sort of towards the late 80s, early 90s, and that kind of caused a reduction in the scale of high yield debt issuance, but it does exist. And the other important source of financing, now that we're off the tangent of Milliken and junk bonds, and back to private equity, the other source of lending for private equity leveraged buyouts comes from private credit firms, which I'll talk a little bit about later in this presentation. So it's a combination of loans from banks, junk bonds, and loans/direct lending from private credit firms that allows private equity funds to borrow the money to buy out ownership stakes in companies. Now, the last thing that you should understand about the mechanics of private equity is about exit strategies. So remember, there are 3 steps to private equity. Once you've raised the funds, that is. Step 1, well, sorry, I guess that actually is step 1. Step 1 is you raise funds from investors. Then step 2 is you do the leveraged buyout. After you do the leveraged buyout, you now own the company. You need to make the company more valuable, more profitable. And then step 3 is you sell the company for more than you bought it. And then that's where the private equity firm makes the profit. But the question is, when you sell the company, who are you selling it to? You can't just sell it into the ether. You got to sell it to someone. So there's 3 major ways that you could exit a private equity transaction. There's a couple of others, but these are the 3 major ones. First option, a public listing. The company goes public, it sells its shares to the public, you make money through the proceeds of the IPO. Option 2, a strategic sale. You could sell the company to a competitor. Example of this would be you're a private equity fund in the tech space. You buy out a tech company, you make the company more profitable. You develop its business model. Google comes along 5 years later and says, hey, you've got a great company. We'd like to buy it. Awesome. That's an exit strategy. Option 3 is a secondary sale. You could sell the company to a different private equity fund. I'll have more to say about that later when we talk about the liquidity problems currently facing private equity. By the way, it's worth just briefly commenting on the relationship between private credit and private equity. An argument you'll periodically hear in some discourse about private credit and private equity is that there's a trade-off. That's not true at all. Private credit is very much integrated with private equity in the sense that a huge majority of leveraged buyouts are actually financed by private credit lenders. So just to be clear on what that means, private equity firms are borrowing money on the balance sheets of the companies they're acquiring, and the money to finance those leveraged buyouts is in a majority of cases coming from private credit firms. So private credit enables private equity and vice versa. By the way, the exit strategy problem that we'll discuss in a moment about liquidity is a problem that shows up most clearly if you look at the timelines for private equity exits via IPOs. So basically, if you look at, sorry, not IPOs, I misspoke. If you look at the timeline between a private equity firm buying a company in the leveraged buyout and then selling it, an example would be an IPO. And if you look at the timeline here, you can see the general increase in the amount of time it takes for private equity firms to sell off the company. So back in the early 2000s, on average, private equity firms were holding companies for maybe in the ballpark of 3-ish years. Nowadays, it's much closer to 6. Part of the reason for that is that private equity firms are having an increasingly difficult time extracting value from the PE investment process. And as a consequence, it's harder and harder and harder to find buyers for these companies that PE firms have bought out and remanaged. So the critical step for PE to work is that after a private equity firm buys out a company, it needs to make the company more valuable. So how does it do it? Well, one way is operational improvements. That would mean making the company bring in more revenue or have lower costs. So how might you increase revenue? There's lots of ways. You might merge with smaller companies so you can get economies of scale. You might develop new product lines. You might renegotiate your supplier contracts. You could also cut costs. The most obvious way to cut costs would be firing employees or consolidating suppliers so that you have more sort of supply side economies of scale. So in that way, you can change the company's operations to increase revenue and cut costs. That's the easiest way to make a company more valuable in the sense of profitability. And in doing so, that makes the company more lucrative for someone else to buy or in an IPO. Second is you can change the company's governance. So you can change compensation packages, you can adjust management structures. You can basically try to make the board more effective. For example, a pretty common thing to see in private equity is private equity will come in and they'll pretty quickly fire the existing executives that are already in power if they think that they're incompetent or aren't running the company well. Last, there's lots of financial engineering involved in private equity. Private equity financial engineering basically means adjusting a company's capital structure to make the private equity's return on investment higher. So an example would be maybe a company has old maturing debt that has weird seniority structures about the order in which debt is paid off. A private equity fund might say, look, we don't like this. We're going to issue new debt on your balance sheet to repay that old debt that better accords with our conception of the payout hierarchy in the event of bankruptcy. The other example of financial engineering would be private equity firms might try to find clever legal ways for companies to pay less in taxes, even if doing so is technically legal. So the big criticism of private equity relates to the concept of slash and burn. Sometimes you'll also hear this referred to as asset stripping, although technically asset stripping is a distinct concept that has a specific economic meaning. So the major criticism of private equity, there's a great book, by the way, out. I'd recommend reading Plunder. I think it's a good read. It's written by a former US prosecutor who has a lot of interesting insights on the private equity business model. But the core argument against private equity on a humanitarian basis, basically, and also an economic basis as well, is more or less that private equity results in huge collateral damage. So, for example, a very common tactic that private equity firms will deploy is mass layoffs. They'll come in and they'll fire a bunch of workers. Now, private equity's defenders say, sure, that's true, but we fire lots of workers at first, but then we eventually hire more workers. Why? Because if you make the company more efficient, more streamlined, more profitable, then it's more viable for the company to hire more people down the road. Empirically, that's a bit suspicious. It is true that private equity companies invest in firms that do later hire people, but they hire employees at a lower rate than non-PE owned firms. There is a selection bias there, though, of course, which is why that finding is not necessarily robust. But the main implication of efficiency-based layoffs is you often end up having mass reductions in service quality and huge amounts of harm to employees. So you'll have nurses that'll be fired. You'll have health clinics run by PE that are not staffed well enough to meet demand when, for example, there's a surge in ER cases. Or you won't have enough supplies in the closet for when people come in needing bandages. Or doctors will have shorter appointment times. Or you'll order lots of ancillary tests. Those would all just be examples from healthcare alone of what private equity would do to make a company more profitable. You can think of lots of other examples, though, in other contexts of how you could find similar ways to increase corporate value at the expense of human well-being. You might fire lots of the people who work at preschools, for example. That might result in a larger ratio of students to teachers, but as long as the firm is more productive, it technically constitutes an increase in the value of the firm. So that's one criticism of private equity, which relates to operational efficiency leading to layoffs, leading to cost cutting, et cetera, in a way that means that people lose their jobs. People can't afford their mortgages. People often have their benefits cut by PE is another good example of this. And the quality of service provision also goes down markedly. You get much worse quality healthcare, education, water services, everything that private equity touches, there's some effect. So a kind of silly example of this is like lots of restaurants that get bought out by private equity often will see a reduction in the quality of their menu because the ingredients go down in quality as private equity shifts the company to focus on importing or using cheaper foods as opposed to higher quality food. A second and more probably enduring criticism of private equity is about the short-termist nature of private equity. So a private equity advocate would say, that's not true. Private equity is actually pretty long-term. We're trying to focus on, gains over the span of 3 to 7 years because the private equity fund has locked up investors' money for many years. And so it's not looking to make an immediate return on investment. The main response to that would be to say, no, the way that you grow a company cannot be achieved in 3, 5 years. To grow a company requires persistent investment in long-term growth over the span of 10, 15, even 20 years, sometimes even longer. Like even just think about today, the most valuable company in the world is what? It's NVIDIA. NVIDIA is a company that's been around for decades, and that took very many years of persistent growth, research and development, experimentation for NVIDIA to become the company it is today. You couldn't achieve that in the span of 3 to 5 years. The problem with private equity firms in that context is that they'll do lots of things that make the company more valuable to sell in 3, 5, 7, maybe 10 years. But those things will often undermine the company's long-term growth prospects. One example of this is asset stripping. So asset stripping is basically when you take a company's most valuable assets and you sell them. So an example of that would be you run a company and it has a couple of subsidiaries. One of them does really, really well. You as the private equity firm might say, hey, that subsidiary is doing real great. We're going to sell it, and we're going to use the proceeds from the sale to pay ourselves a dividend. We're going to make a profit on this sale alone. It's terrible for the firm, great for the private equity company. Another example of this is sale leasebacks. Sale leasebacks is when a firm will take productive capital goods like machinery or a factory, for example. They'll sell the asset and then they'll lease it back to whoever they sold it to. So leasing in this case more or less means renting. So an example would be private equity buys out a farm. The farmer owns a tractor. The private equity firm says, you're going to sell the tractor, and then you're going to pay a monthly rent to basically rent out the tractor. That's good in terms of profitability in the short term, because you turn a capital item into cash, and that makes the company, at least in the short term, more cash flow positive. But long term, it's bad because you forfeit control over productive assets like factories, land, machinery, etc. So you might be good for the company's short-term growth, but probably bad for the long-term growth. The third criticism is about capital. It is true that private equity results in a capital inflow into companies. In many ways, private equity firms, for example, have incentives to provide working capital to the companies that they invest in to develop new products or expand into new markets. But private equity firms also have a pretty bad effect on companies' balance sheets, which is private equity firms don't themselves bear the costs of debt servicing. The debt falls ultimately where? It falls on the balance sheet of the company that is being acquired by the private equity firm. And the probably most famous example of this is when KKR and Bain, as well as a third, more mortgage-related company, less private equity-related, but they still were involved in the transaction. But KKR and Bain, being two fairly large private equity firms, partnered up to buy out a majority stake in Toys R Us, the famous kids store. And there are lots of reasons why Toys R Us was already in decline, but Toys R Us arguably was in a much worse position because of the private equity deal. The reason why is because Toys R Us was saddled with billions of dollars in debt that were more or less borrowed by the private equity funds to finance the leveraged buyout. So even though private equity firms will maybe make the company more profitable, they'll also make it more debt-ridden. And of course, remember, if you're the private equity fund, the thing that you ultimately care about is not the health of the companies that you're managing. The thing that you care about is whether or not you make a return on your investment. But remember, and this is important, private equity funds are very leveraged. They're using a lot of borrowed money to finance a lot of the acquisition cost, and they're putting in relatively less of their own capital. Why is that a problem? There are lots of ways that you can saddle a company with debt and then recoup your equity investment in the company, even if the company ends up being worse off. So one example of this is what's called a dividend recapitalization. That's when a company would borrow money and then uses the money from the loan to pay a huge cash dividend to shareholders. It's great if you're a private equity firm. Probably a bad thing to do if you're a company because it's a terrible use of the money. And more importantly, it saddles your balance sheet with debt in a way that makes it harder for you to grow in the future by taking out more debt. It's harder for you to function or finance your operations, and there are some long-term costs associated with that. The other concern with private equity is about consolidation. The simplest reason why private equity promotes consolidation is just that one of the main value generation strategies pursued by private equity is mergers and acquisitions, what are called roll-ups, where you merge a couple of small firms together into one bigger firm. They can access economies of scale. That might be good in the short term, but it also potentially leads to consolidation and reduced competition in the long term, which in turn creates all sorts of concerns about reduced service quality, increased prices, reduced bargaining power for workers, so on and so forth. What I'll end this slide by just noting is all of these criticisms apply the most compellingly to social services. By social services, I basically mean sectors where there are lots of values provided that can't be strictly captured on a spreadsheet. So, for example, some of the saddest stories you'll read about with private equity are the effects of PE investment on places like hospitals or nursing homes or preschools or prison phone services or water services, because in those contexts, things that might be good to cut from an efficiency perspective are not good to cut from a well-being perspective. Like having overstaffing of nurses is often pretty good for many health clinics because when you have a sudden inflow of patients, having extra staff on hands, it's not profitable, but it's good for the well-being of patients. And in contexts where people are going to come to the health clinic regardless, it's an inelastic demand good healthcare is. That was not properly worded English, but you get the gist. In that context, there might not be an effect on profits, but there is an effect on well-being of customers. And in that context, private equity can be pretty harmful. There's a nice piece that you can read about in The Guardian that details all of the sort of asset stripping slash and burn concerns that sort of nicely identifies that, yeah, some people will say, sure, private equity has all these horror stories, but you're cherry picking. On average, private equity is great. There's some truth to that, but there's also a lot of truth to the fact that the horror stories are not that rare. There are lots of cases of private equity fucking up companies and causing pretty intense human suffering. One of the interesting trends to keep an eye on, and at some point I assume this will be set as a motion, is the democratization of private equity. So a couple of weeks ago, the Trump administration, for example, announced a shift to permit retirement investment accounts to invest directly into private equity funds, like 401k accounts. And there are proposals for retail traders to eventually engage directly in private equity investments. The logic for this is that private equity returns, depending on some accountings, have above market returns. So if you speak to a PE advocate, they'll probably be like, yeah, on average, average returns are like 15% on private equity, which is better than most of the long-term gains on, say, the S&P 500 or the NASDAQ. And as a consequence, retail investors are a huge source of funding for private equity. And so it's only fair that if the 1% has access to this great above market return mechanism, so too should retail investors. There are lots of reasons why this is probably a poor idea. One of the biggest reasons is just liquidity concerns, which is the reason why it makes sense that accredited investors can invest in private equity is because private equity doesn't allow you to withdraw your money for many years. Retail investors typically do have liquidity needs in the short term, like they'll need money out for random stochastic shocks like unemployment or a natural disaster. And so there are some concerns about whether or not it makes sense for retail investors to be putting their money into private equity. The other concern is that private equity firms, yeah, it's not just that they're risky. The more specific concern is that the risks associated with PE are not immediately self-evident and as a consequence might be difficult to grasp for information poor or non-professional retail investors. It's not to say that private equity is inherently risky. It's rather to say private retail investors might not properly understand the risks that they're signing themselves up for when they put their funds into a PE firm. The other concern with democratization of private equity is just it's not clear that democratizing private equity by permitting retail investors to invest in private equity would even be good for private equity. The main reason why is that just about every time an investment fund or type of investment opens itself up to investment from retail traders, the consequence is almost always the same. It leads to more government regulation. There's public outrage when there are losses. There's lots of demands for the SEC or the ESMA to become involved in regulating for liquidity concerns and transparency concerns. And the one specific example of that you might, for instance, want to be familiar with is what's called ERISA, which is a specific law that has lots of implications for disclosure requirements and risk requirements whenever more than 25% of some funds' money is coming from retirement accounts. And so there are lots of concerns that say, if you think private equity is good, big if, but if you do think private equity is good, you probably don't want to turn it into a heavily regulated domain of finance, because then it basically becomes indistinguishable from just any other highly regulated form of investing. And so, if you wanted to make an argument, for instance, about why regulation is bad, you might make arguments that say, look, the ability of private equity firms to operate with relative speed, to make investments that are not handicapped by government regulation, and for private equity firms not have to raise fees to account for compliance costs. All of that requires PE to not be touched heavily by regulation. The last thing I want to talk about in the private equity section is the liquidity crunch that private equity faces. This is one of the sort of interesting problems that private equity faces that doesn't have a clear solution. There's an interesting trend that's been ongoing for more or less 2 decades now, whereby private equity firms have acquired tens of thousands of companies. They're having a hard time selling them, both because they're having a hard time launching them as IPOs because investors in public equity markets aren't willing to buy. And they're also having a hard time finding other companies to purchase these. There's a nice piece, for example, from the editorial board over at the Financial Times that sort of identifies this in kind of nicer language. One of the interesting, but more or less, at least in my view, quasi-corrupt solutions that private equity firms have come up with is what's called a continuation fund. So a continuation fund basically is you're a private equity firm. You have bought a bunch of companies, but you can't exit them. You can't find a buyer, and so you're just stuck holding on to them. Remember that chart I showed earlier of the average duration at which a private equity fund holds on to a company has doubled in the last few years? That's sort of what this problem is addressing. One of the ways that private equities try to get around this is, what if you just build a second private equity fund that has a new batch of investors that buys out the companies that the original private equity fund bought in? By the way, this might be one of the reasons, arguably, it might be a little cynical, but it's not entirely implausible. This might be one of the reasons why private equity firms are willing to permit retail investors to jump aboard, which is you could get a new basket of funds for these investments into continuation funds. The logic behind a continuation fund is that you build a second private equity fund, the continuation fund, that uses this newly raised capital to buy out the companies that are on the bankroll, more or less, or the balance sheet of the OG or the original private equity fund, so that the original private equity fund can then distribute returns to its limited partners, its investors. Of course, there's a bit of a Ponzi scheme issue here, or kind of a circularity problem here, which is you can't do this forever. At some point, you're going to have to find an end buyer. And there are major concerns that private equity has exhausted more or less lots of the sort of middle bracket firms that it can really extract much value from, in a way that means that private equity firms face a pretty major liquidity crunch of figuring out how to sell tens of thousands of companies for which they do not have buyers. One specific domain of private equity that shows up a good bit in debate that you should be familiar talking about is venture capital. So to be clear, venture capital is technically a form of private equity, but it has very different characteristics. In particular, venture capital focuses on a very different type of company than private equity. Private equity focuses on relatively established companies, relatively mature companies. VC is the opposite. VC is focused almost entirely on small, scrappy startups that have potentially large growth potential, often tech companies or companies that have some adjacency to the tech sector. Now, what venture capital firms do, unlike PE, is they buy minority ownership stakes in hundreds or even thousands of startups. And the logic behind this is a PE firm is going to buy ownership stakes, majority stakes, in enough companies that it can manage. And that's going to require personnel, it's going to require oversight, it's going to require monitoring. VC has the opposite approach. The purpose of a venture capital fund is to raise money and then invest it as widely as possible. Most investments are going to fail because 85 to 90% of startups fail. It's just inevitable. But if you happen to identify the next Facebook, if you happen to identify the next NVIDIA, the next Tesla, you're going to be rich beyond imagination. So there's a bit of an inversion of risk in VC contexts. If you're a bank, the thing that terrifies you the most is making a bad loan. If you're a venture capitalist, the thing that terrifies you the most is missing out on the next big thing, the next big firm to succeed. And so in that sense, the main thing that a venture capital firm is going to focus on is providing seed funding to companies that are early in the stages of growth, and providing some level of oversight or some level of mentorship and advice to companies that are just starting out. And for that reason, VC is a much higher risk endeavor, where the aim is by and large to invest as broadly as possible and as riskily as possible, precisely because most of those firms will fail, but the ones that succeed will succeed in a way that results in a $1 billion IPO that brings in vast returns for the venture capital firm. Again, VC has a particular salience in the context of tech, and to some extent also in the context of firms like, say, biology, pharmaceuticals, etc. Okay, there's two final markets that we'll talk about. First is the bond market. So at this point, we've talked about the sovereign bond market a good bit, but it's worth talking about corporate bonds in greater depth. So a bond, by this point, as we've established, is just an IOU. It's something that you promise to repay to another person. And a secondary debt market is where you can sell a bond. So this sounds a little weird at first, but it just means if I promise to pay you money, you could sort of sell that to someone else and then say, hey, yo, Ryan, actually pay that other person, and you'll take a cash payment for that original transaction. That's what a secondary debt market entails. Why do secondary debt markets exist? Well, lenders are more willing to make the loans in the first place if they know that they can sell the loan to someone else when their needs or liquidity conditions happen to change. Now, there are two types of debt markets that you should be familiar with, plus private credit, which is a third. The first is money markets, and the second is the bond market. So what's the distinction? The core distinction is about maturity. Money markets are basically where companies, banks, and governments borrow in the short term. Bond markets are where companies, banks, and governments borrow in the long term. And for that reason, people will typically talk about money markets as being bonds or debt instruments that mature within 270 days to roughly a year. For example, commercial paper is a particular type of short-term debt that has to be repaid within 270 days. That's for regulatory reasons. If a bond or a loan is due for repayment longer than 270 days, it has to be registered with the Securities and Exchange Commission. That's costly. It involves lots of legal fees. It has to go through public disclosure requirements. So commercial paper would be an example of trying to skirt public disclosure requirements by using short-term debt. So let's start by talking a bit about money markets. Money markets, again, are short-term debt markets. What happens in a money market? Companies issue bonds. Investors buy those bonds. The proceeds of those sales go to the company that needs the money, and those bonds can then be sold on the secondary debt market. So what happens in money markets is short-term debt instruments are issued. There's two very important types of short-term debt instruments that you should be familiar with, which are repos and commercial paper. Repurchase agreements are complicated on face and extremely easy once you realize that this is just weird financial accounting. A repurchase agreement is basically just a secured loan where one side lends money to the other and the other side posts a very safe asset as collateral, like a treasury bond. The way a repurchase agreement works in practice looks something like this, where you basically purchase, or more specifically, if you're initiating the transaction, you sell a bond or a asset like a mortgage-backed security to the other side, and then you agree to repurchase it back the next day at a slightly higher price. And in this context, it's basically a secured loan, because if the person that has borrowed the money doesn't repay, then the counterparty just sells the collateral and recoups the loss. A very reasonable question you might ask is like, repos seem weird. Why don't you just use loans? There's two reasons. One of them is about accounting treatment. Under risk weighting requirements for capital requirements for banks, repos are treated slightly more favorably in risk weighting than bonds, or the long-term bonds, that is, or than bank loans. So there's a bit of an incentive for banks to borrow through repos as opposed to borrow through, say, a bank loan. The other reason is about bankruptcy. This is a little bit complicated, but in a loan that is secured by collateral, if the borrower defaults, the lender has a right to take the collateral. But there's a slight catch, and the catch is there's a timing gap. After a borrower declares bankruptcy, but before the collateral can be seized and sold by the lender, the company enters bankruptcy proceedings where they're protected by what's called automatic stay, which is basically a temporary ban on lenders like haggling you for repayment and stuff like that. Automatic stay creates friction because it basically means that the lender doesn't get the collateral for a few days or weeks or months, depending on the bankruptcy process. A repo is a sale of an asset. And because it's a sale, when you sell something to another bank or another lender, they now own that thing. If you then default on the repo, they already own the collateral and they just sell it immediately. So there's no risk surrounding automatic stay provisions in bankruptcy. And so for that reason, a repo is considered bankruptcy remote. In other words, the underlying collateral is not affected by a default event. So that's why repos exist. They're short-term loans secured by collateral. They're done instead of bank loans for accounting and regulatory reasons. Repos at first glance might seem, unimportant. Like, what are these random repo things? Turns out they're massively important for the functioning of the financial system. And there are three major groups that use repos that are particularly important. The first are market makers. Market makers are those institutions we talked about earlier that stand by ready to buy and sell securities, particularly in stock markets or to some extent in bond markets and to some extent in derivatives markets like centrally cleared exchange traded derivatives. But repos are particularly important for market makers in stock markets because market makers use repos as a way to lend out the securities that they own in exchange for cash. Remember, market makers are in the business of doing two things: buying, which means handing over money, and selling, which means receiving stocks. Sorry, I said that correctly and I thought I didn't. The consequence is that market makers need lots of money and they have lots of securities on hand. So they can use the securities they have on hand to borrow via repurchase agreements in order to ensure they have enough liquidity on hand to keep markets functioning. The second and more important is banks. Banks use repos to meet their short-term liquidity needs. You might remember way back we talked a bit about liquidity requirements. Those are the requirements imposed by regulators on banks to reduce the risk of a liquidity crisis and a bank run. Commercial banks use repos to ensure they have enough cash or highly liquid assets on hand at the opening of each business day to meet withdrawal requests. And repos are the primary way that banks do this on a short-term basis through overnight interbank lending markets. Repos are the instrument of choice. Lastly, hedge funds make extensive use of repos because they use lots of borrowed money for their investments. The other type of short-term debt instrument, by the way, is commercial paper. Commercial paper is basically an IOU that's not, or typically not, backed by collateral unless it's what's called asset-backed collateral, in which case it is. There is a risk associated with both repos and commercial paper that's called rollover risk. Rollover risk basically is a common way that short-term debts will be repaid is by taking out new short-term debts. So I have a repo due for repayment tomorrow. I'll take out a new repo and use the cash from that repo to repay the old one. And so rollover risk is what happens when borrowers stop giving you new loans to repay your old loans, and that's the context where commercial paper markets or repo markets are tend to freeze up. Now, a fair question you could ask is, who cares about money markets? Like, I get it. Market makers are important. Hedge funds are maybe important. Banks are definitely important and they use this, but why do we care about repos? Why do we care about commercial paper? Well, the main reason you should care about these things is because they have major implications for what's called shadow banks. So shadow banks have a very mysterious and ominous sounding name. Shadow banks, they sound illegal. To be clear, there's nothing illegal about a shadow bank. It's a term that even the industry itself happens to hate. A shadow bank is basically just a financial institution that does bank-like activities without actually being regulated like a bank or without being a bank in proper legal terms. The IMF is a nice way of putting it, which is the saying sort of goes, if it looks like a duck and quacks like a duck, it's probably a duck. But that's not necessarily true if an institution looks like a bank and acts like a bank. So the way that shadow banks work is they basically do the two main things that banks do without actually being banks. They take things that are more or less deposits and they make loans. So shadow banks are in the business of using short-term funds like repos and commercial paper and making long-term loans. Now, a fair question you could ask here is, wait, repos look nothing like deposits. What are you on? The point is, shadow banks use short-term liquid financing on the liability end of the balance sheet to finance long-term investments like buying mortgage-backed securities. Notably, the crucial distinction between a shadow bank and a regular bank, which uses deposits to make loans, is the level of government support and the level of government regulation. A traditional bank, as we saw earlier, faces a maturity mismatch, and it also faces a liquidity mismatch. And because of that maturity liquidity mismatch coupled with credit risk, traditional banks receive two forms of government support: deposit insurance and central bank lending, i.e. lending of last resort, as a way to reduce the risk of runs. Those mechanisms potentially cause moral hazard. So, as a consequence, governments impose prudential regulations on banks to limit risk taking. Shadow banks are not subject to nearly any of those benefits or regulations. They do not have access to deposit insurance. They do not have access to lending of last resort, and they are not covered by nearly as many prudential regulations like capital regulations and liquidity regulations. Consequently, shadow banks like finance companies, like hedge funds, like money market mutual funds, etc., provide bank-like services without being regulated like banks, without being as transparent as banks, and without having the public credit guarantees for their liabilities, like, for example, repos and commercial paper. By the way, you can use arguments about the harms of shadow banking pretty effectively in nearly any debate about regulation. A very common effect of government regulation is specifically on banks is to shift lending away from the traditional commercial banking sector towards the shadow banking sector. So, for example, a narrow banking regulation is a proposed regulation that requires banks more or less to back up their deposits with government-backed safe assets like Treasury bonds rather than invest that money out in the form of loans, etc., unless the depositor specifically requests their money to be put into a quote-unquote equity account, whereby the value of the equity account fluctuates based on the loans the bank issues. One of the arguments against a narrow banking regulation is that if you regulate banks' ability to make loans by reducing the amount of lending that they can do because they have to buy bonds issued by the government as opposed to issue loans, then one of the immediate effects is that banks make less money and they can't offer as high interest rates, and they also just generally are less capable of lending. That means that lending and wholesale financing shifts out of the regulated, transparent banking sector into the shadow banking sector. The reason it's called the shadow banking sector, by the way, it's because these are financial institutions that operate in the shadows of the traditional banking system. That's bad because they're less regulated, they're less transparent, and they're more vulnerable to bank runs because they still face the same maturity and the same maturity and liquidity mismatch of a traditional bank. That is, shadow banks rely on short-term repos and short-term commercial paper, and they still are ultimately exposed to long-term assets, even if securitization makes them slightly more liquid. But they do not have access to any of the support mechanisms that governments provide to commercial banks. Now, the reason shadow banking is a concern is because shadow banks are vulnerable to runs that can spread into the traditional banking sector. And one of the most famous examples of this is what happened to Northern Rock, which is a UK bank back during the 2008 financial crisis. So here's roughly what happens. In the early 2000s, a large number of shadow banks, for example, investment funds, a whole slew of money market mutual funds that invest in that raise funds from investors and then purchase these short-term debt instruments like repos and commercial paper. Increasingly, a large number of shadow banks used these short-term loans like repos and commercial paper to invest in what are called mortgage-backed securities. Mortgage-backed securities get a bit of a bad rap because they were so centrally involved in the 2008 financial crisis, even though they're not inherently bad instruments. But a mortgage-backed security is basically, and I'll explain this in more depth in the securitization section, just a collection of mortgages that are bundled all together and pay cash flows out to investors. The important distinction between a mortgage and a mortgage-backed security is A, a mortgage-backed security contains thousands of mortgages as opposed to just one, and B, a mortgage-backed security can be bought and sold and traded like a security, like an asset, as opposed to no one's going to be really in the business of buying and selling individual mortgages outside of the initial transfer of the mortgage originator selling the mortgage to the securitizing agent. But anyways, we're getting ahead of ourselves. In the 2000s, there's a huge rise in shadow banking, where this massive shadow banking ecosystem uses short-term debt like repos and asset-backed commercial paper, and they invest this money into mortgage-backed securities, which are then used as the collateral for those repos. Now, here's the problem. A repo is a secured loan, but the collateral for that loan is the asset that is sold and then repurchased. If the quality, the creditworthiness of the collateral is called into question, repo markets and repo lenders get terrified. Why? Because if the borrower in a repo agreement defaults and the underlying collateral that's used in the transaction decreases in value, then the lender in the repo transaction, this diagram here shows it somewhat nicely, the lender loses money because the borrower defaults and they can't recoup the loss fully through the sale of the underlying collateral. So here's the context. 2000s. A bunch of shadow banks have borrowed a bunch of money, and the collateral that they've used to borrow against is mortgage-backed securities. August of 2007, everyone suddenly starts to realize, a bit of an exaggeration, this starts happening a bit before then, but for the narrativized story, we'll run with it. August 2007, French bank BNP Paribas freezes 3 investment funds. Why? Because they were heavily exposed to losses in the subprime mortgage market in the United States. Everyone suddenly realizes, shit, subprime mortgage-backed securities are not nearly as safe as we thought. And here's the problem. The repo market has used billions of dollars of subprime mortgage-backed securities as collateral for repurchase agreements. We are no longer sure in the repo market if we can trust subprime mortgage-backed securities as safe collateral. So a bunch of repo lenders, in other words, the lenders that provide funds in the repo market and participate in these short-term secured loans, they got terrified. And so they start to demand more and more collateral, and they don't allow repo borrowers to use these toxic subprime mortgage-backed securities as the collateral. The slightly technical way of putting it is that they raise the haircuts on repos. They basically demand greater payment and greater repo rates. By the way, this is a sort of visual representation in the decline in the value of subprime mortgage-backed securities circa sort of 2006 to 2008. The ABX index is an index that tracks the prices of subprime mortgage-backed securities issued in particular periods in time. And so you can sort of see the general decline here in prices that spikes particularly in 2007, particularly around August. That continues then throughout the remainder of 2007 and of course 2008 as the crisis intensified. And that then corresponds with a sharp increase in borrowing costs in repo markets. So as the quality of repo collateral decreases, the expensiveness of borrowing in short-term debt markets goes up. Now, where does Northern Rock fit into all of this? Let's be very clear for one moment. Northern Rock was a traditional commercial bank. They were not a shadow bank, and here's the more important thing. Northern Rock did not invest nearly any money into the subprime mortgage sector in the United States. Northern Rock was not very exposed to the subprime mortgage sector. Northern Rock was not a highly irresponsible bank, in other words. But there's one slight problem, and you'll notice it on this diagram here. You notice this section called wholesale funding? You'll notice a huge drop between June of 2007 and December of 2007. I mean, we're talking millions upon millions, heck, billions of pounds lost. So what happens here? Well, what happens here is between June and December of 2007, Northern Rock sees its wholesale funding, in other words, its repo agreements and commercial paper lending, dry up. And what basically ends up happening is this. In 2007, the repo market faces a major crisis because as lenders start to worry about the credit quality of subprime mortgage-backed securities being used as collateral in all of these repurchase agreements, all of a sudden, the short-term debt market, again, the money market, that's what this all is about, the money market freezes up. Lenders stop lending. And as lenders stop lending, totally safe, not exposed to subprime mortgage-backed securities firms like Northern Rock suffer a shortage of funds. Why? Because Northern Rock had relied so very heavily on borrowed money through short-term money market instruments. When short-term money markets dried up, guess what happened to North Rock? Answer, Northern Rock suffered a major bank run in September of 2007, and it was eventually wiped out and required a bailout from the UK government. The point of the Northern Rock case study is to emphasize the importance of the functioning of money markets to commercial banks even commercial banks that don't invest very riskily, because deteriorations in short-term credit markets, like the money market, where companies or banks or governments issue short-term debts that they repay maybe by the next day, maybe by the next week, maybe the next month, before the end of the year for sure. When those markets freeze up, otherwise healthy firms can't have the money they need to meet short-term liquidity requirements. While we're on the topic of securitized finance, it's worth just talking briefly about what securitization is and whether or not securitization is bad. The securitization premise is straightforwardly bundle many small things into one big thing that can be bought and sold freely. And therefore, you basically create a secondary market for lots of types of loans. An example of this would be mortgages. Another example of this would be auto loans. A mortgage-backed security is just a bunch of mortgages all bundled together that promises a cash flow. Excuse me, I couldn't find the word. A cash flow to investors. A fund that is collateralized by mortgages. Now, that's a slightly simplistic definition of securitization. A slightly more proper definition would say securitization involves lots of financial engineering, securitization involves diversification, and securitization involves a sort of version of liquidity transformation in that you're transforming individually illiquid debt instruments like mortgages into a single fairly liquid, in other words, easy to turn into cash, easy to buy and sell asset that can be traded around in markets. So, for example, here's a kind of visual representation of the process of producing a auto loan backed security. So in this case, for instance, you'd have lots of people borrow auto loans, like from finance companies. Finance companies or banks would then sell those loans to an investment bank. An investment bank would then pool those loans together into one auto loan backed security. And then they would sell that to investors on Wall Street, in particular to shadow banks on Wall Street, the thing that can then buy and sell and trade and reprice, et cetera, those auto loan backed securities. Now, securitization often sounds risky because it's complicated, and that is, in fact, one of the major risks. But it's worth pointing out that securitization is not inherently risky. Securitization is risky depending on a series of factors. First, a securitized instrument is risky in relation to the risk of its underlying assets. For example, the reason subprime mortgages were so risky is not because the concept of securitization is inherently dangerous. No, it's because if you stuff financial instruments full of shitty mortgages, there's just a high risk that the underlying asset that you've produced is shitty and is going to default. The second related risk is about correlation. There's a great paper called The Economics of Structured Finance that was published a few years back. I highly recommend reading it in case you want to better understand the logic of securitization. But one of the main arguments for why securitized finance works and why it reduces risk is that if you build a bundle of loans or bonds or investments, whatever it happens to be, it's safer than any of those individual loans or bonds or debts individually because there's the law of large numbers at play. What are the odds that all of these mortgages are going to default? What are the odds that all of these auto loans are going to default? Pretty low. And therefore, you can build fairly safe investments out of individually risky assets. But there's a catch, which is that doesn't work if there's correlation in defaults. If all of your mortgages start to default at once, there's no safety. If all of your auto loans start to default at once, no safety. So correlation of risk is very important in whether or not securitized products like mortgage-backed securities or collateralized debt obligations are or are not prone to default. Finally, securitized financial products are risky in relation to their tranching structure. So this is slightly complicated, and I wish I had included a diagram. You should probably Google one. It's a good way to visualize this. But one of the ways that you can create a securitized product in finance, again, just creating a bundle of assets that can then be bought and sold, is you can create different waterfall payouts. What this basically means is, did I include a picture? No, I didn't. Never mind. What you can basically do with securitizations is you can make the product, like the mortgage-backed security, for example, such that some people, some investors in the product get paid out first. So, for example, you can create what's called a collateralized debt obligation, or a CDO, where there is a tranche of people who get paid out first. That's the senior tranche. Tranche literally in French just means slice. So, for example, the first slice of the mortgage-backed security means as mortgage payments comes in, the senior tranche gets paid out first. And then subsequent tranches, like the mezzanine tranche, which is sort of in the middle tier, the equity, which is at the bottom, they get paid out as more payments flow in, but they're more towards the bottom of the rung. So if, for example, the mortgages in a mortgage-backed security default, the senior tranche holders get paid out first. And if defaults are too high to pay out everyone, then the equity or mezzanine tranche holders are the ones that don't get paid out in full. That's a form of what's called financial engineering, or a credit enhancement, where you can make a securitized financial product a little bit safer by creating a tranching structure that ensures some people get paid out first and other people have a higher premium that's paid to them. Like if you buy the mezzanine tranche of a mortgage-backed security, you expect a higher rate of return because there's a greater risk that you won't get paid out. And all of this is to say, a common narrative you'll hear in debate is mortgage-backed securities are very, very risky and very, very dangerous. Is that true? Well, kind of, but it depends on the mortgage-backed security. Yeah, a mortgage-backed security filled with extremely toxic subprime mortgages is risky. A mortgage-backed security filled with highly rated, stable mortgages is barely considered riskier than a US Treasury bond. So financial assets are not equally risky, and securitized financial products can be engineered to be less risky than they would appear on face. That being said, there's a major risk facing securitized finance, and by extension, a major risk facing the shadow banking sector, all of those financial institutions that perform bank-like behaviors without actually being regulated like banks, like finance companies, for example, would be an example. Finance companies, to be clear, different than investment banks. When I say finance company, I'm talking about the firms or the financial wings of industrial companies. So, for example, the finance companies that are attached to car companies or furniture companies, those are finance companies. They make loans. Money market mutual funds are the kind of wholesale funding providers to the shadow banking system. That's what I mean when I talk about the shadow banking system writ large. So what is model risk and why is it relevant for shadow banking and for securitization? Well, as you remember, shadow banks rely on short-term debt like repos, and they invest very heavily in securitized financial products like mortgage-backed securities. One of the major problems with securitization, and by extension with the shadow banking sector, is that it's very difficult to determine the risk level of a securitized financial product. Why? Because if you have a mortgage-backed security that has 10,000 different mortgages in it, I mean, it's going to be hard to figure out what the risk of any one individual mortgage is, much less 10,000 of them. So it's very difficult and complicated and riddled with information asymmetries, and adverse selection to figure out what the actual value of these securitized products is. And there's really only one way to figure it out. You use mathematical models. You have the smartest Wall Street engineers and computer scientists and mathematicians and quantitative analysts, or quants as they're called, figure out these fancy computer algorithms to determine what is the value of this thing, what's its risk, how probable is it that this stuff is going to default. And those models are typically pretty good, but they're always going to rely on certain assumptions, certain baseline cases, certain parameters, certain risk distributions, and sometimes the models are wrong. Sometimes they, for example, underestimate the probability of default. They underestimate the severity of prepayment risk. They underestimate the number of mortgages that might go into default and not have high enough recovery rates. All of that potentially results in the models that are used to price risk not being accurate. That's part of what happened in 2008. Lots of credit rating agencies had enormously sophisticated mathematical models that they used to determine whether or not mortgage-backed securities were risky. Their models were wrong. They had parameters and assumptions that were not reasonable. They made assumptions about default rates that were not aligned with reality. the models said that the mortgage-backed securities were safe. They were not safe in reality. That's an example of model failure. The financial model that was used to determine the riskiness of an asset doesn't accurately reflect the true level of risk. One of the other related concerns with model risk is the rise of so-called F9 monkeys. The concept here is if you run like a Bloomberg terminal, for example, or work at a bank, you'll often be hitting the F9 key on Excel, for example. The F9 key is basically the key that when you hit it on the keyboard and you're working like a complicated financial spreadsheet, it'll kind of crunch the numbers, it'll run the algorithm. The problem is that the people who design mathematical models to price securitized products, those are the math wizards, the quants, but they're not the traders oftentimes. They're not the people that are actually running the algorithms to price things. And so the people who are actually trading things like mortgage-backed securities, who are they? They're traders, they're investment bankers. Those are the folks who don't understand the math. They're just hitting the button. They're filling in the right numbers, hitting F9. That's why they're called F9 monkeys. And there's a real concern, which is what happens when the people that are buying and selling and trading securitized products in the shadow banking sector don't actually understand the brutally high-level math involved in these valuations. Here's, for example, just like a scary picture that you can find of one of the more recently developed models for structuring and pricing securitized assets. The point is that most regular traders, certainly not retail traders, but frankly, lots of professional traders themselves aren't really capable of understanding all of those nuances, and there's a real concern around models being incorrectly applied when pricing securitized products. By the way, this is an interesting domain where artificial intelligence might potentially improve financial markets. For example, there is the potential for large data models to better identify trends in prices, trends in default rates, trends in recovery rates, and so forth, in a way that improves pricing models and the accuracy of pricing models, which in turn might reduce risk in the shadow banking sector. The last thing I want to talk about in the domain of bonds before we shift to private credit is debt restructuring. One of the major things that doesn't get discussed enough in debate is what happens when companies go bankrupt and what the process of debt restructuring looks like and why that happens to be significant. So that's what we'll talk about next, and then we'll pivot into private credit. So it's worth thinking first about what happens when a company goes bankrupt. At a very basic level, it just means the company is not able to stay afloat. It's not making enough revenue to cover its costs. It's not able to repay its debts. Its liabilities exceed its assets. Now, when a company is nearing bankruptcy or after a company has gone bankrupt, it realizes that one of the biggest threats it faces is its debt. The company owes money it can't repay. So one of the major things that a distressed company or a debt-distressed company will try to do before it goes bankrupt is it will try to renegotiate those debts. So what does renegotiate mean? It doesn't mean that the company just forgets about the debts and says, hey, will you agree to be generous and just forget that we ever had this whole bond transaction? Rather, a company that is facing distress will try to renegotiate the terms of its bonds, the terms of its loans. What does that mean? Maybe reduce the amount of money that's owed, the interest rate that has to be paid, the period over which the bond is due for repayment, and so forth. And so if you are a debtor, a company that's nearing bankruptcy, you'll form a negotiation process with your bondholders and with the banks that have lent you loans, and you'll try to negotiate these terms. Now, the process of debt restructuring negotiations is tricky when a company has issued bonds. And the reason why is because when a company just borrows from a bank, it's very easy to figure out who the negotiations have to happen between. There's the company that borrowed, and there's the bank that lent the loan. But what happens when a company has issued bonds? Well, those bonds have been bought and sold and traded back and forth in secondary markets. And as a consequence, dozens or even hundreds of different investment funds, hedge funds, pension funds, mutual funds, you name it, might own those bonds. So what happens during debt restructuring negotiations is the institutions that own a distressed company's bonds will form some sort of committee, typically an ad hoc committee, and they'll often appoint some sort of proxy or some sort of counselor, and then they'll negotiate with the company. And they'll basically figure out, hey, how do we form a path forward here? Now, both sides of this negotiation process have some leverage. So, for example, the creditors, the people that have lent the money, they have quite a bit of leverage, which basically is just, hey, we don't have to give you anything. You're the one that owes us money, not the other way around. So, the simplest leverage that we have is we can just refuse your terms and force you to go bankrupt. But the company that's struggling to repay its debts also has a bit of leverage. One of them, for example, is if you're the company, you might say, look, it's in your interest to help me out here, because if I, the company, stay afloat, I'm in a better position to repay you in the future. If you force me into bankruptcy and you force me to sell all of my assets, you're not going to get much of your money back. It's in your own best interest as a lender to see my company survive and do well. The other reason is when a company goes bankrupt, one of two things can happen to the company. The first is what's called liquidation, and the second is restructuring. Liquidation, which in sort of the United States goes by Chapter 7 bankruptcy. Liquidation basically means the company decides it can't repay its debtors and it can't keep the business open. So the company sells whatever it has. If the company owns a factory, it sells the factory. If a company owns a machine, it sells the machine. If the company owns patents, it sells the patents. And the business basically uses the proceeds from these sales to pay off its debts, or it pay off its debts as best as it can. The other outcome is restructuring. For example, when airline companies go bankrupt, they typically don't engage in liquidation. They'll typically do what's called restructuring. And restructuring is basically a process in which it's determined that the bank and bond holders that own the company's debt will basically be forced by the court to negotiate new terms on that debt, and the business will leave the bankruptcy proceedings with a adjusted balance sheet and a new business plan, like cost-cutting measures, for example, to avoid going bankrupt again. So in that context, Chapter 11 bankruptcy, the company actually comes out of the bankruptcy and continues to operate. So, for example, most major car companies today, particularly in Western countries, have at some moment in time gone bankrupt, but they still exist. They still sell cars. They still design automobiles. How does that work? Well, when they went bankrupt, they did not liquidate. They didn't sell off everything they had and repay their creditors. No, they kept afloat by restructuring their debts. But what's important is in this restructuring process, unlike prior to a company going bankrupt, when there are just voluntary negotiations between debtors and creditors, when a company goes through this restructuring process after going bankrupt, a court can order what's called a cram down restructuring. What it basically means to have a cram down is if a court looks at a proposed restructuring deal and says, yeah, that's pretty fair, the court can just order that creditors, so banks, bondholders, etc., accept the new terms, the new interest rates, the new principal payment, the new repayment period, et cetera, et cetera. And so one of the pieces of leverage that debtors have in debt restructuring negotiations is they can say, look, if you don't negotiate with us now, here's what's going to happen. We're going to file for Chapter 11 bankruptcy. We're going to restructure, and we are going to ultimately get a restructuring of the debt that's very favorable to us. And it doesn't matter if you dislike it because the court will cram it down your throat. And so it's in your best interest to negotiate with us right now. So those are reasons why if you've lent money to a distressed company, it might be in your best interest to negotiate better terms. There is, of course, a collective action problem in debt restructuring negotiations. And the collective action problem is that it's in the individual incentive of each creditor to defect, i.e. to demand full repayment as opposed to partial repayment via renegotiation and restructuring. But collectively, the entire group is better off if all creditors renegotiate, because that allows for bonds to be amended and it allows for loans to be adjusted in a way that allows the company to stay afloat. So, for example, back in 2012, the Greek government faced a very real problem related to debt restructuring. So, for context, Greece was in a major sovereign debt crisis, as was much of the Eurozone. And Greece was having a major problem renegotiating its debts. And the problem basically was that under the terms of Greece's bonds, Greece more or less needed the vast and overwhelming majority of the banks that held its bonds to agree to change the terms for any of those bonds' terms to be changed. So just to put that, I'm going to make up numbers here. even if 80% of Greek bondholders were fine with the new proposed terms for Greece's debt restructuring, as long as 20%, say, of the bondholders opposed, Greece couldn't amend the terms. It just wouldn't work legally. But fortunately for Greece, there was a bit of a workaround. As it turns out, the overwhelming majority of Greece's bonds were issued under Greek law, which meant that the Greek parliament, was permitted to retroactively amend those bonds. In other words, go back in time, basically, not literally, but kind of in the modern day, change the terms of those bond agreements. And the Greek government could insert what are called collective action clauses, CACs, into Greek bond indentures. That's just fancy technical jargon speak for Greek bonds. Indenture is just the contract, basically, that spells out the terms and structures of the debt. And the reason Greece did this is collective action clauses can help to reduce the problem of holdout creditors. A holdout creditor is someone who owns debt and doesn't want to accept a restructured deal. They don't want to accept a lower interest rate. They don't want to accept a lower principal payment. They don't want to accept a longer repayment period. They want to be repaid in full. And the most famous example of this would be a vulture fund. A vulture fund is a very specific type of financial institution that buys up bonds when they're trading very, very cheaply because a company is right near the point of going bankrupt or has already gone bankrupt. And they buy it up and they plan on using aggressive litigation tactics to sue in court for repayment in full. Fun fact, I lost World's 2024 semis rather terribly on a motion about vulture funds. And so the purpose of a collective action clause is to basically stop the problem of vulture funds and holdout creditors. The problem of holdout creditors is a small minority of creditors can hold the entire debt restructuring process hostage by refusing to accept the renegotiated terms of bonds or loans. Collective action clauses say, look, as long as a substantial majority of creditors agree to these new terms, everyone has to agree to these new terms. That's what it basically means with collective action. If a majority or supermajority of creditors agree, then the new terms become binding on all creditors, even the vulture funds, even the holdouts. And the reason that Greece ultimately did this is because it allowed Greece to solve the holdout creditor problem and renegotiate the terms of its debts in order to achieve a pretty major haircut. Here, a haircut doesn't literally mean a haircut like cutting hair. It just means that basically Greece renegotiated its debts to pay roughly half of what it was originally supposed to repay. So in other words, if Greece was originally supposed to repay something like 200 billion euros, it only now had to pay somewhere in the ballpark of 100 billion euros in a way that made Greece less likely to default. Of course, as history would have it, that's not what happened. Greece once again faced a major financial crisis in 2015 and required yet another bailout from the Troika, but that's a different story. By the way, one of the most famous examples of holdout creditors is an interesting story that you can read about. There's a particular vulture fund that goes by the name, or has historically gone by the name, Elliott Management, and it was very famous for being a holdout creditor in Argentina's debt restructuring after the 2001 financial crisis. There was a long, drawn-out court battle in American courts because most of Argentina's bonds were issued under New York law. Elliott Management purchased Argentina's bonds for dirt cheap prices back when Argentina was basically locked out of credit markets and was considered to be bankrupt. And Elliott Management sued Argentina in American courts for full repayment. Now, you might ask a very sensible question. How on earth would an American court get Argentina to pay a debt to an American hedge fund? Well, as it turns out, there are lots of Argentinian assets, and for that matter, many countries' assets in the United States. Like central bank reserves would be one example, although those are rarely touched on a basis of legal considerations. But ultimately, Elliott Management successfully convinced American courts to force Argentina's assets in the United States to be used to pay Elliott Management the full amount of money it was owed on those Argentinian bonds. And this kind of famously resulted in Elliott Management briefly seizing control of a major multi-billion-dollar Argentinian naval ship, which is sort of an example of the power of vulture funds. By the way, one of the ways that the EU responded to the sovereign debt crisis in Greece and the Eurozone writ large was to require all Euro area sovereign bonds that have been issued after 2013 to include collective action clauses. The upside is that it makes the holdout creditor problem less concerning during debt restructurings. The downside is that investors know that there's a risk that they could have a debt restructuring deal forced down their throats without their consent. And so as a consequence, that does increase the borrowing costs because there's a bit more risk associated with lending to a European government. So that is the debt restructuring process. Just before talking about private credit, I just want to briefly summarize the importance of debt restructuring. Lots of companies that go bankrupt might potentially have value to add to the economy if their debts can be renegotiated in a way that allows the company to keep its employees on the payroll and to keep services being provided. Debt restructuring is complicated by the fact that when companies issue bonds in public debt markets, that bonds are dispersed across very many owners. And so you need some form of committee or some form of collaboration between creditors to ensure an efficient restructuring process. If that restructuring process doesn't happen, companies have to go bankrupt, they have to liquidate, and that ultimately is bad both for employees who lose their jobs, but also for creditors who don't get full repayment. The last thing that we'll talk about is private credit. By the way, there are two excellent papers. One of them is a Yale Law Review paper. The other is a paper that you can just find on SSRN that both sort of detail the rise of private credit in really excellent terms. So I'd quite recommend checking out those two papers. I've put them right here, and I'll include some lines later on. Private credit, I've alluded to throughout this presentation, but I haven't defined. Private credit is basically a type of lending that is privately negotiated between a private credit firm and some company that needs money. Now, by the way, a slight misconception is that private credit firms only lend to private companies and they don't lend to publicly listed companies. That's not entirely true. Some publicly listed companies actually do receive lending from private credit. There's no reason why private credit companies couldn't lend to those firms. There's just intuitive reasons why they wouldn't. Namely, those firms are credit worthy enough to access debt through other sources like bond markets or money markets. But nonetheless, the whole premise of private credit is providing loans outside of the conventional banking system. Now, the most common form of private credit is what's called direct lending. That's what I've described here as privately negotiated loans. There are other forms of private credit financing. One is mezzanine financing. That's a particular type of debt that sort of sits in a weird place on a bank's balance sheet where it's more senior than equity, but less senior than secured debt, i.e., in the event a company goes bankrupt, mezzanine debt would be less prioritized than secured loans, but more prioritized than equity shareholders, for instance. And distressed debt financing relates to what I was just talking about purchasing the debt of a distressed bank or a distressed company, and then aiming for that firm to repay you in full, either by growing the company and then having the company repay down the road, or by pursuing litigation against the company. So that's what private credit does. It's basically debt that's not traded on public bond markets. So again, just to kind of briefly contrast private credit and public credit markets would be a company issues a bond. An investor buys the bond and now is owed repayment by the company. Private credit is a PC firm goes to a company and privately negotiates a specific loan with conditions that are unique to that company. Now, who's investing in private credit? Where is PC getting all of these hundreds of billions of dollars to make these direct, customized, bespoke loans? Well, if you're a fund like Blackstone or Apollo that's running, a private credit fund, you're getting a lot of investment from all over the place, sovereign wealth funds, high net wealth individuals, but a lot of it, increasingly upwards of 40%, comes from pension funds and insurance firms for the reason that we discussed earlier about illiquidity and the illiquidity premium. Now, the key distinction between a bank loan and a private credit loan is A, if you're a bank, you're getting your money from depositors. If you're a private credit fund, you're getting your money largely from accredited investors. And the other distinction relates to speed. Banks are pretty heavily regulated, particularly in advanced economies. And as a consequence, there are a whole slew of regulations that banks have to satisfy and a whole bunch of procedures that banks have to jump through when they're issuing loans. That means that banks often don't lend to large swaths of the borrowing market. For example, below investment grade companies. And it also means that when banks do lend, they typically lend somewhat slowly, and there are limits on just how specialized those loans can be. So, for example, the degree to which banks will merge debt and equity-based financing. Private credit loans differ in speed and in customization. The main advantage that private credit has over commercial banks is private credit is not subject to banking regulations. So that means that private credit can sort of lend to a wider range of companies. That's what I was referencing earlier with the concept of credit expansion versus credit substitution. And the other distinction is about customizability. One of the upsides that private credit offers is that it'll offer very tailored terms in terms of interest rate structures, principal, et cetera, when lending to companies that need financing. The other thing that private credit is known for doing in comparison to bond markets is covenants. Covenants are restrictions on borrower behavior. Basically, a covenant in a loan agreement says you, the borrower, are not allowed to do these things. Things like take on more debt or acquire a huge amount of equity financing that dilutes the current equity owners. And so covenants are ways that private credit firms, and for that matter, banks, when they impose them, can regulate the behavior of their borrowers to reduce the risk of default. There's one other fairly important distinction between a private credit fund and a bank. And this is about origination to distribute versus origination to fit. So most commercial banks, increasingly over the last 20 years, have adopted what's called an originate to distribute model of lending. An originate to distribute model of lending means that a bank will underwrite a loan, it'll issue the loan, and then it'll sell the loan to someone else who packages it up for some securitized product. The most famous example of this, of course, would be mortgages and subprime mortgages involvement in the financial crisis back in 2008. If you are a bank that issues a mortgage and then sells the mortgage to Wall Street to be packaged up in some securitized, fancy collateralized debt obligation, you're originating to distribute. You're originating a loan, and then you're distributing it, i.e. selling it to some investment bank that then packages it into a securitized product. Private credit loans don't work the same way because private credit loans are highly customized, so it doesn't make sense to be selling them on secondary markets in the way that you might be able to do so for corporate bonds or in the way that you might be able to do so for auto loans or mortgages. The consequence is that private credit is notably more illiquid in its lending because although both banks and private credit firms are in the business of making long-term loans, private credit loans are less easily sold to other investors for securitization, and therefore private credit tends to be a bit more on the illiquid end. The other upside for private credit investors, in other words, the people that give their money to private credit, is that because private credit is both illiquid and highly customized, the yields that the private credit firms receive on these loans, the interest rates that are paid, in other words, tends to be a bit on the higher end. So the people that invest in private credit funds end up making a bit more money as a consequence. Private credit has grown pretty spectacularly in the last 10 to 15 years. And there are a couple of reasons for this, but you can sort of just really see the scale at which private credit now operates. One reason for the rise of private credit, sort of just intuitively, is regulation on banks. The more regulations there are on banks, the less and less of the borrowing market banks are able to control. Another reason is the general premium that a private credit fund can offer investors when compared to other potential investments, like, for example, investments into public credit, i.e., firms that engage in the bond market and buying and selling bonds. And so the reason, by the way, private credit offers that premium is both illiquidity, i.e., there's kind of a natural premium. If you're a company that's taking out a long-term loan, you kind of have to pay a higher interest rate as a consequence. That gets passed on to the investors into private credit funds. And also that customizability, the fact that if you're a borrower that's getting a very customized loan, you have to pay a slightly higher interest rate as a consequence. That in turn increases the profitability of the private credit market. And so there's increased willingness from the angle of institutional investors to put money into private credit funds. The other reason that's a little bit more interesting that for why institutional investors might be willing to invest in private credit funds is that private credit is reasonably immune to the problem called creditor on creditor violence. So the reason that I just talked about debt restructuring prior to talking about private credit is because what you might remember from the debt restructuring discussion is that when many different firms own a company's bonds, it's very difficult to restructure that debt because there are many different creditors, they have different priorities, and very importantly, each creditor wants to be ahead of the other creditors on the repayment totem pole, so to speak. They all want to be higher up in terms of seniority. And what that often leads to is creditors, bondholders in other words, using very aggressive legal tactics to try to make their position higher than others. So examples of this would be like banks finding ways, lenders finding ways to own more senior debt or debt that is secured by assets of subsidiary corporations in a way that makes them higher in line for repayment compared to other creditors. So creditor on creditor violence happens when many different firms own a company's bond because they're all involved in the restructuring process and they all want to be first in line to be repaid. That doesn't happen with private credit because there's one lender, the private credit firm, that's directly involved in issuing those loans, and they're the one that gets to determine the negotiation terms when a company happens to be facing the risk of bankruptcy. And as a consequence, there's a relatively higher probability that even when a private credit borrower goes bankrupt, there's a higher probability that the private credit firm gets repaid, especially when the loan is secured by some form of collateral. There are a couple of implications of the rise of private credit for borrowers and also for financial markets more broadly. One implication is a general increase in leverage. There are lots of firms that are below investment grade, in other words, not safe enough to be considered very stable borrowers with a high probability of repayment. And there's lots of those below investment grade borrowers that can't get bank loans, because they would be categorized as what are called leveraged loans, basically loans to firms that are already overly indebted. And these are firms that also aren't sufficiently creditworthy to issue large-scale bonds in public debt markets because no one would be willing to buy their bonds on a large enough scale. The default risk is just too high. So private credit fills that niche. Now, there's a good way to look at this and a bad way to look at this. The good way to look at this is that there are lots of firms that potentially can provide valuable services and goods and innovations and employment that now have access to credit because of the rise of private credit that's able to fill in that niche in the market, i.e. you have credit expansion, not just substitution. The downside is this potentially increases corporate leverage. Lots of companies will now borrow even more money than they previously could. And lots of the firms that private credit is lending to are not necessarily credit worthy. And that means that eventually private credit, when exogenous shocks hit the market, potentially could face huge losses that then spreads throughout the rest of the financial system. The second implication of credit markets, private credit market expansion relates to information. One of the major concerns with private credit is that this is all private. It's not happening in a public bond market where prices reflect investors' attitudes about the company's health and stability. And because private credit is involving private negotiations between a bank, well, really a private credit firm, and borrowers, there's limited transparency. And the consequence of that is that there's a real risk of mispricing. It's not to say that private credit firms willingly give bad loans or willingly take on too much risk. It's rather just to say the best way to figure out how safe a company is to let as many investors as possible speculate on the value of the company's bonds in secondary bond markets. That's the best way to figure out through the wisdom of the crowds and the efficient market hypothesis whether or not a particular firm is or is not a good borrower. The main risk with private credit, perhaps, is just that when you have individual customized negotiations that determine whether or not a company gets money or the interest rate it pays, there's a greater risk as a consequence that more and more companies never go public. They never issue bonds. They never IPO. And as a consequence, pricing the risk of those companies becomes harder and harder because they're not operating in public markets. And private equity and private credit firms are inevitably bound to get those valuations and risk assessments wrong. The third potential implication of the rise of private credit relates to the effects on insolvency and restructuring. One of the upsides of private credit is the elimination of creditor-on-creditor violence that I was just talking about earlier, which potentially makes debt restructuring easier, which means that when companies face distress, it's easier to renegotiate the terms of a deal. Of course, the downside is that private credit might also increase the probability that companies default in the first place by saddling companies with quite a lot of debt that they otherwise couldn't access through high-yield debt markets or through commercial bank loans. And that's a particular problem as private credit expands beyond just mainstream lending into an increasingly wide array of sectors, including even real estate and consumer finance. And that potentially creates concerns about systemic risk that lots of financial regulators are increasingly concerned about. So why do investors nonetheless continue to put money into private credit given all of these risks? Well, there's a couple of reasons. One reason is if you're a investment fund, like a pension fund, a mutual fund, et cetera, and you're trying to figure out where to park your money, there might be an intuitive benefit to investing in private credit compared to investing in, say, a bond fund. One is bonds are typically not secured. There's not collateral backing the bonds, but there typically is collateral backing the loans that are given by private credit firms. So private credit firms might have a bit of a safety edge in that domain. Another reason relates to covenants. If you're a private credit firm, you're negotiating the terms of these bonds, which means that you have the ability to demand, no, you can't take more debt. No, you can't make very risky business decisions. No, you can't operate without consulting us first. So private credit firms have greater oversight as to whether companies are managing risk appropriately. That doesn't exist in bond markets to nearly the same degree. Finally, private credit might just have the advantage of debt restructuring, which makes it less likely that a company actually defaults because there's greater ability to adjust the terms of a loan because there's no creditor-on-creditor violence and there's no collective action problem in debt restructuring. Comparing bank loans, for example, to private credit is a little bit trickier, but you might plausibly argue that because private credit firms can't easily get loans off their balance sheets like banks can in the originate to distribute model, they're much more incentivized to diligently monitor the riskiness of the firms they're potentially going to lend to ensure that they issue loans that have a reasonably high probability of being repaid because they don't have the ability to sell loans off of their balance sheets in a way that commercial banks potentially might be able to do. The other reason why investors are drawn to private credit that I alluded to earlier is yields. And there is some merit to the fact that private credit has offered pretty substantial gains to investors, particularly in comparison to other sorts of fixed income securities or other sorts of debt markets. Of course, there's a bit of an asterisk here that you could highlight in a debate. And the asterisk is private credit markets have yet to be tested. Every other major market has gone through some major shock, some major crisis, not even just an exogenous shock like COVID, but some specific shock to that type of investing or that type of lending. That hasn't really happened yet with private credit. And there are some real concerns about whether or not private credit's loan portfolios are sufficiently safe to endure a major shock, like a major interest rate shock, for example. There's one other interesting argument that I think is kind of cool in thinking about the merits of private credit, which is an argument about countercyclicality. The argument basically is one of the problems with reliance on commercial banks to control lending, which was the sort of historical norm prior to the rise of large-scale bond markets and more recently since the rise of private credit funds. One of the issues with bank lending is that banks tend to lend less during recessions. And there are two reasons for this. One reason is the boring reason, which is just that banks literally have less money available to them during recessions. That's often when depositors will pull funds out of the bank, especially uninsured depositors, for fear of the bank potentially going under. And the other reason is capital regulations. When banks' loans start to deteriorate in quality, i.e. when bank default rates rise, banks are required to up their equity buffer, that capital requirement that we talked about earlier. And when banks have to hold more capital, they can't issue as many loans, and that in turn limits bank lending during downturns. Of course, that's an issue because lending during downturns is exactly what you want. That's how you stimulate economic growth and spur innovation during periods where the economy is stagnant. And arguably, that's what private credit is capable of doing because private credit is not subject to those same capital regulations. And private credit doesn't face the risk of deposit deposit withdrawal because private credit's funding is locked in, which means that, for example, investors in private credit funds can't withdraw their money nearly as easily. And investors do probably want long-term gains from their private credit investments. And so that actually creates a pretty major opportunity for private credit funds because during downturns, lots of companies are suddenly undervalued because everyone's selling their bonds. And that's a real opportunity for private credit to do, for example, distressed debt financing, like providing loans on pretty excellent terms to companies that don't have many other alternatives available to them, because the private credit firm realizes that the company has enough value to grow post the recession ending. That being said, there are pretty colossal worries right now about the safetiness of the private credit sector. And there are lots of concerns about what happens if the private credit sector starts to suffer major write-downs on its lending portfolios. One concern, probably the simplest concern, is just that private credit has led to more companies borrowing money, and it's led to riskier companies borrowing money. And there's a risk that many of those borrowers eventually default. Another concern relates to IRR pressures. This is a little bit weird, but IRR just means internal rate of return. It's basically the rate of profit that the company, i.e. private credit firm, has been able to extract from its investments. And there's a potential concern that if the thing that's attracting investors to private credit is high yields, private credit firms are under pressure to provide high yields, which naturally forces them to take ever riskier loans in an attempt to satisfy investors' pressures. And that potentially means that private credit firms start to reduce the standards that they use when underwriting loans to, for example, issue higher interest rate loans to lower quality borrowers in a way that might successfully increase the rate of return as investors demand, but might also increase the risk that investors suffer losses as default rates rise. There's a third concern that's specific to dry powder. Dry powder basically is liquid assets, or HQLA, that stands for high quality liquid assets. Remember, we talked about that earlier in the liquidity bank regulation context. The issue is that private credit dry powder has increased pretty substantially over the last several years. Now, dry powder basically just means private credit firms have lots of money sitting around ready to be lent out. And that might sound like a good thing. That means that they've got lots of money to spend chasing good quality companies when the investment opportunities arise. But the potential concern is that when private credit firms have lots of lots of liquid capital just sitting around, there is a pretty real risk that this eventually results in asset bubbles or in poor investments. Why might it result in bubbles? Well, there's one major concern, which is when lots of private credit funds all have lots of dry powder because they're all sitting around waiting for the next big lending opportunity to arise. When some big opportunity to lend arises, it's potentially plausible that all of these major private credit funds rush into the scene all at once, all trying to capitalize on the opportunity. And when all of these major private credit funds are trying to lend billions of dollars to the next big thing, it potentially leads to an over provision of debt to that sector in a way that might be useful in the short run, but increase the risk of default in the long run. The other concern relating to dry powder is about and that also leads to problems of like inflated valuations in the private equity context. But the other concern with dry powder is if private credit funds have so much dry powder sitting around waiting to be spent, there's a slight problem, which is that private credit firms eventually do have to return investments to their investors after a finite number of years has expired. If you keep sitting around waiting for a great investment opportunity to come, and it never does, eventually you're going to have to just pick your best option and lend because you have to meet that deadline for when your investors expect their money back. And so there's a real concern that if private credit funds are sitting around waiting for a great lending opportunity to arise, and it never arises, they'll feel an obligation, a very real obligation, to lend that money regardless, because they can't just let it sit around, not accumulating substantial returns, and that potentially leads to needlessly risky investments. The last concern that I'll flag vis-a-vis private credit is private private credit does have pretty strong linkages with the commercial banking sector. For example, lots of commercial banks actually just lend directly to private credit firms. And that potentially means that if there are problems with private credit, that will spill over to commercial banks. And of course, because private credit has received so much investment from insurance companies, and because private credit is so involved in sort of AI capital expenditure booms, there are major concerns about potential spillover effects on the insurance sector and the ability to pay out policies. So those are really all of the core debt markets, i.e. money markets, bond markets, private credit, et cetera, that are sort of worth understanding in detail. I'll wrap this presentation up by just highlighting a couple of endpoint conclusions. The first is you should understand the transmission mechanisms that relate the financial economy to the real economy, and you should be able to explain in debates why the financial system matters for economic growth and also for development. Secondly, you should be able to explain why intermediaries exist, the purposes that they serve, the risks that they face, and how they're regulated. Third, you should be able to explain the distinctions between debt and equity markets and also explain the relative implications of being public debt or public equity or private equity. And lastly, you should be able to think about and argue about risk, like risk management, diversification, why price discovery matters, and how financial institutions potentially face contagion risk, how illiquidity becomes insolvency, so on and so forth. That's all I have for this presentation. Apologies for the length. Hopefully this was useful, and best of luck with your debating.